It's another Federal Reserve Day. Oh boy, oh boy, oh boy, oh boy. You kind of love these days. These are some of the most exciting days. And I'm also really excited because, yeah, I think we haven't done the totals yet, but October is stacking up to be probably the biggest fundraising round that we've done all year or month. Just the month. For house hack slash, reinvest, which is kind of remarkable. I think people are really like looking for an opportunity to diversify from some of these crazy high valuations because they're looking like, hey, I can diversify into an AI startup that has a real estate valuation, which, is on the low side right now because we're just starting this AI launch. And I think that's why people are flowing into it. But we've had some of the greatest inflows all year this month, and it's really incredible. And I just wanted to say thank you to all of you because it wouldn't be possible without you. But we'll put it to great use, and we'll keep being real estate backed, which is really great. There's strong stability, I think, in the background. I think that's fantastic. So that's really exciting. Now, today is obviously Fed Day, so of course we're expecting to get our 25 bipbles. Not only that, but, what's Powell gonna do? Is he gonna rug us? Is he gonna talk dirty to us? Is he gonna talk nice to us? We'll see. At the same time, you've also got like a heart attack going on at a stock like Fiserv. You've got Nvidia. I feel like I'm only partially trying to take credit for this, but I feel like after I made my video on Nvidia, like the institutions started waking up and they're like, oh damn, Kevin's right. These are some big number changes on forecasts for Nvidia, and Nvidia just freaking skyrockets, man. Holy smokes. The momentum on AMD is getting actually a little bit of a boost as well. All right, so the earnings call now, what I'm trying to get is the Fiserv earnings call. Oh, it's finally out. Oh, this should be juicy goosed. This will be entertaining, so I'm going to pull this up, and we'll go through this in just a moment. But, wow. Go NVIDIA. Geez, first $5 trillion company, absolute insanity. Okay, so let's go ahead and get, what we're going to get now is the Fiserv earnings call. And yeah, also this morning in the course member live stream, we did some NEO analysis, fundamentals. And then we also did fundamentals on Enphase. And I have to say, both of them, I was shocked. So if you haven't watched it yet in the Alpha Reporter or Course Member live stream, remember today is coupon code expiration day, Schumer Siesta. So you could join using coupon code Schumer Siesta at meetkevin.com. And you can see that analysis on Enphase and NEO this morning, obviously, as well as the trading setups. All right, so let's see what's going on with Fiserv because they're absolutely tanking. I mean, I haven't seen a tank like this in a while. I mean, this is like a meme rug pull, and it's taking a lot of the consumer stocks with it. Like if you look at, Play, if you look at, what else? Fun. If you look at, let's try Cake. I don't know. Yeah, Cake's down 5%, dude. Let's try Red Robin. Red Robin Gourmet Burgers. All of these consumer style plays. Let's try Macy's because I think they use Fiserv. Yeah, they're also down a little bit. Let's try Best Buy. They might be a little bit more insulated. Yeah, up 10 basis points, of course. But you can really see this massive consumer pain over here. So there's something going on here, but this is an absolutely insane hit here. So very interesting. Okay, so let's go look at what's going on with Fiserv here and what the hell happened. So let's see here. We've taken okay. So financial results. They have operating income decreased 7%, resulting in an adjusted margin. Clean Spark? Oh, we'll have to hold on. Let's see, and then LRN, same story as Fiserv. Wow. Resulting in an adjusted margin of 37%, a decrease of 320 basis points. So their margin fell, their operating income fell, organic revenue grew 1%, but financial services declined 3%. There are three unusual dynamics impacting the company. First, the company experienced foreign currency, issues over here. That's fine. Okay. Partly because of Argentina. Then Argentina's interest rates jumped meaningfully. And finally, Fiserv completed the mutual termination of its merchant alliance joint venture. All right. So two of the three reasons here have to do with Argentina. 10-cent headwind to adjusted EPS because of foreign currency expense. Oh, stop it. Then you had all these, stop, what is going on? All these stupid notifications. Yeah, all three of them are dumb too. I had to turn those off. I turned them on recently because I was messing with things on my watch and I think I made a mistake. But anyway, okay, I mean, whatever. Those all seem pretty, one time. But what happened here? Like, to drop 43% by missing adjusted EPS by 20%, it's kind of shocking. So, a little bit more about what changed. Yeah, what changed? Specifically from the growth trajectory. It's almost like they rug pulled growth, right? So what happened here? Let's see here. But the rate of learning has plateaued, and the numbers in the baseline we're giving you today, we're highly confident reflect the company today. So all of a sudden, growth stalled basically. And people don't like that. People want companies that grow. People like a growing PP. Pricing power that goes up, revenues that grow up. Cyclical factors highlighted regarding Argentina. We can grow mid-single digits, but if you take that out, that's where we are today. We go to two businesses, different pieces, world-class banking, embedded finance, whatever. They're like a point-of-sale processor. You go, swipe your credit card at Macy's or whatever. This is where they're making some money. But I don't think people have fully digested yet what's going on over here. I wonder if they have anything to say about the consumer because, they're a payment processor. We're traditionally very, very strong in core restaurants and retail, right? And that's the concern, right? So if restaurants and retail are core, and that's where you guys got smashed, it does sort of create some concern over consumption, but they don't even mention the word consumer. What about economy? No. What about macro? The analysis, macro stuff? No. They kind of just turn a blind eye to the consumer or macro, which is somewhat surprising. But it's a massive plummet here in this company's forecast for growth. They do blame Argentina a lot, but we could look at their annual report to see how much of their growth actually comes from Argentina or their revenues. Adjusting for these, Q4 growth would be in the high teens. The Clover story remains exciting as we continue to expand through vertical expansion. Yeah. So partners with ADP, that's where we're getting some good job numbers, decent job numbers now relative to if you adjust for sort of a new break-even low after the immigration, disaster that we're going through, or shift, I guess you could say. Yeah. All right. So anyway, a lot of people are going to be looking at this as a consumer play because here's a company that basically just lost. I mean, they're a $40 billion company. They lost like $30 billion. $30 billion just poof. Evaporates into thin air, which is wild. So at the same time, you have NVIDIA that's just picking up all the pennies today. NVIDIA absolutely crushing it. I think people, again, as I mentioned in my video yesterday, people forget that this is a company that has the greatest pricing power in the world at the moment. It won't last forever. It will, I wouldn't hold it for 10 years, Because I think there'll be a transition to it. But I mean, I still have seven figures in Nvidia stock, and so I don't mind the surge. I just know it ain't gonna last forever. But there's still juice to be squeezed. So let's see if there's anything else we could see on Fiserv, because it's kind of remarkable that such a consumer-centric company can get destroyed this badly. Fiserv's significant EPS and revenue miss were broad-based. Management's steep guidance revisions raised concerns about their 2026 trajectory. Broad-based weaknesses across financial services and merchant businesses flag growth risks heading into the new year. Leadership changes, also sort of raise the eyebrows. Yeah, I think there's more to this story, though. Let's see here. Fiserv. Let's see what Barron's has. This might be locked. Yeah, I'll have to sign in. Okay, I'll just go to a different source for right now. Oh my gosh, they're all paywalling. It's so annoying. It's all right. One of these I'll actually be logged into. All right, here we go. So, everyone's favorite, Seeking Alpha. In addition to management strategy, Fiserv will transfer the listing to NASDAQ from NYSE under the ticker Fiserv. Right. I mean, this is just a way to try to align with the idea of being a growth mindset company. And I kind of think it is actually relatively meaningless. Yeah, there's not much yet to break down exactly what's going on at Fiserv. I think it's just sort of like a shock. I think that's the way to look at it. It's a consumer shock. And nobody likes to see that because, I mean, where are we on the 10-2 yield? We just walked back out of, shock prone territory, but we could slip right back in pretty quickly. We're at 49 bips right now. 49. And if we go look at bonds, the U.S. Okay, let's go to the U.S. Treasury here. Let's do U.S. 10-year, just under 4%. Look at that, 3.995. Okay. Wow. Well, pretty remarkable. So, and then also, a 5% move on a $4.8 trillion company at the time is also crazy. That's going to be a big contributor to the Qs. And I don't think Powell rugs that, but we'll see. Symbotic hanging out at 70, nice. Starbucks can't really go anywhere, 84 bucks. Microsoft, 74 bips. Ethereum's under 4K. Ethereum and crypto have really come under pressure recently. I think you just don't have as much liquidity from the, let's go look at what the volumes are on like MicroStrategy and the Bitmine immersion. So, yeah, volumes have really gone to crap. MicroStrategy kind of relies on volumes, right? Look at the volume spikes here when the price surges. Now, some of that could be trading activity, but when you get these volume surges, you create an opportunity for the dilution of shareholders to... Oh, are you kidding me? Cantor Fitzgerald is now pulling a $300 price target on NVIDIA. Are they just like signed up for the, Meet Kevin? Are they subscribed to the Meet Kevin channel here? Yeah. So, hey, whatever, man. I like the ride that I'm getting on my NVIDIA stock. And hey, we've been doing some solid analysis on a lot of different companies in the course member live streams. So yeah, you should go check those out. Remember, even if you just joined today, you could go to the stock tab and just scroll through the stock tab and look at a sample of some of our recent fundamental analysis. There's some good stuff in there. Like there's stuff that, like for example, on Enphase, you'll look at it and be like, oh, wow, I never thought about that. Very, very interesting. And that could be bearish or bullish, right? But let's go see if Nick T or anyone, you know what? Actually, sometimes we could get some color from Fiserv on, I usually don't like looking at X. Yeah, here's a leaked footage of Oh, yeah, that's unfortunate. Here's leaked footage of Fiserv right now. Yeah. Not great. SEC total, let's see. Okay, that's that. Okay, I've been following payments for the better part of 20 years. I've never seen a worse quarter than what Fiserv just reported. Yeah, disastrous quarter. Timing delays. Some people are calling it a kitchen sink quarter. Yeah. I mean, sometimes that happens. You know, you throw in all of the worst things that you could possibly say, all into one quarter, and then you just sort of expect to buy back, right? It's actually very interesting. Like, look at this. The top 10 high quality stocks actively buying back their shares at a 5% yield. And then you have, Fiserv as their number two. And, now it's down 42% or whatever. Oftentimes when like these companies, are like, hey, yeah, we're buying back the shares. It's just often to pump the stock up. Anyway. All right, let's see what Nick T has for us today. Nick T! Nick T, Nick T. All right, October FOMC is a bit unusual in the following way. The September SEP showed a split on the committee, a narrow majority who wanted to do more cutting as a risk management exercise, but a significant minority did not see the need to. Normally, the data help reconcile the divide, but with less top tier data available, there's less reason for people to change sides. I mean, that's an idea. Oops, I didn't mean to click that. I meant to click this. So, man, Powell's looking concerned there. Okay, so let's see here. Divided forecasts. All right, I'm definitely going to have to turn off some of these notifications. Data drought, yeah, decision for December. The data blackout could give Powell an easy way to sidestep questions about how they're approaching the next set of decisions. Yeah, because he always kind of like punts that. It's like, oh, it's going to be meeting by meeting. There's no risk-free path. Fed Governor Myron could dissent again in favor of a larger half-point cut. However, without clear data showing meaningful job market deterioration, it may be hard to submit or, to support a bigger move. Totally agree with that. Likely to discuss the wrap-up of QT. Even if we don't get QT that ends today, we'll probably get a time frame for the end of quantitative tightening, right? So, my expectation is expect nervousness before the Powie Wowie. And, man, I just really would love to get some more color on Fiserv because I feel like it's such a consumer processing company. Like, how many payments does Fiserv process? And then let's go to the Fiserv annual report, because that could give us some color too. So Fiserv transacts 35 billion transactions, 35,000 a second. Sorry, 25,000 a second. Holy smokes, dude. So, and Visa actually reported good earnings. So then I think that's why a lot of people are sort of scratching their head, like, what happened here? Because it is a consumer exposed company. Fiserv, let's look at if we look at the annual report, which is from February, which is old, we might be able to get some segment data just to see where they make most of their money. Because again, they got hit with broad weakness. So if I go to the annual and I just type in segment. So yeah, see, this is why I think the Argentina thing is kind of funny. Because if you look over here, Clover, point of sale at management business, e-commerce. So they do point of sale checkout, they do e-commerce. Look at their revenue, folks. 85% is domestic. So this idea that Argentina is solely to blame for this, I find very hard to believe when 85% of their business is domestic. I know that's what they're like blaming this on, but I don't know, man. That's an insane drop in a stock. Could you imagine, like, you have $10,000 in that stock, and then all of a sudden you wake up and it's at like 5,800? You know, what a pisser. How fast stocks can drop. It's insane how quickly an order book can get destroyed. Let's see here. Fintech, payment system, operating income, goodwill, boring. This stuff's all boring. I was hoping to get some more on. They're doing some fintech acquisitions, whatever. Business segment info. Oh, wait, what did I get here? Nope. Yeah, I think it's just going to take a while for the dust to settle on this one. Processing, because see, this is where where their revenues come in. They've got the product revenue, but then also the processing, payment processing. That's where the big money is, and they actually have decent operating income. Like, their margins aren't that bad. You know, $2.3 billion divided by 8,132 as a payment processor. That's a 28%, operating income margin. So 28% operating income. That's decent. And again, I think it's just the volume, the sheer shocker here is going to take a while to digest. All right. So what else is moving today? So we've got Caterpillar that's moving a lot. Caterpillar's already been kicking butt quite a bit. I mean, you look back at Liberation Day, and this was a stock trading for $280. I mean, you have Caterpillar, which is a $278 billion company that's basically doubled here. A pretty remarkable move, which is just like Fiserv having. Although they've kind of been bleeding for a while. You know, they peaked out really before Liberation Day, and they've really been down since then. Makes you wonder, how low did they get here? They are past COVID lows right now. Holy smokes. That's crazy. COVID lows were basically where it's trading right now. Wow. All right. Well, in the meantime, the Qs continue to move up as NVIDIA keeps moving on up, which is pretty remarkable. This, like, I think people, again, we have to look at a company like NIO, for example. When we look at a company like NIO, we say, hey, here's an automotive play that people are, somewhat excited about. People call it the sort of like Tesla play of China, especially now that they manufacture themselves as opposed to enjoying partnership. But then the question is, we've got negative EPS here. When does that turn around? And so then, is it better to say, here's a company with, here's a company that uses NVIDIA products? And the amount of anger I got yesterday when I talked about NVIDIA's automotive products was insane from the Tesla cult. Now, I'm not, short-term bearish on Tesla. I'm actually short-term bullish on Tesla because I think the stock comp's going to pass. But the amount of comments that come out of people like, oh my gosh, how are we still talking about LiDAR or whatever? The conversation I had yesterday about LiDAR was that, and I don't think people realize this, so I'm going to boil this down. I highly encourage you watch the video, but I'm going to give you a bottom line that I don't think people realize, okay? So this is going to be a very simple bottom line. I'm going to say this. Does Elon hate LiDAR because LiDAR isn't necessary, or does Elon hate LiDAR because incorporating it would require starting over? Right? They have the data, right? They have the data, but you'd have to rewrite FSD and replace all hardware to, Fusion, the vision and LiDAR data, right? So this begs the question, does Elon hate LiDAR because LiDAR bad, or because LiDAR bad for Tesla? You see what I mean? that question, even if you're a Tesla shareholder, is really important to ask, because there's a level of ego here that is very important. So I think Tesla has gone so far, it's basically too late, right? I think Tesla has gone so far down the rabbit hole of no LiDAR. You can't U-turn now, even if it's the better thing to do, right? Like, that's the concern that I have. Like, is it possible that Elon's ego prevents that recognition? Does ego stop a proper transition? Like, if we had to transition over 6 months and then all of a sudden we had we actually had full self-driving, like 100% unsupervised FSD, we have to wonder, like, would that be worth it, right? So look, for example, if we say, let's go and say, let's put it this way. Let's say it costs $5 billion and, how many, let's just do, I don't know, call it, let's go $3,000 times, I don't know, let's take like 4 million vehicles that we could upgrade. It's gonna cost more. Let's say it costs 10 bill, which is closer. Let's say it costs 10 billion and 12 months to transition, but that gets us 100% FSD. Would it be worth it, right? That's the question. Like, would that it be worth it? And so I don't know. I think it's just too much money. The fact that he shut down Dojo, meaning he has no ego to admit he's wrong. I mean, they kind of quietly shut down Dojo, man. That was kind of like that was egg on face, man. I don't think Elon's cheering that one, man. But yeah, I think this is very interesting. Okay, so Sam Lee here says, but they tried LiDAR. Elon's not against using LiDAR. Okay, just because you tried LiDAR in 2016 doesn't mean it doesn't work today, right? Like, but Elon tried LiDAR. Sure. In 2016, when they used NVIDIA, it's been 9 years of development. It's probably substantially better today. The problem is we went down an all vision road, right? So it's gotten a lot cheaper. So I think it's very, very interesting. Somebody says, here comes the Tesla cult. Get them, boys. Right. So I think it's very interesting because people get so, like, offended if you mention this. People are like, you're trying to bag on my stock. You're trying to take my money away. No, I'm not. Get your head out of your damn ass and realize that there's a very real possibility here that Elon doesn't like LiDAR because he's so deep in the vision rabbit hole. It's so deep in the vision rabbit hole. Somebody says it's important that we have LiDAR and vision in the market. It's the biggest A/B test. Well, I mean, you do. You got Waymo and you have Tesla, right? So somebody said, LiDAR is very bad for the eyes. It's shooting lasers. What? Like, are you just like making stuff up at this point? This idea like, what, you're gonna kill people's vision because, you're using laser radar. So like what you're saying is every time a cop takes out a laser radar to measure the speed of other vehicles, they're actually like damaging our eyeballs. Is that what you're saying? Come on, like I feel like you're just sort of making things up here. So Anthony says, but Kevin, most of these people are Tesla bulls because of you. Does that mean I'm responsible for only shilling the stock? Or does that mean I'm responsible for providing good factual information back in 2017 when I was uber bullish Tesla and it's returned, like 100x? And now I'm like, guys, I don't know. Now the fundamentals are changing. You have to remember that. And most people won't do that. Most people will not tell you when something has changed, because it is much easier to just keep the sort of like the bull hat on, blind love, shill. You're typically not gonna get true analysis. There's too much knee bending in this world. Too much knee bending. So anyway. All right. So then what do we have here? Then let's go see here. We've got, all right, let's do a little bit of Powell prep, okay? So a little bit of pre-Powell prep. All right. By the way, I'm gonna run a survey before we do the pre-Powell prep, but I'd like to see your answers to this question. No, the survey has nothing to do with the coupon code expiring today. Don't worry, and it doesn't have to do with LiDAR, okay? I want to know, okay, which one of what I'm about to show you is your boy, okay? So I'm gonna show you two pictures, and then you're gonna have to vote in this poll, and then you're gonna say either April is your boy or October is your boy. And so I'm gonna run the poll, and then you gotta pick, okay? One of them, according to a text message that I got about this, one of them is James Bond, and one of them is Jose Bond. All right, so which is your boy? April Kevin or October Kevin? All right, ready for this? So this is very important fundamental research here. Here we go. Which one of these is your boy? April Kevin or October Kevin? From James Bond to Jose Bond. All right, I'll let y'all do some work on that. Now, with that said, let's do a little bit of Powell prep. All right. All right, we've got to do a short and quick and sweet pre-Powell prep meeting. Here's the Scoopy Doodlies. We know we are lacking data. Nick T is saying this is going to be a great opportunity for the Fed to just go 25 BEPs and kick the can down the road and not actually give us a lot of forward guidance, because they're just going to say, we don't have a lot of data. But I actually dispute that. See, you already know this. Today is coupon code expiration day, coupon code Schumer Siesta for the Meet Kevin membership and the Alpha Report. This morning, in the Alpha Report, these are the things I like to point out in the morning. I'm gonna give you a spoiler right now. But something has just shifted. And the Fed would be dumb not to talk about this. And I think they will. Look at the Atlanta Fed real GDP. We already know that the real GDP estimates are mega high. 3.9% is phenomenally high. This is like, forget soft landing. This is like mega boom level GDP. Now, that doesn't mean that it's going to be accurate, but what you have to see that's changed is this. For the last 2.5 years of us looking at the Atlanta Fed real GDP levels, we have always seen the blue chip consensus around 1%. It has consistently been around 1%. That means blue chip American companies have really only been telling us that GDP should be moving somewhere around 1%. And what did we just get? We just got a massive inflection point to the upside over the last 4 weeks. Now, how do we reconcile this with employment break-evens? Well, this is obviously what's critical today. Is I'm gonna make you a menu of what we wanna pay attention to when it comes to Powell today. So this is sort of our last minute little menu here, okay? So the first thing that I wanna pay attention to is economic strength via GDP references, okay? These are gonna be bullish stonks. It is very normal. In fact, we talked about this in the Alpha Report, because that's what we do in the mornings. We set the stage. It is very normal to get a sell-off between now and Powell talking. Very normal to see a pre-Powell sell-off. But what we need are the longer term signals. And the best signal that we could get is color on what, this is probably the most important question. I don't know whether we're gonna get it, but what is the labor break-even rate? I believe the Fed thinks it's 20K. If they say it's 20K and ADP right now is showing 14K, we're actually decently in alignment. If they say break even is 0, that's actually bullish because it means without immigration, we don't actually need much labor growth to keep the unemployment rate stable. Now, what matters for recession is the difference between the break-even rate and the actual jobs report. So, if immigration high and break-even rate is 150,000 and we have 50K jobs, that's recessionary. Usually, around 50K jobs is recessionary because it revises to negative, right? Once we actually get the revisions, we tend to go negative, and then we're in a recessionary environment. But it all comes to what the break-evens are. If immigration is negative and break-even rate is -10, to 0K, and jobs are 14K, yeah, we could see all these layoffs, but it's actually bullish because it means the unemployment rate ironically goes down. So Powell color on the break-even rate is critical. This is where we talked about yesterday. If we hear beverage curve is steep, that's bullish. That's a complicated way of saying it, but it basically means as job vacancies are low, we can actually normalize at a low unemployment rate, creating a steep slope of the line. I really don't want to get into like slopes and lines of all that kind of stuff right now, but it's just important to understand if we hear anything about a steepening, it's bullish. The lower the break even we hear, bullish. So like if you're making notes on a notepad and you're looking for like how to day trade or whatever, in my opinion, the lower the break even we hear from him, the more bullish. The steeper the beverage curve, bullish. Any GDP references about economic strength, especially that blue chip consensus moving up, bullish. Is it normal to see some kind of sell down before the Powie Wowie meeting? Every single time it happens. Is it possible that if we get a bullish Powell, yields actually end up going up? Yes, it is very possible that we end up getting a rate cut and the 10-year treasury goes up to like 4.05 and goes up and interest rate sensitives get hurt. Now, the crappy dappies, okay, this would be like, it's so unlikely to happen, but there is a crappy dappy scenario where Powell basically SH9Ts the bed, okay? It's very unlikely, very, very, very unlikely. But let's say he poops the bed, okay? Pooping the bed is NQT, 25 BP, signal multiple more cuts, spends a lot of time focused on credit, distress, private credit, and layoffs. Those are all bearish signals, and they are economically bearish. Yesterday, we had the worst day since 1990 on stock breadth. Now, that's not like meat breath, because you just had a big sandwich and you've met Kevin and you had a bunch of, pastrami on it and you got stink breath. No, breadth is the difference between how many stocks are rising versus how many stocks are falling. Here you go. Yesterday, we had the worst up day for the S&P 500 since 1990. So basically what you do is you say we had 200 stocks that went up and we had, 300 that went down, let's just say. In that example, you would be at net negative 100, right? But what we actually had was we had a negative 300, which that means the vast majority of stocks in the S&P 500 were negative yesterday. And so when we take the advancers out of the 500, the number of companies that were positive minus the negative, we had a whole lot of companies that went down yesterday. Now, part of this could be because of this sort of weakening consumer situation. And I'm still having trouble digesting what's going on with Fiserv, because Fiserv is a payment processor that does as many as 25,000 payments per second. This is a financial infrastructure play. If Powell talks about this, it's actually somewhat concerning, because financial plumbing, breaking, is what leads to financial crises. And Fiserv tanking to COVID lows. I kid you not. Look at this. March of 2020. Prices in March of 2020 were higher than they are today on Fiserv, a financial plumbing company. It raises some red flags. Most transactions that Fiserv handles are e-commerce, stores like Macy's. They're basically a payment processor. When you go to pay, they own Clover, which you might see at restaurants, or you go to Macy's and you go to swipe your credit card on those terminals. A lot of these are backed by the plumbing of Fiserv. And to see their adjusted EPS miss by over 20%, which is an insanely disastrous miss, along with not just their forward, like their current adjusted EPS fell, but their forward guidance on EPS was down 17%. They missed estimates across the board by like 7 to 9%. It was like every part of the business, forecast, existing business, different components of the business. This was a broad-based disaster at Fiserv. And it's taking down consumer stocks. Look at this. Dave & Buster's is basically at the lowest lows we've seen since Liberation. Looks like it continues to trickle down. Six Flags is now losing its momentum. Red Robin's going down. It's actually a miracle that Macy's is positive. Cheesecake Factory down 5%. And Cheesecake's been doing decently. But this is a sign that people are nervous, like, oh my gosh, well, if payment volumes or transactions are getting tanked or a payment processor is losing as much money, what's actually going on with the consumer? Any kind of concerns around that would be, would create some heart palpitations for the Powell meeting today. So watch for that. And this declining breadth is a little bit of a sign that, yeah, our market is really concentrated, and rightfully so. Like, NVIDIA's pricing power is so large. Like, I mean, I have over 7 figures in NVIDIA, so I absolutely love this. Like, don't get me wrong, I love seeing green in my portfolio, but I also have to I have to be an analyst, and I have to look at this and go, this will not last. Like, these growth rates for NVIDIA with how much money they will make, they will hit a peak, and when the decline comes, it's gonna suck. That said, I love how much money NVIDIA is making right now, and I understand why. The margins are insane. I don't think you can find me another company that has better margins than NVIDIA, because they don't even make the chips, dude. They just design the chips. And when people realize that, they go, what? They're just the middleman? I'm not trying to water down how critical NVIDIA is. The CUDA mode is incredible. What they're doing with automotive technology is incredible. It is a real risk to Tesla. And people don't recognize this. The cult gets so mad at me. And yeah, I'm responsible for helping build the cult. But at least I have the balls to tell you when the facts and circumstances are changing. But the cult gets really mad at me when I say that NVIDIA's fusion technology, built on a Blackwell infrastructure for inference inside of actual vehicles, SoC, system on chips, inside of actual vehicles that can fusion radar data, vision data, LiDAR data, all of it with very low latency for real-time applications. It's a game changer. It's a game changer. People don't see it. But anyway, so this is sort of our pre-Powell prep. Now, does it matter if we get QT today? Not really, because even if we don't get QT today, what we'll end up getting is a setup for a time frame for QT. So even if we get 25 BP and hey, we're gonna end QT in a month or two or whatever, that's not that big of a deal. But what I care more about is obviously the commentary, so we'll be covering Powell very closely. Yes, we know it's coupon code expiration day. But what I also wanna know is, well, actually, I guess I know the answer now, because I ran a poll, and I want to just memorialize this. I ran a poll, and I asked you, who's your boy, April Kevin or October Kevin? And the poll results are in. So thank you for voting in the poll. But the poll results are in. Somebody says you mean QE. No, ending QT is not QE, right? Like you're turning off the vacuum cleaner. So QE, quantitative easing, is running the printer. Yes, we know the Fed doesn't actually print money, but practically that's what they're doing. Quantitative tightening is vacuuming up that money. And pausing QT is turning off the vacuum cleaner and the printer. Like the printer and the vacuum are off. But anyway, I'm going to end this poll here. The poll says that 68% of you say that your boy, nearly like 1,000 votes in a couple minutes here. Thank you for voting. But nearly out of nearly 1,000 of you, 68%. I'm only disappointed it's not 69. Say that Jose Bond is your boy. So we went from James Bond to Jose Bond. So I appreciate y'all. And to that I say, thank you, mi amigos. Meet Kevin will always be here to give you perspective, whether you like it or not. I'm going to give you my perspective because I ain't never going to bend the knee. All right, cool. So what else do we have here? All right. So let's see. So that's going to be Powie Wowies. And obviously, we're expecting the Powie Wowie today. That'll be at 11 and 11:30. We'll be covering that in detail. I'm pretty excited about that. We've also got, let's go take a look at stonks here. I don't know if I already mentioned it, but I want to close this tab. So we'll close this tab. I want to close this tab. Again, shout out to those of you investing in Reinvest. We are having the largest fundraising month that we've had, I believe, all year long. And I think it's because people see our artificial intelligence roadmap. I don't know this, but I think they see our roadmap of what we want to do with our beta and the various different AIs that we're coming out with. Like renovation AI, I think is going to be clutch. But basically where you could sort real estate based on how much it could change your net worth. And then we guide you how to do the renovation too with, like only spend this much in the kitchen because it'll affect your net worth by this, and if you overspend, you'll have a negative net worth, or like this deal is a bad deal for your net worth. Like those are, oh, hello children. I think people are getting really excited about this. And I think that's just a sample of the excitement that I have. Like I get giddy on a daily basis because I study artificial intelligence on a daily basis because I'm working in artificial intelligence on a daily basis, not just training our model, but then studying. Because when I study AI, it also helps me put the mindset hat on of, oh, okay, this is how we might have to change our weightings. This is how we might have to change our ratings. It's not, here's where we stand on quantity versus quality of data, right? It's all of these things. But the more you understand about AI, the more you understand how important weightings are that go into our data. And so then it gets me brainstorming over, okay, like here's how I feel about my weightings around kitchens or bathrooms or whatever. And the individual components within them with what our vision-based AI sees. And I don't know, boys and girls, I'm just really excited. Personally, I feel like I'm becoming a little biased to the point of I don't want there to be a recession. Not that I don't think we'll be fine, because we don't have any bank debt, we'll be fine. But the only bummer will be, I think it'll slow down like how much we could boom in AI. So I still think we'll boom. But I just think if we continue this sort of soft landing like NVIDIA Moonship, man, can we IPO sooner? No guarantees, obviously don't let my enthusiasm sell you on this, read the offering circular. This video is not a solicitation, right? Like all that kind of stuff. But I don't know, I thought I'd share that. I just get really excited about it all. All right, let's close that out. And so not a surprise, we're getting that sort of continued, it doesn't actually smell that good today. The New York Times smells a little too lefty. Oh, this one smells better. Oh, yeah. The Wall Street Journal, which leans right, much better smell today. The lefty paper, the New York Times, no. No, it's not that good today. So in case you were wondering about the sniff test, um, the Wall Street Journal wins the sniff test today. All right, somebody's asking for a deep dive into Rocket before earnings. You know, mortgage volumes have been moving up. It's the problem that you face is, you know, you're gonna it's these mortgage plays are so dependent on people's impression of where the economy is going to go, and you know, the risk of inflation from tariffs, and the you know, how bullish Powell is. Like, who gives a flying F about earnings today or whatever for Rocket, when if Powell comes out and says, hey, we're so you know, optimistic about the economy, and real GDP is skyrocketing, and, you know, the break-even unemployment rate is actually really low, so we're actually really bullish on employment, then yields go up on the 10-year, which affects mortgage rates, which then the market prices in, okay, that means down mortgage plays, right? I don't know that it really matters what the earnings are. So the mortgage plays to me are something you can't really time in the short term. The only way to play the mortgage companies is by having the balls to say that in 8 years, rates will probably be a lot lower, and between now and then, there'll be a refinance boom, and that'll be a great long-term play that maybe you can get into at lower valuations now. Obviously, none of this is personalized financial advice, but that's my point of view. So, like, am I gonna sit there and go, oh, you know, I'm gonna make bets on mortgage company earnings? I don't play earnings. I think I say that all the time. I don't play earnings, because earnings, dude, like, you could smash on earnings and the stock tanks, because you get so much trader momentum sometimes that goes into stocks that you get sort of like the buy the rumor, sell the news buildup, right? It's remarkable. So, you know, earnings are playing roulette. Like, technical analysis, that's smart. Fundamental analysis for longer term, you know, fundamentals don't do you too much in the very short term, but in the long term, they almost always win. Like, I remember in the course member live, dude, I said $6 to $8 is the peak on Beyond Meat. Be careful on this puppy. And dude, it capped at $7.60 in tanks. Why? I mean, I see people on Reddit talking about Beyond Meat, about how they put their life savings in the Beyond Meat, and I'm like, you are a retard. Like, I hate to say it, but when you look at the fundamentals of Beyond Meat, they absolutely suck ass. They're out of money, they're high in debt, their revenues are declining. There's no desire for plant-based meats right now. If anything, there's more of a desire for real meat, like Meat Kevin. The fad is over. It was like the soy boy fad of the 2000s or the late 90s. You know, fundamentals win. Put your life savings fundamentally on a meme, man. Jeez, dude. Holy smokes, dude. Ay, ay, ay. So, somebody writes, Tesla bad earnings talk. Tesla doesn't move on earnings. Tesla moves on hope. And right now, people have enthusiasm that Elon Musk somehow is going to want, like, I think basically, all right, hold on. Let me do this, okay? I'm gonna, this could be slightly inappropriate, but I think it's the best way to explain this. All right. So, yeah. Okay, sorry for what I'm about to do. I apologize. Please don't cancel me on YouTube. Okay? I apologize in advance. Okay. And I'm almost done. Hold on. I'm almost done. If I could just paste this in, it'll work. Oh, I did it. Okay, hold on. Okay. Now, if I just resize this, I apologize in advance. It is going to be inappropriate. I'm probably going to get canceled for this. But this is why Tesla's going up. This is a very, very detailed, fundamental analysis of why this is happening. Like I said, I apologize in advance. Okay, it's ready. It's ready. I apologize. I apologize. I apologize. I apologize. I apologize. I'm gonna walk away while I do this. I'm just gonna walk away for a second, okay? I'm gonna go close my door and walk away for. I did it. I'm sorry. That's all it is. That's all it is. That's why Tesla stock is going up. People think Elon wants those titties. That's it. He wants the $1 trillion titties. And that's the extent of fundamental analysis as to why Tesla stock is going up right now. That's it. So, $1 trillion tatas. That's it. All right. So where were we? Okay, good. So let's see here. All right. Let's see here. Go to here. So let's go see what else is going on here. Let's go try the doomers.
Skill sets of programmers to develop. I think that's what's so impressive about the NVIDIA software portfolio, and the fact that you can use it for many optimized functions. I think that's what's very
shut up. It's gonna peak out.
I think we've got to get after the money and the organizations that are responsible for it. But universally condemn political violence. We should do that. We should support free speech. But let's be clear. This isn't a both sides thing right now. This is happening on the left. Look at what happened with Tesla. Look at what happened with Charlie Kirk. Look at what happened with President Trump. Look at what happened when the Catholic school kids were being shot at church. So it's crazy. It's got to stop.
Yeah, I mean, from our scroll, majority.
Okay. Come on.
It's an issue to contain it.
There we go.
Goldinvestments.com.
What the hell?
Before the market forecast, get your weather forecast.
Oh my gosh. Before the market forecast, get your weather forecast. Nobody cares. The hell? All right. Whatever. All right. So obviously it's Powie Wowie Day. We got a lot of work to do. We got to figure out why Fiserv is dumping. Maybe the consumer's dying. Consumption so far has held up though, because Visa isn't telling us that consumption is this bad. Okay, let's go pop this up. Okay, so the next thing that we probably ought to talk about is this absolute ridiculous insanity of this Neo robot. So we're going to talk about this because it is like the greatest fundraise that I think I've ever seen on social media. It is such a jump the shark moment. Okay, we're gonna call this, let's just go last minute Fed warning. All right, let's go beam that up, Scotty, and then we're gonna talk about this stupid robot. It's not even a robot. Okay, just call it like a I don't even know what to call it. All right, let's get our sombrero. Okay, there we go. Okay, somebody in the chat is asking me if Caleb Hammer consumers are basically a tool to evaluate the current state of the consumer. You have to realize they purposefully choose the most insane people. I think people go on there to literally be ludicrous to get on the show and say the most ridiculous and retarded financial things ever. I have tried to watch those videos. I can't do it. It's like watching disaster porn or something. It's like schadenfreude of retardation. I can't do it. It's like, yeah, I've got nothing bad to say against the guy, just like I've got nothing bad to say against Asmongold. But so I open up some of the videos and I'm like, my brain cannot process the level of stupid that I'm watching right now, and I'm just going to turn it off. That's it. I can't help it. Everybody's really into my shorts today. Yeah, I've got these like Hawaiian shorts on today. They're actually really cool. We got like the Hawaiian flowers. They're really nice running marathon shorts. I love them a lot. Okay. All right. Let's go look at this robot. But yeah, to be clear, do I actually think the vast majority of consumers are that dumb? I mean, they might be, like, there might be a lot of dumb people, but not that dumb. Like, that's like taking a pile of dumb and then picking the dumbest. No, I actually think most people, you know, watching financial content on YouTube are generally pretty intelligent and frugal. I think with financial people or people who look at like financial stuff, you're a more skeptical bunch, but that's a good thing. You know, that's a way to protect yourself, and it makes you more critical and discerning, and that's a fantastic thing. But anyway, okay, so let's get into this Neo bullcrap. Okay, so Wall Street Journal. Okay. Well, there is a robot that you can now pre-order today. Actually, I want to say that differently because let me pull this up because this is what drives me nuts, is people are implying that you could buy it today. Neo robot order today. All right, here we go. Well, folks, there's a company that came out of nowhere that says you can buy and order yourself a robot today. Neo, the home robot, order today. I hate to say it, though, this is supposed to be the most exciting thing ever. That finally we have a robot that can do stuff for us, and we could order it today. Except it's probably the greatest financial fraud I've ever seen. I hate to say it. And it's fully transparent and fully disclosed. So is it then really a fraud? But I think this is essentially Nikola 2.0. I hate to say it. But first of all, this product isn't available for order today. It's available for pre-order, which is a great opportunity for a company to fundraise. It's an opportunity for a company to say, look, we've got this fantastic product. It's coming out sometime in 2026, and we're just going to collect all these deposits, and maybe eventually you'll get the product. But the reason I say the product is a complete joke is because this is not actually a robot that uses any kind of artificial intelligence. It is a teleoperated robot. It is literally like the scam of Amazon telling us we can walk into a store, buzz in or scan in with our Amazon Prime account, and anything we pick up off of a shelf anywhere in the store will automatically be billed to our account. Meanwhile, there are 1,000 Indians surveilling the store with dozens of different cameras, observing what you're putting in your cart and then manually billing you for it. It's a straight up scam. Amazon got exposed for it, and this company is being blatant about it. This is not a robot that can autonomously do anything. In fact, it sucks at most of what it's doing right now. This is a robot that is teleoperated by literally somebody who's supposed to teleoperate the robot remotely inside of your home. But don't worry, they'll value your privacy by blurring what the people look like. This is insane. Joanna Stern over at the Wall Street Journal, I think, did a fantastic breakdown of it. So we're going to respond to this. I want to caution you, though, there are a lot of influencers who are pumping this. And they may not look like influencers who are pumping it, but what happens is this company invited a lot of, especially on X influencers, to this company launch. And so you got people writing comments like this: for $700, you could buy a humanoid today, and you could early access buy it for $20,000, $200 deposit due today, and then you'll pay $500 a month for somebody to teleoperate the device for you, which could really only be done at foreign wages. Wonder what the latency is going to be like. But you have to be cautious because there is a lot of pump going on here. Look at this. Here somebody says, there's actually a buy button for the One X Neo. Looking forward to seeing these actually in homes. Of course, it's really provocative to have a humanoid robot in your home. It is so provocative. But when you actually look at this and you watch the video that I'm about to show you, this screams scam. I'm sorry, because I know we are all optimistic about actually having a robot in our home, but this screams scam. Let's watch it together and you'll see why. It would help if I actually turned the volume on and not on mute. So I apologize about that.
For $20,000, you can pre-order One X's Neo robot now with delivery in 2026.
Think you missed a tiny spot over here?
Just
all teleoperated, by the way. All of it. The head movements, the hand movements, everything teleoperated. There is no intelligence in this. This is a wrapper. This is an idea of a robot.
one little catch. There may be a human behind the curtain, pulling the robot's strings.
If I throw up, will the robot throw up?
A company representative may need to peer into your house via Neo's camera eyes to get things done.
To many people, this is crazy.
You have to be okay with this for the product to be useful.
But is Neo a useful product?
We're twinning now, Neo.
Home robots have had two big challenges: creating a safe and capable body and a smart brain. One X is taking on both of those, which is why Neo looks so different from a more industrial factory robot.
Neo, it's 70 degrees here in California. Why are you wearing a sweater?
Good question.
Okay, this whole sweater thing, you could watch this yourself. They're just trying to say like, oh, we're trying to make it look approachable and soft and happy. It weighs 66 pounds and, you know, we don't want it to hurt you, blah, 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 blah. But it's all teleoperated and remote operated. Mind you, they're literally using the Quest 3. So there's no proprietary technology here. They're using the Quest 3. They slap together actuators that you could basically find on the internet, in my opinion. I don't think there's any proprietary technology there. They wrapped it in literally like a woven cloth. And that's probably the extent of their proprietary design. I hate to say it, because you could buy most of these actuators off the shelf. And what this is a fundraising play. It's, well, we're doing pre-orders now. They're nowhere near ready. But it's a great way to get people to go, oh my gosh, they're so ahead of the game, let's throw money at them. It's full retardation.
150 pounds. It's not as superhuman as you'd think.
Crush it. It's a walnut.
There's this concept that we think that robots are like superhuman in like pressure and like strength. And some robots are because they're heavily geared, but that means you're not sensitive, right? And delicate. Neo doesn't work like this at all. It works more like us. So the finger strength of Neo is about the same as a human.
That body lets Neo try to do a lot of things humans do. Emphasis on try.
Can I get a water?
If only the real world didn't have doors.
Somebody in the chat says, what do you mean actuator? It's tendon driven. Okay, tell me all you did was watch their marketing video without telling me all you did was watch their marketing video. A tendon-driven actuator is a type of actuator. You could buy it off the shelf. It's not that big of a deal. If you really want to invest in robotics, you probably should look at the companies that are selling actuators, because you'll probably make a whole lot more money selling pickaxes than you will scams. Look at it. They can't even open the
it took
freaking
Neo a
refrigerator
little
door
over a minute
smoothly.
to fetch a water from the fridge 10 feet away.
Thank you, Neo.
Next challenge. Load 3 items in the dishwasher.
You got this, Neo. You got it.
Yeah, get that 4. Oh, yeah. Oh, yeah. Rotate. Oh, drop it in there. Just chuck it in there. All right, eat them, boys. Yeah, eat those cups in there. Ah, what was that? Oh, yeah. Almost got both of them not to fall over. All right, here comes the squat, boys. How low can you go? How low can you go? I gotta go lower. The hand can't reach. Oh, I couldn't get the grip. Oh, squat back down, baby. Oh yeah. Oh, you couldn't get the momentum.
That took 5 minutes.
I'll just
The
leave
Neo
it
I
open.
saw isn't the one shipping
5 minutes to put 1 fork and 2 cups in the dishwasher. This is full retardation.
in 2026. The new model will be safer and have better hand dexterity. The one I saw still needed to take breaks to charge and cool down.
There's literally a guy on TikTok standing there with a portable fan blowing the robot because they can't even get the crap to function long enough for a Wall Street Journal demo. It had to squat so much, it needed a TikTok dude to cool its neck because it sucks that much.
Down. The challenge isn't just Neo's body, it's also its brain. The body has to perform tasks.
The Chinese are laughing at us right now. The Chinese are like, this is what we're competing with in America, boys and girls.
Safely, but the brain needs to know how to do them on its own without.
It doesn't. It has no brain. And honestly, even Tesla putting Grok into Optimus doesn't make it smart or impressive. I could press the voice-activated feature on GPT-2 and have the same damn thing.
Even help. But right now, everything I saw Neo do was guided by a skilled pilot.
Teleporate.
Skilled pilot. He ain't a licensed pilot. He's a kid wearing an Oculus 3. This is bullshit.
Is essentially when there is a human in the loop.
And who is the voice I'm hearing right now of Neo?
I am a remote operator in a different region.
And what's your name?
Turing.
What's your real name?
My real name is Turing.
Like that's your name on your birth certificate?
Yeah. Okay, whatever. Who cares? Controllers.
I actually might throw up. I think my hand is... I have no idea.
Goes the bottle. Don't mind showing the glass breaking. Yeah, we're fine.
And Neo had to go to urgent care.
See,
Oh, look at this.
I have no idea where I'm facing. This is me doing the Macarena.
Yeah. Ooh. Oh, she broke it. Ah! Wait, I missed that the first time. She goes to twist it, and it gets it all twisted up in a bundle and breaks
I have no
it.
idea where I'm facing. This is me doing the Macarena.
Yeah. Ooh. Yeah, we're fine.
And Neo had to go to urgent care.
See you, Neo.
Why does Neo need to be operated like this in the first place? Because its brain, aka an AI neural network, needs to learn from more real-world experience. The videos of the robot doing things via teleoperation become the training data to make the AI model smarter.
Bro, it is going to be decades of collecting data. This is ludicrous. Anyway, we're gonna get. Let's listen to this guy. I'm telling you, this is like Surfer Bro. This is Trevor Milton respawned as Surfer Bro.
Important for me to just say that in 2026, if you buy this product, it is because you're okay with that social contract.
Guys, we have a social contract that we're gonna have an Indian with cameras in a humanoid form in your home.
If we don't have your data, we can't make the product better.
This is not anything bad about Indians. The only reference to Indian is because of the Amazon Indian facility. I've got great Indian friends. I like Indian folks. I'm just saying. It's probably what it's gonna be.
I'm a big fan of what I call like big brother, big sister principle, right? Big sister helps you.
Hey guys, Big Brother's actually good. Because it's like, you can have Big Sis.
Big Brother is just there to kind of monitor you. And we are very much the big sister. Depending on how much you want to trade, we can be more useful. And you decide where on that scale you want to be.
Do you right now know what things NEO in 2026 will do autonomously versus what it will do teleoperated?
So when you get your...
So the answer, Joanna, is everything will be teleoperated because it's a scam.
NEO in 2026, it will do most of the things in your home autonomously. The
No, it won't.
quality of that...
No. Nice pitch. Don't believe it at all.
Work will vary and will improve drastically quite fast as we get data.
To be clear, on my visit, I didn't see NEO do anything autonomously.
Bingo.
The company did share this video of NEO autonomously opening the door.
It's such a lie. Hey guys. Hey guys. Here's our actual product demo. Oh, does it do anything autonomously? No, not yet. But here's a video we edited together of it doing it autonomously. Right.
You know, there's this new trending concept now called AI slop, right?
I do know.
It's a very powerful concept of, let's call it robotics slop. It's the most useful kind of slop. Because if you put all of my glasses from my dishwasher in my cabinet, I'm pretty happy. It is going to be not perfect, but...
Yes. I want to spend $20,000 and $500 on a month on a robot that's going to drop my dishes and imperfectly load a shelf, which is literally like $5 worth of labor to a child for an hour. I could have them do chores for an hour for $5 probably. Yeah, I mean, if you're going to have kids, put them to work. And you're going to spend $500 a month just because you don't want to put your cup away? Come on, man. This is absolutely ridiculous.
Back to like just incredibly useful.
NEO might not fold my shirt perfectly, but if an arm is like kind of hanging out of the shoulder, like it's okay. It's robotic slop.
To me at least, like that's very okay.
Honestly,
Yeah. Uh-huh.
it isn't bad. Thank you.
But the reality is, at least
They put the arm back in. What happened?
It's okay. It's robotic slop.
The arm's hanging out here. And then all of a sudden the arm goes back in?
To me at least, like that's very
And
okay.
cut it in.
Honestly.
Oh, it's perfect. This is such a scam.
by someone else. There will be an app where you can schedule teleoperation, specifying exactly what and when you want NEO to do things in your house.
Sort the shelves, boys.
So we want to, of course, make sure that we respect privacy as much as possible.
Oh my gosh, this is such a scam.
Teleoperator can never connect to a robot unless you approve it.
Other companies, like Figure and Tesla, are also racing to build humanoid robots and develop their own AI models to make them fully autonomous. As someone who's always dreamed of the home robot straight out of the Jetsons.
Let's go home, Ruby. Yes, ma'am.
Yeah, I mean, that's the provocative vision is amazing. Like, people are very, very excited about it. I just think right now what this is a fundraising scam.
Nice job, Neo. High five. Nice. Oh, I'm over here.
Spending the day with NEO was a bit like spending the day with a toddler learning how to do things in the world.
Come on. You got more than... Oh, I'm going to break the robot.
The next few years isn't about owning a super useful robot. It's about raising one. Letting it learn from your home, routines, and chores. All at the expense of the privacy of your inner sanctum. Even if you think this is all crazy, what NEO really signals is the beginning of physical AI in our lives and homes.
There's no AI. She literally said it herself. It's not AI. It's a remote-controlled robot. This kind of stuff just pisses me off because they're selling a lie. They're selling you something because you want to believe that we can have this. I want it too. We want to believe in it, but it's a damn lie. They should be sued. Okay, I don't wish anybody gets sued, but I just think it's a scam. Is that clear enough? Somebody says, is this all just feel-good hype to get people to invest in things only for companies to burn investors' money on hope? 100%. I don't actually think there's real productivity here. Like, if you can have an AI that actually makes people money, by all means, man, throw as much freaking money as you can into that project, right? But this is like, it's a disaster of a product that's teleoperated, and they're selling you a lie that's going to be autonomous next year when it literally does nothing autonomous now, based on what we saw in the Wall Street Journal video. And instead, what they do is they get influencers on Twitter, X, to go promote this crap. And that way anybody doom scrolling on X is like, oh my gosh, look at this. Like, look at this. I can't shake the feeling that I saw the future last night at 1X Tech. Took me back to the first time I used GPT-3 back in 2020, or that time I tried an iPhone for the first time ever. I can't believe how cheap it is too. Only $499 a month? I pre-ordered mine to have it deal cards at my poker night or walk around Palo Alto with me. Oh, nobody likes shuffling the cards. You're a tech bro in Palo Alto? You must know. Bro, this is like an undisclosed ad. I almost guarantee this guy got paid to go out there. I don't know, but I bet he got paid to go out there, got paid to go to the event, got paid to make a post. This is a scam. It's an undisclosed ad. That's all it is. Or he's somehow involved in this. It sounds ludicrous to me. That's it. So where were we? I think we were just about to go to Bloomberg.
Annual revenue growing near 40%. Right. These are unprecedented rates, but with some of the deals that we've seen announced away from Microsoft starting to show up, there have been questions around just the size and scale of the aspirations of OpenAI and how much of that accrues to Microsoft versus the broader cloud hyperscaler ecosystem. So, we think so this is it.
Man, could this guy be any more dry? Bro.
GCP has a 1 million TPU deal with Anthropic. Microsoft has started having a relationship with Anthropic. AWS and Bedrock is kind of thinking, well, what else can we offer? Grok is now available on Azure, I think. Basically, the landscape's changed. Does the hierarchy change now? AWS, Azure, GCP?
I mean, we think Microsoft still has the lead in terms of market perception. That relationship with OpenAI has been very advantageous. So we think Microsoft share gains have been primary a function of two reasons. Number one, just the later...
I can't handle this. I would rather listen to anything than this monotonous talk about Microsoft. I'd rather just watch the Bloomberg TV on mute. I can't handle it today. I can't handle it! This is how I break things on my desk. My aura ring says I'm stressed. All right. Where were we? So, Fiserv's still down 40%. Nvidia's still up 3.8%. The Qs are bleeding before Powell. They do every damn time. They always bleed before Powell. Old news. Gosh. All right. CoreWeave. Oh, is it actually going to try? It always tries 137. It can never get above 140. Can never do it. Oh, yeah. Etsy got smashed this morning. Although they've been on an uptrend recently. Oh, Symbotic. A real robotic play. Talk to me. Talk to me about Symbotic. Yeah. More real robotics play, please. Oh, yeah. Don't ya know real robotics? All right. So, UN says movement detected near Iranian stockpile. What? That does not sound good. Let me see here. UN, Iranian stockpile. What's going on here? Aha. Okay, and then also I want to see. Let me see if there's any Symbotic news. Okay. So Symbotic. No Symbotic news. It's been so quiet. It's great. When does Symbotic report earnings? Somebody says, did Kevin cover Enphase? I did actually in the course member live stream. We did a deep dive fundamental on it. There is a massive landmine in the earnings call that you really need to understand if you know anything about Enphase. Just remember, you can see my whole breakdown.
Coupon linked below.
You get lifetime access to all that fundamental analysis. But there's a landmine in that earnings call. Worse than I could have expected. Okay, so let me see. Symbotic earnings. So Symbotic earnings are set for November 17th. Aha. Okay. All right, so we got some time on Symbotic. Okay, cool. Let's go see this here. UN nuclear chief tells the Associated Press that Iran isn't actively enriching uranium, but movement detected near the stockpile. Oh, I see, okay. The head of the UN watchdog told the AP Wednesday that Iran does not appear to be actively enriching uranium. That's good. But they've detected renewed movement at the country's nuclear sites. Right. Rafael Grossi. What we know about snapback sanction, okay. Dubai, this was in September. United Nations sanctions were reimposed on Sunday, putting Tehran under new pressures. Right. And then Grossi, despite being unable to access the nuclear sites, inspectors have not seen any activity via satellite to indicate that they've accelerated their production of uranium beyond what they've compiled before the war. However, nuclear material enriched at 60% is still in Iran and is one of the points we're discussing because we need to go back there and confirm the material is there and is not being diverted to another use. Right. Inspectors have seen movement around sites where stockpiles are stored. Without additional access, the IAEA had to rely on satellite imagery. Right, well, that can only tell us so much. Iran suspended all cooperation with the IAEA. Sanctions got reimposed. Right, no comments. Iran got MAGA humbled. Must be at least 25 characters. There we go. All right. Now, let's press the news button. All right. So, let's see what else we have here. The Wall Street Journal. NVIDIA becomes first $5 trillion company. Yeah. Tens of thousands of white-collar jobs are vanishing as AI starts to bite. Yeah. That's definitely a longer-term red flag. That I, too, am nervous about. Where can we see EPS projections? Do you have a link? I think the best way to do earnings projections or EPS projections, honestly, is the Investing Pro product. You could use, I have an affiliate link for them. Actually, just use coupon code MEETKEVIN if you ever go check out. But if you go to the, it's the investing.com pro side. Obviously, they're a sponsor of the channel. But like, let's do like Symbotic, for example. So you put in Symbotic, and then I could get the earnings projections right here. It's actually really incredible because now I could see that if I do the end of 2026, I got 42 cents of earnings here. 42 cents divided by, you know, whatever we're trading for now. Let's go find out. Symbotic should be like $70, right? Yeah, $72. So $72. This is a forward, you know, it's going to be like 140 PE divided by 40, 170, right? And then the forecast growth, I have these percentages right here over the next 5 years. 68.6 plus 102.8 plus 39.2 plus 20.1 plus 7.9 equals, divided by 5 equals 47 growth. 171 divided by 47. It's trading for a 3.6 peg right now, just as an example. So anyway, if you have to get the Pro Plus plan to see this. You can use coupon code MEETKEVIN on the website. But I really enjoy what they do here, especially since I could just like click the little PDF button and then it gives me a, let's see here, Symbotic Investing Pro sheet. I always like labeling my stuff before I pull it up. But let's go look at it. Let's go see how good it is. So I'll drop that into all work. Open this puppy up in the PDF expert. Here we go. So, Symbotic, a leader in retail supply chain automation, leveraging AI and robotics to optimize warehouse operations, primarily for large retailers like Walmart. Yep. Company has shown remarkable performance. This is just past stock performance. That's fine. Symbotic has made significant operational improvements, increasing deployment efficiency by 30%, raising its gross margin to 21.8%. See, they're actually selling robots at a decent margin here. And these are real robots. Accelerating sustainability, scalability. Like, I think, Amazon could be a customer for Symbotic, and the company just skyrockets. Company faces challenges, including anticipated near-term revenue deceleration, heavy reliance on Walmart. This is true. Walmart concentration is a significant risk. 88% of their revenue comes from Walmart. I mean, Walmart ain't going anywhere anytime soon. But, if Walmart slows down on, like, the Walmart Mexico expansion, right? That's a risk. I think it's Walmex expansion is a risk. I think they call it Walmex. UBS cites high valuation. Look, we got bullish on this company in the course member live stream at like $18. Kevin, 18 to like $20. Kevin went bullish with course members. That was like a year ago at this point. So do I think there's probably a better entry for it? I do. But I mean, this is kind of cool, Here, heavy reliance on Walmart. I love this. I love the bull bear side. So recent earnings miss of the loss of 5 cents raises concerns about consistent profitability. Well, because it's so lumpy, right? Their revenues are lumpy because you're selling, machine contracts. Company anticipates near-term revenue deceleration as it moves to its next-gen products, right? More lumpiness. Software is very high margin. Robot management software. That's pretty important if you're going to buy these, but you gotta sell the actual product first. Extreme customer concentration, that's fair. I actually think they have a decent moat. I'd actually argue decent moat. They just need to get more customers. But, I clicked a button and I got all this stuff, dude. It's actually pretty nice. And they put some sentiment articles in here. Neutral sentiment, whatever, negative sentiment ones. Next generation structure is value-based. On the space savings it provides for customers. Symbotic is expecting to achieve higher margins. Inbound discussions with new customers are accelerating as a result of marketing the new structure over the past 3 to 6 months. Right. So, but now we actually have to see those things turn to contracts, right? So I think this is kind of cool. I'm a big fan of this product. I actually think they do a good job. So, like, yeah, I like, obviously it's an affiliate if you use the coupon MEETKEVIN. But I think it's a product that I really like. So, okay, cool. So, I mean, it looks like the kind of typical pre-Powell relaxation here. Even Nvidia is relaxing. All right. What else? AT&T ad. That's some bull crap. Pissing me off. I'm angry today. Because of that robot scam. Oh no. Oh no. What's he shilling? Oh no.
Tried to, insulate and enhance the second.
It hasn't done that well.
as a public company?
Well, we're the sponsor. Our goal is to get them. It was probably one of the most successful SPAC transactions of all time.
Well, right. But that speaks to the whole sort of misalignment of incentives, with SPAC sponsors and investors that buy the company.
We haven't sold any shares or made any money on the deal. So we're locked up. So that is a misnomer when it comes to the way we've structured our deal. So we have not done anything. In fact, we returned over 70% to our IPO investors.
Dude,
so from
Sarah is putting them on blast for scamming with their SPAC.
But why do you think the stock hasn't? I mean, where is
I'm
it
not part of the
five?
company, right? So what I can do is the following: enhance the name recognition of the company,
I
take
love
it public
Sarah.
on the New York Stock Exchange, and provide it with $170 million in cash. We did all three of those things, which is why whenever we do another SPAC, we're oversubscribed. So,
You're a
and
suit.
also I would say it's all relative. We did that when the SPAC product on the last two has been highly challenged, and yet we were still able to perform this way. So we had 0 redemptions with the grab and one.
Of course, because your insiders make money, but you scam retail who buys it when it goes freaking public. That's how a SPAC works. The insiders make bank. The suits and the friends of the Trump crime family. I shouldn't say that. I'm going to get so many unsubs. Anyway, the Trump family, they make money. Everybody else gets effed, and Sarah's looking out.
Will also be oversubscribed. So again, you don't have to take my word for it. The investors are speaking, right? It's a free market, and they continue to support our SPAC sponsor team. Now, you asked what we're going to do. We don't have a target in mind because we just filed, and we're going to go out and look, but it's going to be consistent with this, which is the reindustrialization of America. And we're going to try to continue to do those things that are going to help the prosperity and security of the United States.
What's been the? I mean, I imagine he's had the company for a while. You joined as a partner, I think, officially last year, about a year ago. So what's been response? I mean, it feels like you're up to $1 billion in assets now.
Listen, I think the response has been great. People have been looking for this for a long time. They also understand that we've been in this for a long time. We've been doing it right. I think a lot of people are concerned about sort of the political winds. People adapt something. I can make a couple bucks today, but the political winds change. Something happens. It's going to be different, and all of a sudden they bail out. We've been very consistent in our messaging. We were doing this when it wasn't popular. We were doing it when it was borderline dangerous. And they understand that we're in there for the long haul and we believe in these principles. So I think that consistency in messaging is fundamental, and people get it. And it's great seeing other people trying to do the same thing now. Yeah. We were just the guys doing it when it wasn't popular.
Imitation, highest form of flattery.
Sorry, Sarah Eisen wrapping up a couple of days from...
Damn, Sarah, I freaking love her putting them on blast. Absolutely love her for that. Yes, freaking please. More Sarah Eisen calling out the scam. So what is this? Grab a Gun Digital Holdings SPAC. What happens with these plays is they meme up and they sell you some crazy pitch deck. This is why I don't do pitch decks. I think most of the time these are a scam. The Second Amendment is in our blood. We believe that it's the American duty to help everyone. We discovered a gap. We no longer shop the way we used to, and retail firearms market needs to change. We sell them, you shoot them. Support defenders. Brought to you now by Eric, Trump, and Don Jr. and Donnie T. The Trumpies will help you. And all you have to do now, because obviously we're going to be featured on, look at this, Tucker Carlson. He's triggered too. And so pump our pew, pew, pew. And then what happens is these companies with, negative net changes in cash, mind you, they burn money like crazy. Because, before their SPACs, that's all they do. They just pay their suits and their insiders. And then when they combine with companies, they usually combine with companies that lose money hand over fist. We'll give you a real example in just a moment. But these SPACs sit at $10. The insiders make a bag. And as soon as they meme pump it and all the circuit of the Trumpies going on all the TV shows ends, the insiders dump. They're the ones who get rich. And all the Americans who fell for it get left holding the bag. Just like alt. Remember when I made a video on this when it was $8? When Eric Trump goes on Fox News going, this is a great way to diversify to American crypto. I don't know why he sounds like his dad all of a sudden. But anyway, that's when you know it's the top. And I'm like, this sucker has a support line at $0 and it's going straight down. I said this when it was $8. Look at it now. $2.44. It is making its way to zero. Why? because Old Sigma is nothing more than exit liquidity for Donald Trump's World Liberty Financial Token. Oh, by the way, guess who happened to be partnering with the Saudis on $1 billion investment into the stablecoin for the World Liberty stablecoin? Oh, CZ. Oh, and guess who was just pardoned by Donald Trump? Oh, CZ gets pardoned. So the guy who literally pled guilty because he is documented as saying, oh, well, you know, we'll just ignore the North Korean and Iranian money laundering that's going on the Binance network. We'll just ignore that because we don't have any anti-money laundering procedures. We'll just ask for forgiveness later. Pleads guilty to being an anti-money laundering fraud, serves 3 to 4 months in jail, only to get pardoned by Donald Trump because now he's going to coordinate with the Saudis and prop up Donald Trump's World Liberty Financial Token, which is getting liquidity through Alt5, which is getting promoted to Americans who watch Fox News and don't understand fundamental analysis. Instead, they listen to people like Don Jr. and yeah, this is a great opportunity to make long-term money. And it goes straight down. This is how to pilfer from American voters. And as a financial analyst, it disgusts me. And thank you, Sarah Eisen, for putting these bastards on blast. Because when you're stealing money from Americans, you're an asshole.
OpenAI, rather, is committing $250 billion in Azure spend over the next several years. The difference, though, between that deal we heard about yesterday, this is actually contracted, meaning they are good for that money. It's not a nebulous deal like we've seen OpenAI make with Oracle and so many other companies in recent weeks. And also, you can put away some worries about AI CapEx continuing. I was in Wisconsin last month looking at one of their new data centers from Microsoft being built right next to one that's nearly complete already. So before the first one even becomes online, they're already building the second one that's more expensive. Now, Microsoft also told us a few weeks ago they...
Oh, man, this guy's so boring. I'd rather watch this lady on mute. All right. What else is going on out there, boys and girls? All right. So, NVIDIA, a little bit of a bouncy-downsy right now. All right. Let's go into... What other news do we have here? Thank you, Sarah. All right. So... Fiserv, I really want to see if there's any more color on why. Financial surprises emerged at the start of Q3, prompted a planning process, more rigorous review of our financials. Some of that was driven by stuff we're hearing from clients. See, that's bad. I don't know how to like pinpoint what they're hearing because they don't say in their earnings call. Actually, let me see. I have their earnings call right here. If I type in, maybe we could try clients because they're referencing clients. Fiserv, oh, that's their annual report, earnings call. Here we go. If I put in client, exceptional client service, client aspirations, client service gaps, client understanding meetings, forecasting, thousands of client employees. I worked with the management team. Oh, here we go. And several external advisors. Oh, here we go. To conduct a rigorous analysis of the company's operations, including thousands of client and employee meetings. And then they talk about, it's just a lot of talk about Argentina, which is really where they bag on this. They basically try to blame Argentina for this. We know the issues and we're already addressing them. our clients have an insatiable appetite for innovation. Yeah, but Fiserv isn't really known for being innovative. That might be one of the problems. We're hearing from clients. Here we go. So macro stuff. So this is what they're hearing. They're hearing macro stuff. Either stuff that is out of our control, macro stuff, or industry stuff. Ah, okay. All right, there we go, boys and girls. Okay, that's here you go. Fiserv CEO on why they just lost 30 billion, 40% drop in a single day. They say, our analysis uncovered stuff that was either out of our control, macro stuff, industry stuff. Their words. Yeah. That's tweetable for me. Fiserv CEO on why they just lost 30 billion, 40% drop in a single day. Their words. Our analysis uncovered stuff that was either out of our control, macro stuff, or industry stuff. That's good. That's good. That's very, very specific. But there were a series of initiatives that were client, customers, businesses always have these more short-term. Okay. Okay. Again, we've gone through a series of. I'm confident today the numbers represent who we are structurally as a company, and we could grow from here. So, basically, kitchen sinking. Like, hey, everything we told you before was bullcrap, and now we're just going to kitchen sink. That's pretty impressive. Okay. All right. That's some bullcrap, man. It's all bull, man. It's all bull. Ugh. Fiserv, which I'm gonna need alcohol. It's 9 a.m., man. Too stressed for this. Analysts express surprise about how quickly the business appears to have soured. Well, yeah. To be frank, we are struggling to recall a miss and guide down this degree. Yeah. Well, the CEO can't even explain it right. At the heart of the declines is the Financial Solutions Division. Oh, great. Which provides underlying technology for legions of banks. Right. Revenue from the division fell 3%, while margins plummeted, down 5 percentage points from a year earlier. I just think they're failing to innovate. They're a legacy company that's failing to innovate. And they can't even explain it themselves. Shocker. All right, what else here?
To these other ETFs that launched, right? Like, this isn't just you file it during the shutdown and it gets launched. I think the other thing that's really important to note, we're in a government shutdown, but that doesn't mean there's literally nobody working. There are skeleton crews at all of these agencies. So there was an opportunity if somebody were to look at these applications and say, you know what, you don't fit within these criteria of this new listing standard that we've announced for an accelerated launch. We're going to actually put the stop here, and we're going to make you kind of come back and forth and go back through a more longer comment period.
So if the SEC stepped in and contacted anyone at any point, then that would be the signal that this is not going to go ahead. That didn't happen with these 3 launches.
Evidently, yep.
Does the successful launches of the Bitwise Solana ETF and the Canaries pair of ETFs provide a path for more issuers to use?
That's such a great name. Yeah, we're the Canaries. Oh, great. By the way, shout out to those of you joining the Meet Kevin Alpha Reporter membership. We got Fernando, Mark, Chris, Jeremiah, Santiago, Travis, Abhinav, Christian, Robert, Cody, Boris, Jay, Thomas, Garrett. Welcome aboard. Thank you for joining. Dude, I don't think I saw a single girl in there, man. I'm gonna have to step this up. I need some more women in here. I need a Sarah there, like Sarah E. Man. That'd be great.
Not from the fund perspective. I think with the portfolio companies that are hoping to IPO, we saw some really successful ones already with Circle and Figure, and that was really exciting. I think those who are in the queue and were in the queue when the shutdown started, that's frustrating at this point. So it's more kind of from our portfolio and our platform perspective that we're starting to, you get a little frustration. Are we at the longest shutdown yet, or
Not
second
yet,
longest?
but
Like, we're getting there.
We're getting there.
Yeah.
I guess that raises the question.
Yeah, we need a special coupon code if you identify as a woman. True men will not use that coupon because they won't identify as a woman. So basically, only women will use it. Yeah. Here, see, somebody else is confused too. I don't know who this person is, but is anyone knowledgeable about Fiserv and willing to give me a TLDR about what's going on in the business? Frank goosed the numbers with Cliff deals. Clover losing hard to Square and Toast. Bank backbone margins in structural decline as regional banks get rolled up. Nice. That was good. Goose the numbers with Cliff deals. Past management over-optimized margins. CEO left. New CEO looked under the hood properly. Band-Aid ripped off today. Frank juiced the numbers and then left and dumped all his stock. Wow. Wow. People are dumping on the prior guy. DM'd. I want to know. Poop product. Yeah? Somebody says, I will change my gender for a good discount. Oh, man. Now, we're just going to raise the price again. Before we go into November here, we're going to do a price increase again. We've got some more content coming out, too, so we're really excited about it. All right. What's over here?
CRYP Go on the terminal. This is Bloomberg.
Nothing. Nothing.
Right. Isn't that what you all do?
Yep. Okay, can I just make one comment on cycle?
Without full information.
2000, March of 2000 was when the market crashed, right? And the S&P was down 50%, the NASDAQ was down 90% at the worst. And it was the beginning of the internet, right? It was the beginning of the internet. But it was also the end of this enormous rise, the euphoria about internet stocks that did come down crashing. So they don't have to coincide,
And
the
they
cycle
won't.
on the market.
Right. They're not supposed to coincide. But right now, I think we are at a point where actually the market is very detached from what the economy is doing. That doesn't make the market wrong. The market is always using the information it has and the optimism that we're looking at with AI.
You think the market's detached from what the economy's doing? The economy's pretty good.
Pretty good, but it's not heating up. It's cooling down.
All right, that's not what the Atlanta Fed real GDP says, woman.
The market should be front-running maybe a heating up in economic activity. But
yeah. Did you see the blue chip consensus heating up, lady? Do you look at data?
In order to bring inflation down. And now we're getting announcements that are getting slightly concerning, layoff announcements from a lot of bellwether companies, but we don't have any labor data. So right now we can still say that the economy is okay and the labor market is okay because we don't have any data that proves otherwise. But when it starts coming back out again, we don't know what that'll look like yet.
You know, it's so interesting because when you talk to companies, and whether it's CEO or CFO or just pick somebody, that's in middle management, there's a disconnect because they don't see things being as good in the economy. Yet we see numbers, we see some companies reporting, but and I've been unable to square that disconnect, and it's been going on for months and months that the economy is not that good. We hear from some people that come on the network as well. But it really doesn't matter in terms of the market. The market's looking forward, and what it sees forward.
Yeah, but the question is, how far is the market looking forward, and are we missing a potential real labor market weakening, right?
Because
because the market doesn't know, we don't have the data.
That Carl Quintanilla put this out on social from Vital Knowledge. It tells a good story about if you're tech, boom.
Yep.
If you're not tech, not so much. Cheesecake Factory, weaker sales. Caesars, EBITDA miss.
The consumer, this is also why you see the Fiserv crash.
Generac, a miss and a guidance cut. Hormel, EPS warning. Kraft Heinz, guidance cut. Masco, guidance cut. Mondelez, guidance cut. PPG, guidance cut. I can look at all of those, and there are probably more, and build a case that, you see, told you, economy's not so good.
Well, and this all translates eventually into a slow bleed for the labor market. Yesterday, I put out a memo to everybody in the Alpha report. It was actually in the afternoon. So early afternoon, I put out a memo and I said, look, here's my take on the economy. And here are what the leftover problems are. Like, can we still get euphoric increases in stocks versus, where are we going? What trajectory are on? And that's essentially, what everybody's wondering about. But I don't think the stock market is pricing in by any means. I think there's zero pricing in of a labor recession.
Based on the underlying economy, or do you buy stocks based on the AI economy?
Well, you're buying stocks based on the AI economy because that's where the earnings growth is. And I think it's reflected in the fact that we have two distinctive economies. I'm going to give you a very compelling statistic. Has anyone come on our show or the 3 o'clock show and said, Scott, I want to be short financials? No, myself included. Everyone loves financials. They're overweight financials. The earnings for financials, I think collectively we can define as being really robust.
All right. Robust financials. Yeah, until private credit rolls over.
Is that dangerous in some way?
Actually, tokenization doesn't change those rules, right? So tokenization is just upgrading
Correct.
the ledger.
Tokenization doesn't change the rules. We know a lot about that with my startup too.
If a product is only for accredited investors, it's still only for accredited investors, even if
that's right. Yep, we're trying to tokenize what we're doing with House I Can Reinvest to make it really easy to reinvest over time. So we're really, really excited about what we're doing with tokenization. But yeah, I mean, you still have to operate within the letter of the law. It doesn't change anything.
ownership, etc. So.
Does tokenization matter as much to retail investors as it does to institutional investors?
I think it matters a lot to retail because at the same, any technology that, makes things cheaper, easier, more accessible, obviously pending the regulatory, framework, makes it easier to consume for retail people. Like, large investors, they have armies of people that they can deal with inefficiencies in markets that retail people don't have. So. I think it's a great equalizer for accessing financial services products.
So if this is about the rails and about changing the rails, getting things that are not tokenized, so then they're more easily accessible, things are faster, things settle.
I mean, things being faster, I think that's also how you could have lower minimums for investing in things when you have a tokenized system that can operate more smoothly or more efficiently with providing distributions to people's wallets or whatever. I do think there are a lot of efficiencies that come from tokenization. That's why I've always liked crypto technology from a blockchain point of view. If you go back and watch my videos for the last 3, 4, 5, even 6 years, 7 years, I've always said it's the technology. The underlying blockchain technology is phenomenal for streamlining financial services, which is different, obviously, from asset prices like, the price of Bitcoin or Ethereum.
Whatever's in their inventory as well.
Well, they are already saying, but that they actually doesn't. 2
of the Louvre robbery suspects will be presented. Oh, I'm kind of excited to see them. But they still have not... They still have not recovered the jewels.
Let's say we get to that world where everything is tokenized. Will the end user not even notice this world?
That's a very good question.
So the point, nobody cares about
tokenization or tokenized finance eventually will become finance. The same thing that internet companies are just companies today, right? So I think blockchains at some point, when they are integrated on the endpoints of consumers, will just disappear behind the scenes as another infrastructure there, the same way that internet. Back in the days, you might remember, you had to like dial up and have a modem and all that stuff. And today, everything is connected to the internet and it's transparent, right? So I do think blockchains will eventually become completely transparent.
Can AI achieve the same efficiencies that tokenization claims to create?
I think these are complementary topics, right? They're not one replaces the other one. AI is about like providing intelligence to things. So I think that
we haven't chosen a chain yet for the tokenization that we're doing. With the reinvest. It's one of the reasons we're calling it reinvest. It's not just the AI. You know, we think we can reinvest our AI profits into real estate, but then also help, you know, users of the product reinvest their wealth, right? That's why we're calling it reinvest, you know, by House Act. But we haven't chosen a chain yet for the actual reinvest feature where you can sort of like on a recurring basis reinvest. But we are in interviews with our broker-dealer. And so if you have any connections to any chains, like you want us to interview your chain, you have any connections that's interested, you're welcome to email us. Just send an email to, staff@reinvest.co. That's co. We're not going to spend $1 million on the .com. So reinvest.co. Staff@reinvest.com or ir@househack.com. Doesn't matter. It's all the same thing. So, but yeah, if you want to make an intro or whatever, you know, to like Ethereum or what, you know, whatever you're into, that's fine. All right. If you look at it, you know, somebody the other day made me a whole video about how like we should use this particular blockchain. Cool. All right, so let's see here. Title and deeds on blockchain is not a big deal. Doesn't really matter. Okay. Like if anybody knows about real estate and where the inefficiencies are in real estate, I think I can confidently say it's me. So Morgan Stanley to extend reach into private groups and deal for equities and that's interesting. Yeah, well, they want more clients because then once people buy private assets, especially they get accredited investors, they can move people in there. Okay. The world is watching Trump and Xi to meet. Yep, that's tomorrow. Phoenix to bolster pensions. Germany startup sets for deal on kamikaze drones with Rheinmetall. Deregulation will pour extra fuel on the private credit bonfire. Is this like an AI catch up or like of like The Big Short? Let's see what's going on here. When I walked into ABS East conference, the noise was so deafening I almost walked right back out. Armies of finance bros from the biggest banks and private capital groups jammed ballrooms, cabanas, and hallways to talk about asset-backed securities. Dude, this is so 2007 all over again. The conference, now run by the Financial Times, has been a deal-making hub for years. The ABS East conference in Miami. Asset-backed security East. Has been a deal-making. It bills itself as the most productive 72 hours in your structured finance year. But participants agreed that the 2025 gathering, which grew a record 7,200 people, turned the dial up a little bit. It felt like the scene for The Big Short. Depicted the lunacy of the mortgage-backed securities market right before the 2008 crash. Right. These days, rising investor demand for private fixed income products has stoked competition among lenders to offer attractive loans and package them into various forms of securities. Right. That in turn has allowed companies and consumers of all stripes to borrow on generous terms and is helping them spark a return of buyout fervor. Oh, man. I'm not the only one getting bubbly feel. Great. Bank of England Governor Andrew Bailey said last week that alarm bells were going off around the rapid growth of structured products. Great. Yeah, this would be a risk if we start seeing Powell talk about this today, right? That's going to be interesting. Somebody writes, is it worth it to replace the patio exterior door or paint it and get new hardwood floors? What adds more? Well, it depends what you have. Why do you need new floors? Why do you need a new door? What's wrong with what you have? That's what it all comes down to. It's what do you have? And what's there right now? Chance that Powell becomes hawkish? I mean, you're still going to get the cut, but is there a possibility, he hawks up GDP? Of course. That actually, short term should be bullish, like tech stocks and anti-recession. But it's bearish yields. Yields will go up, which nobody wants to hear that because everybody wants lower mortgage rates right now. Mortgage rates are so high. You don't want any bank debt right now. It's like, when in my career do I walk around saying, yeah, guys, time to pay off debt? I never do that, except now. I have no debt, no personal debt. House Hack has no bank debt. We are very, very happy and comfortable where we are. Yeah, it's just like, people have like 7% mortgages, 7.5% mortgages, 8%. I don't think I've seen 8 yet. But I've seen a lot of 7s. People are like, hey, I heard you paid off your home. Should we get out of, should we start paying down our mortgage too? And obviously I can't give people personalized advice, but you got a 7% mortgage, man. That's a nice ROI to just pay that sucker off over time. Even if you make an extra payment, it amortizes every single month, so you pay less in interest immediately. So, St. Louis Nowcast. What? For what? For inflation or what? I think for Nowcast, we must be talking about inflation. St. Louis Fred Nowcast. Or GDP. I don't know, because you didn't say. Yeah, I don't know. Nowcast. GDP now. I mean, this is basically the same as the Atlanta Fed. Real GDP, eh? Oh, yeah, GDP. Real GDP Nowcast. Oh, yeah, there we go. So, let's see here. Q1, Q2, Q3. Is this only released quarterly? Because the Atlanta Fed numbers are released weekly. Uses economic content from key monthly economic data to forecast real GDP growth during the quarter. In general, it is considered the most current. I mean, this is interesting because it stands in contrast to what you're seeing with the Atlanta Fed. Now, is this annualized? Because that's really low if it's annualized. Real GDP during the quarter. Oh. Okay. Well, if that's quarterly GDP, I don't know if that's the run rate. If we multiply it by 4, it's not that big of a deal. Because then it's, 2.2%. But if you don't multiply it by 4, it sucks. The final forecast value is the historical value for that quarter. It says for that quarter. But then we should have had a negative in Q1. Or when we had the, the tear. That's weird. I'm not sure. Deep zoom. Didn't even zoom. Analyzing performance in real time is a challenge. Many central bankers. I can't even scroll on this. There we go. Nah, this is a scam. What a crappy PDF reader. Now casting. All right, here. For example, suppose macro consulting firms run a forecasting model in late February and predict that residential fixed investment will increase 5% at an annual rate in the first quarter. The forecast is conditioned on several factors. We use estimate. This is just how they construct it. Yeah, but again, I need to know if this is an annualized figure or not. Maybe they say it here. The consensus of forecasters, blue chip economic indicators, the real GDP would increase at a rate of about 1.7% in the first quarter. I think this is the speed. Like, I think there's no multiplying needed. Which would be bad because it's low, right? Anyway. All right, well, let's see what else is going on. So, oh yeah, where's the rest of that Wall Street Journal piece? Where'd it go? We were just looking at that journal piece. I don't know what I did with it. Oh. Oh well. I'll find it again. Front page journal. Oh, it was the private credit story, right? Yeah. Oh, it was on the Financial Times, that's why. There it is. Failures have uncovered complex webs of borrowing and allegations of fraud. The question is, what happens next? Well, that's always the question. It's like if you're in 2007, everybody wants to know what's going to happen next, right? Somebody writes, owning a house is a liability, not an asset. Man, that is the dumbest financial line that you just scraped off some dumb financial YouTuber or something. Real estate is an asset. This is not a liability. And if you could look at this as, if you're a real estate professional, you understand that. If you're a real estate investor, you understand that. If you're an accountant, you know that. If you're an auditor, you know that. If you're a bank, you know that. There's nobody who says that real estate is not an asset. It's a fixed asset. It's called PPE, plant, property, and equipment. And to say otherwise means you don't understand finance. You know, and then people make this argument, yeah, well, but it has costs associated with it. No shit. So if I own Apple stock, does Apple operate without paying their leases or their utility payments? Of course. They have to pay their staff. But a share is just like real estate ownership, just like a deed of real estate. A stock is equity, it's an asset. We call them equities, right? Because you have equity in the company. That's how you show up on their balance sheet. But your balance sheet shows stock as an asset, just like a deed of real estate is an asset. And to say otherwise means you don't understand financial accounting. And it's fine. You know, people are like, oh, but you have to pay property taxes. So what? Apple has to pay utility bills. Oh my gosh, Apple has liabilities. They have to pay utility bills. Oh my gosh. Does that make it not an asset? It's like this convoluted mentality that people have. Oh, real estate bad. It's because you're retarded. You don't understand finance. All right. So let's see here. Global financial watchdogs want to expand the regulatory perimeter and tighten up rules. This month, the IMF warned that the US and European banks could be destabilized by their $4.5 trillion of exposure to non-finance banks. Yes, this is a big deal, by the way. This is a very big deal. The fact that the International Monetary Fund is warning about private credit, IMF 4.5 trillion. Let's see here. There it is. Oh, that's juiced. I don't know that I read this article, actually. Let's take a look at this. All right, so IMF warns on a $4.5 trillion bank exposure. Wow. I think I miss them announcing this. I mean, they always have warnings, but that's their job, right? That's why they call them the International Monetary Fund. Because they're supposed to tell us about monetary risks. And that appears to be what they're doing here. When this implodes, it's going to implode really fast. And that's the concern. It's like, let's still keep the bull game going. But anyway, policymakers should strengthen their oversight of hedge funds, private equity, and credit funds. Yes, they should, but they won't, especially not under Trump. You know, the bubble keeps going. Which could amplify any downturn in financial markets and transmit stress to the banking system. This is when SH9T hits the fan, the crash will be insanely rapid and take long to get out of. Why? Debt. So much leverage. Kevin, are you sure if my current floor is attached to plastic tile with adhesive, is it problematic replacing the flooring? Does the adhesive... A lot of people floor over 9-inch asbestos tiles. Oftentimes the 9-inch asbestos tiles are actually really flat. And, you know, like, as long as they're not breaking, it's not a big deal. And typically, you know, if you have like a vinyl plank that's floating on top of it, just because you're taking off your vinyl plank, it's not going to tear that up. Now, if you glued floor on top of the asbestos tile, yeah, that's going to be tough to take up. You know, that's why I stay away from glue downs. I like floating floors. Or like if you could get a nice hardwood floor, nice. But I wouldn't pay for a new hardwood floor. I would refinish an old hardwood floor, but I'm not going to put down a hardwood floor. All right, how are the Qs doing? Qs up 36 basis points, still doing decently here. Pre-Powie Wowie. Not bad. All right, let's keep going with this IMF warning here. Here, they're talking about Fiserv. Let's listen to this.
After a busy day of earnings, investors might have a pretty late evening tonight. As the White House says, President Trump and Chinese President Xi Jinping will meet in South Korea at 10 p.m. Wall Street time. So let's bring in Tyler Kendall, Bloomberg's Washington correspondent.
I want to hear from Tyler. I like hearing from Tyler. Just for some reason. She's great. I can't tell.
Yeah, hey, Scarlett. Well, it's widely expected that we will get an extension to the trade truce that's currently in place and set to expire on November 10th. That is seemingly in exchange for a pullback of some of the escalating tensions that we've seen in recent weeks. Today, Bloomberg News confirmed that China has placed its first orders for U.S. soybeans, though a relatively small amount compared to the $12.8 billion worth of imports that they did last year alone. China also, according to the U.S. Treasury Secretary, going to delay some of its planned export controls when it comes to critical and rare earth minerals, while the U.S. itself takes off the table, it appears, some of its threatened but not yet imposed restrictions related to things like critical software and cloud computing. Now, I mentioned a potential extension. We could also see a potential reduction when it comes to tariffs if you listen to how officials on both sides are talking about that 20% tariffs linked specifically to fentanyl. And then, of course, one of the big headlines today that we've been covering all day on Bloomberg, President Trump saying that he's going to raise NVIDIA's Blackwell chips with Chinese President Xi Jinping when they meet. Of course, none of this is confirmed. It all depends on how this meeting goes. And
yes,
Scarlett, I have to say, well, of course, there has been this simmering intentions following President Trump here on the ground. It really feels like the White House is still trying to make sure it has the most leverage going into this meeting. Just look at that trade deal finally inked today after months of negotiating here in South Korea. It has this emphasis on building this partnership in critical sectors in a bid to counter China and their grip on some key parts of this market.
All right, good stuff. Thank you so much. Tyler Kendall joining us live from South Korea. She's been up all day reporting for us. We really appreciate it. And of course, we will look ahead to that summit between President Xi Jinping and President Trump later on this evening, our time. And then, of course, there's the upcoming FOMC rate decision in about an hour and a half, which comes as the central bank has seen easing policy without the benefit of any official data. Goldman Sachs CEO David Solomon spoke about the Fed with Bloomberg at the Future Investment Initiative event in Riyadh.
I got a baby. Look at this. Hi, can you say hi? Say hi. What do you see? You want the calculator? You want to do accounting? There you go. That's all right. You could do accounting. Can you say calculator? No. Can you say one? One? You don't want to say anything today? It's okay. I still love you. Mwah. Yeah. We got to hang out a little bit this morning, huh? How are you doing? You're so beautiful. Oh, such a good little baby. You know who talks today? Jerome Powell. Powell's going to come give us the Powie Yowie. What do you think about that? Are we bullish? Or are we bearish? Just nothing. Just quiet. Quiet. Just quiet. Just peace. Just peace and quiet. You want to take the calculator? You were so zoned out. All right, let's listen in over here.
Above the Federal Reserve's goal and actually picking up relative to their projections, they're still worried, and what they're worried about is the slowness of employment growth. Because of the administration's attitudes towards the border, there's been a significant slowing in labor supply. Foreign-born workers, just flow cut, and deportations mean outright decline in the stock of workers. The problem is to keep the labor market in balance would involve very, very slow job growth, maybe too slow for the Fed, i.e. they're worried it leaves us vulnerable to adverse shocks. So they're willing to buy a little bit of insurance given the slowness of employment growth. The cost is higher inflation.
Jay Powell had described the labor market as low fire, low hire. Has that perception changed after this week's announcements? Amazon cutting 14,000 workers, UPS slashing 34,000 jobs, and of course the ongoing shutdown that has led to layoffs of federal workers this month.
Yeah, I think there are two different stories there. The first part is a conundrum for the Fed. The employment cuts, particularly in the white-collar space and in the tech side, is very much about additional productivity. So we're probably will still get the GDP. We'll get it with less employment. What do you do if you're the central bank? Well, I think for Jay Powell, he'll say, Federal Reserve Act tells of maximum employment. He's got to lean toward providing insurance about employment growth. Second part, government shutdown. The government has gotten better over time at dealing with shutdowns, so the net drag on GDP has been declining. Longer it lasts, the more costly it is, particularly businesses around the federal sector aren't getting the revenue they used to. They're really hurting, and workers not getting paid are hurting, and they are and will be cutting more of their spending. Longer the shutdown lasts, the longer you may break things.
Yeah, absolutely. And thank you for breaking down that question. I know I was conflating the two there, but it's important to kind of itemize what fits in where. I have another question for you when it comes to inflation. You said the cost of easing policy is potentially an increase in inflation. Why is the consensus view that tariffs cause only a one-time price bump? Companies have made clear that they're eating costs for now, but will eventually pass prices on. And we've seen in the past that they do this in different ways, whether it's shrinkflation or a slow, barely perceptible rise in prices over time so as to not lose market share.
It's the view of some, Scarlett, and I think hope is always a view. But I think what they would say depends on your definition of the long run. Ultimately, in the fullness of time, when you raise tariffs that say add 10% to the cost of a good, ultimately the cost of the good will be 10% higher because the Federal Reserve isn't going to change the general price level its policy. However, it could take a long time to get there, and there could be risks associated with it. In particular, if
y'all want to say hi to Jay?
The cost takes some time, is abrupt at some point. Inflation expectations could adjust, and that could shift the whole framing of the issue. So hope is the hope of the Federal Reserve. It's a one-time effect that ends pretty soon. That's the important. That's the part they don't say.
Well said. Thank you so much for saying the quiet part out loud. Vincent Reinhart is chief economist over at BNY Investments. And of course, the Fed decision coming up at 2 p.m. Eastern time. Now, in the meantime, coming up on Bloomberg Markets, global infrastructure giant Ferrovial releasing earnings.
I thought this guy actually had good points here on Bloomberg. I thought he was pretty right on. And I like this talk about insurance cuts. I think that's exactly what they're going to do. Do you have a brush? Brush. Can you say J? Can you say bullish? Yes. Can you say moon? Moon. How about rocket ship? Yeah. How about, can you say Tesla? How about coffee? Yeah. Where's Dad's coffee? Where's the coffee? Oh, I hear the babies at the door. Dada, where are you? Oh. Yeah. That's right. All right, so we got another hour to go before Powie Wowie here. We'll do some more chatting. Let me bring, I'm gonna bring Jay away, and then we're gonna get to some more chatting. Huh? Besson? You want to talk about Scott Besson? Do you want to talk? Okay, if you're gonna talk about Scott Besson, can you say, Jay? Can you say knee bend? Knee bend. That's right. Yeah, and can you say Kevin Hassett? Good. Now say wet blanket. Good. Now, can you say JD? And then thank you. Can you say thank you? Good. So you have said thank you. Good. Yes. Can you say H? Ooh, there is an H there. Yeah. Can you say rate cuts? Yes, those are good letters. Yeah. B. There is a B there. Yes. C. He's all, oh my gosh, you're gonna mess up my computer, buddy. All right, man. Let's go, okay? We'll be back. Let me go drop him off. And then, here, I think they're coming back.
Central America,
yeah.
The most legendary shipwreck in American numismatic history.
You want to take the brush?
For its hidden treasures and
right,
historical significance. During the 1850s, while transporting gold from the California Gold Rush to New York, disaster unexpectedly struck. On the night of September 12, 1857 at 8 p.m., a violent storm tore through the SS Central America, dragging its passengers, crew, and over 30,000 pounds of gold and silver into the dark depth of the ocean's floor. For more than 150 years, all was...
I thought they were about to come back on. I guess not. Sorry. All right. So... let's see here. What do we have today? Oh, I guess, he put Target in here. Yeah, he typed Target in, because I didn't put Target in here. He put Target in here, which is now under $100, which is also kind of remarkable because you're almost at like COVID levels. In fact, if we do a retrace on Target, let's do a COVID, no, let's go high to low, because then we can get the extension again. That's not bad. Let me put this, I'll make this gray for right now. There, I can see this a little more clearly. That's not bad. That's right on the retracement lines. That's incredible. Ceiling right here. We got another line here. It's actually a decent fib. Except this no man's land over here. There's just a clear downtrend on target. Huh. All right, let's go back to the IMF piece. Now that we've had our baby visit. So the growth of financial activity outside of the traditional banking sector is adding an additional source of risk to the financial system. Yeah, totally. And we won't know how bad it is until you get more of these first brand collapses. You know, that's the only way you'll actually ever know, is when the collapse actually happens. It's like they say, when the tide goes out, you see who's swimming naked, right? So banks in the US and Europe have $4.5 trillion of exposure to hedge funds, private credit groups, and other That's an insane number. The problem is, it's not just 9%. It's going to be a leveraged 9%, almost certainly. So, almost certainly a leveraged 9%. Beneath the calm surface, the ground is shifting in several parts. The IMF said in its twice-yearly financial stability report, reinforcing recent warnings. Oh, I want to see their financial stability report. Global Financial Stability Report, October 14th. Ooh. Shifting ground beneath the calm? Are you kidding me? That's literally what it's called. All right. Let me close Adobe here. I don't know why Adobe keeps opening on me. I can't stand this. Okay, downloads. IMF shifting grounds. Yikes. Here we go. IMF Global Financial Stability Report. Let's go find asset valuations. Corporate credit risk. I want to look at that. Oh, they have a... Holy smokes, there's a lot to go through here. Well, we're not going to go through all of this. But here's their executive summary. Okay, we can look at their executive summary. I'm too lazy to read the rest. Global financial markets appear calm, despite continued trade and geopolitical uncertainty. However, in this issue of the Global Financial Stability Reports, several signs of shifting grounds in the financial system that could raise vulnerabilities if the risks are not addressed. Okay. Do they think can they still save us? Accordingly, the IMF Growth at Risk Framework shows that risks to the global financial stability remain elevated. Okay. First sign that the ground is shifting is the continued appreciation of risk price assets. So basically, valuations up. Markets appear to downplay the potential effects of tariffs on inflation. Yeah. Well, because, you have, 50% of country that's like, Trump can do no wrong. IMF staff models show that valuations of some risk assets have once again become stretched. Let's see. Any further abrupt correction of asset prices could be exacerbated by changing asset correlations, like with the dollar depreciation. Another crucial sign is that debt has continued to shift towards the government sector. Fiscal deficits. Yeah, we know that. Finally, the growing size of the non-bank financial intermediaries and deepened ties with banks have heightened their sectoral interconnection. NBFIs. NBFIs has kept financial stability risks elevated. Okay. Including labor shock risks, labor supply shocks. Well, it's not just labor supply shocks, it's labor hiring, labor demand. NBFIs. These NBFIs remain vulnerable to large and persistent bond market shocks. Dash for cash. Treasury markets weathered April 2025 tariff turmoil, stopping short of the severe dislocations witnessed during the Dash for Cash episode. This relative stability raises an important question. Does the market's resilience reflect structural improvements, or was the April shock merely less severe in a different nature? Right. Okay. Well, it was short because we got taco fast. NBFI's amplification of market stress from the side of leveraged funds was limited in April 2025 compared with March. So in other words, we didn't even get to NBFI stress yet. Okay. Stronger non-bank nexus increases contagion and liquidity risks. Oh yeah, talk to me dirty. Banks lend to a variety of NBFIs. Right. Banks lend to the non-banks. And then the non-banks lend to the scum. And then package it up to pension funds. Right. Right. Banks' exposure to NBFIs is large. In Europe and the United States, NBFIs represent 9% of banks' loan portfolio with an exposure of 4.5 trillion. 2.6 trillion corresponds to loans and the rest to undrawn commitments. The growing exposure to NBFIs is generating concentration risk at some banks in the United States. Banks representing almost 50% of their assets, representing almost 50% of sample assets, have exposure to NBFIs exceeding their Tier 1 capital. While large banks serve as the primary lenders. Oh, wow, the biggest banks are the primary lenders to NBFIs. 90%. Exposure is severe amongst large regional banks with assets under 100 bill. Oh, so it's interesting if larger banks are the ones doing the lending to these, because that's like the financial plumbing of the whole ecosystem, right? Exposure to private equity and credit funds alone is substantial and growing rapidly. Banks are increasingly lending to private credit funds because these loans often drive higher returns on equity than traditional commercial and industrial lending. Wow. Thanks to lower capital requirements allowed by their capital structure. Concentration amongst private equity is also growing. 5 large fund managers accounted for about 1/3 of aggregate loan commitments. U.S. banks with high NBFI exposure, defined as exposure greater than 100% of Tier 1, have a more fragile funding structure than the low exposure peers. Banks' growing exposure means adverse developments at these institutions, such as downgrades or falling collateral values, could significantly affect bank capital ratios. Right. Like, basically what they're saying is, okay, I'm going to simplify this. So basically, large banks are the ones lending to non-banks. If non-banks lend to companies with SH9T collateral, then large banks will find themselves shocked when that collateral value plummets. That's when you have a financial crisis. That's very interesting. IMF staff assessed the potential impact on the euro area and U.S. banks in a scenario in which the average risk weight for NBFI exposure rises from 20% to 50% and borrowers draw down 100% of the commitments. Okay. The results suggest the impact on bank solvency ratio could be substantial. CET1 ratios would decline by more than 100 basis points in about 10% of U.S. banks and 30% of European banks. in the adverse scenario, combined with additional NBFI shock for the euro area, projects an increase in the share of weak banks. It's a full-on new banking crisis. In the more conservative scenario, these are results. Furthermore, could face, let's see, liquidity pressures, outflows, sensitivity analysis. 4% of U.S. banks would lack enough liquid reserves. Oh, wow. 4% of U.S. banks would lack enough liquid reserves to meet outflows. So you would literally have, a draw on FDIC again, turning their net liquidity into negative liquidity. You'd have a liquidity panic. Full-on liquidity panic. Full liquidity crisis. The impact of outflows is concentrated among smaller banks. These banks would have lower liquidity, of course. That's always how it is. The additional impact of liquidity stress on the solvency of these banks. Right. Which is not considered. Wow. They don't even consider the fact that the banks could go bankrupt. Didn't even consider bankrupt banks. That's like where the term bankrupt comes from, after all. Liquidity shocks. Blah, blah, blah. By contrast, banks may be more vulnerable to abrupt increases in bond yields and interest rates. 2 years after the heavy bond portfolio losses led to the demise of Silicon Valley Bank, stress tests show that global banks can incur valuation losses of about 1%. In an adverse scenario. However, losses are much more meaningful for North American and European banks, reaching 2.5 and 1.5% of the CET1 ratios. Fine. In other words, it's going to be worse. Like, declines due to NBFIs would be worse than stress tests test for. And then they get into stablecoins. That's all they're going to say about the NBFIs? I mean, that's interesting. How do they not even factor in that these banks could go bankrupt? Yeah. I mean, this isn't great. Like, they're basically mapping out the next financial crisis here. In like really complicated wording. Kind of crazy. All right. Well, that's a wild report from the IMF. So let's go back to the Financial Times piece. That was here. By the way, if you haven't already checked it out, remember that we do have a price increase coming for the Meet Kevin membership. So we've got that.
Coupon linked below.
You get all 8 courses. Could be a tax write-off for you. Every trade alert. Top 10 stocks to buy for the next 10 years. Every private live stream. Every alpha report. We had some great alpha reports over the last few weeks, frankly. It's been doing really, really well. Satisfaction's really, really high on the product that we have there. So do give that an evaluation there. MeetKevin.com. Anyway, the warning comes as financial regulators are monitoring the collapse of First Brands. Let's see here. We have seen an uptick in leverage in the sector, as we've seen an uptick in the exposure of banks. Right. The IMF said Tuesday that a number of U.S. and Eurozone lenders have built up an exposure to non-banking intermediaries above the value of their Tier 1 capital, an equity buffer that absorbs losses. So basically, the stress tests are no good. So he says, nice shorts. Oh, thank you. Yeah, I really like these shorts. They're very, very comfortable. Lenders with non-bank exposures worth more than their capital now represent more than 40% of banking. Lenders with non-bank worth more, right. 40% of total banks have non-bank exposure more than their capital reserves. Wow. Basically, basically, If SH19 hits the fan in private credit, the banks are not prepared. Dude, you know what soundboard button we need? Hold on, I'm gonna download it right now. Oh yeah. Oh yeah, here we go.
You are not prepared!
It's pretty good. I feel like it could be a little, like, I feel like that's not the OG You Are Not Prepared. I might have to, like, steal that from the Burning Crusade.
You are not prepared!
That's better. That's better. That's got, like, the background music. That one's way better. Yeah, I like that one. That one's much better. All right, we're gonna do that one. That's definitely it. You are not prepared. Oops. Let's go here.
Problems and, no reason for it. I think it's going to be a great deal for both.
The president says he'll press Xi on soybean purchases, fentanyl, and NVIDIA chip exports, Beijing's curbs on rare earths, and Trump's massive tariff hikes on China will also be on the table. So, EJ, you're watching what's going on in Asia. We've been debating fiercely on this show how much it matters. But take us into the U.S. economy for a second, okay? We get big numbers in these deals, whether it's South Korea, I think it's $350 billion. Japan is like $490 billion. Investment coming in. Now, those are pledges. I don't think they've happened yet. But you've also got an economy where clearly the job picture is sluggish right now. How much do these deals make a near-term difference for getting that job market picked up, kind of in line with the GDP projections we're seeing?
Sure. Well, so Brian, this is the big advantage to investment, right? You get both a short-term boost, but you also get the long-term boost. What's the short-term? Well, if your investment is going to be for things like Toyota building a factory here, what does that do? It means you immediately get some construction jobs. After that factory's up and running, now you have the manufacturing jobs to run it. And then all of the different ways in which the supply chain is affected. So you get jobs in not just making cars, but now making steel, making electronics, rubber, glass, you name it. Right? So there's kind of a, I don't want to say a trickle down, but maybe a spillover. There are all these related industries that are going to be benefited as well. So again, that's the beauty of investment. Consumer spending is great because we need to consume today. But investment in a lot of ways is better because, again, you get the boost to the economy today and then it continues for quarters and years to come.
I mean, I agree with the logic there, Jackie. For me, the issue is like timelines. So how soon does this happen? How fast do these investments break ground? How quickly do you get the hiring? And look, let's just make it a little bit political. You've got midterm elections in 2026, okay? So do these things happen fast enough for people to walk into 2026 and say, I feel good about my job prospects. I feel like this economy's humming and it's working for Main Street, not just Wall Street investors.
Some yes, some no. It won't be fully fleshed out by then. But I do think enough people see what the president has done.
I did it. I have made it a soundboard. Let's see if it works. So I could press this button.
You are not prepared.
Oh, that's so sexy. Love that we did that. Thank you, Kevin, for suggesting that. Also, I haven't used this one yet, but I really want to use this one in case there's like breaking news one day. We got to do like, and Jerome Powell is about to speak at the Federal Reserve to give us 25 basis points of cuts and potentially end quantitative tightening. Use that coupon code, link below. MeetKevin.com. All right, where were we?
To say a 10% tariff, which would then average out and bring down all of his overall tariffs. So I think he's going to start there because that's low-hanging, easier fruit for him. And that's one of the things that the president really wants to make headway on. The other thing is the rare earth aspect of it, where if he can negotiate Trump some time, whether it's a year or 2 years, he's already working on his diversification plan. And I think the United States will be in good shape not to rely on China.
Kevin wants to be a news anchor so he can go close to Sarah. Shh! Don't tell anyone at CNBC. They'll never hire me.
Tomorrow, which
who's gonna take Jim Cramer's job?
That would be really smart. But these are some of the aspects of this particular negotiation and the art of the Trump deal that I find fascinating. I can't wait to see this play out.
I can't either. Lydia, let me throw one at you and see if you'll bite on this.
Okay.
TikTok will be on the table.
Mm-hmm.
Some people say having TikTok on the table gives America something that we maybe shouldn't really want in the first place, and it's going to give Xi a little bit of leverage to get something he wants.
Yeah.
Do you like that TikTok's going to be part of the conversation, or do you wish we had just let it die on the vine?
I mean, I think the reality is that it's there. It doesn't matter. It's not going to go anywhere. And I think for so many Americans, it's part of their social media diet that they want back.
Do I think the USD is going to fall after the Fed? Well, I actually think if Powell is mostly bullish, then you'll actually probably see rates go up. And if rates go up, then the dollar will actually strengthen. You know, I think people think oh, rates are going to come down. That's going to weaken the dollar. But the thing is, depending on his commentary, the opposite often happens. So Azure portal having access issues. Yeah, here's the down detector. Capital One, Microsoft 365, AWS again, Microsoft, Xbox, Starbucks, Azure, Costco, Google Cloud. Good, I don't want email anyway.
In a way that Congress doesn't like or that litigants don't like, it doesn't matter. I think that is such a big deal and would be a victory for him. You know, we can look back at China, in 2020, there was a deal. Larry Kudlow was a part of negotiating it and has reminded us so wisely many times that they just didn't play by the rules, even when they agreed to it then. That always reminds me to keep expectations low when it comes to China.
Right.
But I was encouraged today to read a headline from Reuters that said China just bought some soybean cargoes from the U.S. for the first time this year.
A little good faith going into the negotiation,
I'm
maybe?
just saying that's exactly the way I read it. I think they're trying to play nice ahead of the actual sit down.
Okay, so Brianna, let me ask you then, because I've been very persuaded by Larry that these guys make deals all the time that they don't keep. And I think fentanyl could be in that category. Soybeans have been in that category. Rare earths, they flip-flop. So what should Americans expect out of this? What should our standard be for a win? Knowing that when you negotiate with China, what they say historically has not been what you've gotten.
Yeah, and I think for TikTok, for that aspect, I don't necessarily think we should be excited either way, because I don't think China necessarily wants to give what the United States wants. To the fentanyl point, to snowball on this, I think the average American knows that any win on fentanyl is something tangible that the average American who's not engaged in politics or business can understand as a win for President Trump versus tariffs. It's not really digestible at the kitchen table. Talking about fentanyl at the kitchen table, President Trump stopping that flow is something that's good. And to the rare earths minerals, we were just talking about this last segment. Look, President Trump struck somewhat of a deal with Malaysia, but it's still unclear because Malaysia is now saying, well, we're not actually going to, get rid of our ban on rare earth minerals. They've also been working with China over the past few weeks. So I think President Trump going over there and trying to hammer out details with China for rare earths might send a signal to Malaysia and other countries that we're trying to diversify with that it is an open market. You should be involved with the United States and don't cozy up to Beijing because they might stab you in the back the way they've essentially done to the United States and other countries.
EJ, I've read Treasury Secretary Scott Bessent and what he's been saying lately, and he's made some curious comments, interesting comments around what China's done on rare earths has been kind of a China versus the world thing.
Right.
Okay, right. And my view has been, and this may be too strong, but my view has been, I think ultimately with China as a communist country, decoupling in key areas at least is the only realistic alternative to what we've got going right now. From an economic standpoint, is that suicide for us, or is that actually where we should be going?
Well, it's one thing if you could flip a switch and instantly.
Yeah, remember the Fed meeting is at 11. So we'll get the statement at 11, and then we'll get the press conference at 11:30. So we got like an hour to go.
As bring up the Treasury Secretary, as he has pointed out many times, they're the most lopsided economy in the world today. They are so overly dependent on their export market that if you do shut that off, it's game over for them. Xi has enough problems as it is with things like youth unemployment and prices right now. There's no way he can make the situation for himself even worse, I think, and still hold on to power.
How big are his problems? We've heard people say they're huge. How big are they? How do you know, even with an economy that never tells you the truth on their economic statistics?
Great question. So one of the things that we have to do, for example, to figure out how much are they actually exporting, because you can't trust their numbers, you have to try to go around to the rest of the world and figure out what percentage of their imports are from China and add all of that up and do all the exchange rates and everything else, and then try to figure out, okay, how close is China's published figure to reality? It's a lot of work. It's difficult to do. But sure enough, you can see that, as you said, they're not publishing real numbers. They haven't for years.
But what we're finding in doing that work is suggesting their economy is in very, very rough shape right now. Xi does not have leverage when it comes to strength of his economy.
Sure, and they are pouring in both fiscal and monetary stimulus, right? As much as they can right now to try to keep that thing going.
One area where the U.S. and China are in fierce competition is EVs, Jackie, Tesla. What's going on?
Preparing to name a new CEO if shareholders do reject Elon Musk's proposed $1 trillion pay package and he resigns. So Tesla's chair says that Musk's successor would likely be someone from within the company. The vote is scheduled for next Thursday. I can just say this. This would not be a situation where, for example, Steve Jobs dies and Tim Cook takes over. Obviously, you have no option. Investors and Wall Street will not like Elon Musk's resignation of this company, especially since he really doesn't have to. And pay packages, listen, if he's worth it, he's worth it. The shareholders can decide.
Again, remember what we showed this morning, like this pay package, it's the Elon, the Elon wanting the tatas, right? Like, that's what people are hoping. Like, we put together this very clear fundamental analysis here of why people are so excited about Tesla stock, because Elon's looking at the $1 trillion boobies. And people think, hey, it doesn't matter what the fundamentals are. He's going to figure out how to get his tatas because he's Elon.
A new investigation revealing Zohran Mamdani's political rise wasn't really a grassroots TikTok movement, but instead one engineered by radicals with deep pockets. We'll explain.
Well, duh. You need deep pockets to get anywhere in politics. That's how it works. All right. So let's keep going here. What do we have here? Let's see here. Oh, so how are bonds moving right now? Bonds, US 10-year. It's up a basis point. I don't know. I still think there's a shot that they go up even more after the Fed meeting, so we'll see. Handful of US and Eurozone banks have non-bank exposure worth more than 5 times their capital. Banks are increasingly lending to private credit funds because these loans often deliver higher returns on equity than traditional commercial and industrial lending, thanks to lower capital requirements by their collateral structure. Fine. A recent push by private equity and private credit funds providing access to retail investors has also raised the concerns about the risk of forced sales to meet demand from looking people to cash out in a market crash. Right, that's also true. The more you sell to retail, the more you're gonna get people freaking out when the values go down. And then, people will demand their dollar hollers out. That's gonna be interesting. So the worry is that we enter a more pronounced downturn. There will be more redemption pressures on retail products. Completely true. There are significant gaps in disclosure by some non-banks. Oh, it's going to lead to so many lawsuits. This is why, what we do with House Hack and Reinvest, we think we're so ridiculously transparent. We're just like, hey, here are the assets we have. We put them on the website. We're putting up our in-progress renovations as well. Hopefully today, maybe this week or something like that. But I think it'd be cool for some people to see some of our in-progress renovations, or at least some pictures of them or whatever. So, yeah. Hedge funds have rejected calls for tighter scrutiny. And that's obviously, that's the asset-backed side of our business. Of course, there's the AI stuff we're really excited about. Not a solicitation. Read the offering circular at reinvest.co or househack.com. Same company. Hedge funds have rejected recent calls for tighter scrutiny. Of course they have. saying they use less leverage than banks. Right, well, they just end up using more options, so they might end up practically using less debt, but what they'd have is they have greater debt exposure to, option contracts. Financial system has largely showed its resilience during a sharp but short-lived sell-off. Financial markets in April after U.S. President Donald Trump announced higher tariffs on imports. But the IMF said the risk of a downturn in financial markets has increased since a surge in equity markets led by optimism about the potential for artificial intelligence. Right. But why? Just because of a potential overvaluedness? It estimated equity markets were 10% overvalued compared with fair value, but added this was lower than the 20% right below the dot-com bubble in 2000. Oh, we still have 10% to go. Let's go. 10% more money to make. All right. Let's see here. Cues before Powie Wowie. Should we go make our, we should probably start prepping a bingo board for Powell, huh? I don't know. Are we ready for Powell?
You are not prepared.
How's the volume on Illidan, by the way? Are any of these too loud?
Sync rate. Pull up.
Big pee-pee.
Welcome. Nice to have you. You want to talk about lovemaking, right?
Fetch me.
That one sounds too low. Bullish Catalyst sounds too low.
Chew on this. Kiss it bye-bye.
Data dependent.
All right. We'll do some bingo in just a sec here. Oh, boy. So... You were not prepared is pretty loud? Okay. Yeah. And then I think Bullish Catalyst is too low. So let's raise Bullish Catalyst. And let's lower You Were Not Prepared. So I'll drop it another 4 decibels. So this will be the Bullish Catalyst.
Bullish Catalyst.
That still seems a little low. And then You Are Not Prepared.
You are not prepared.
Yeah.
Kiss it bye-bye.
Cool. Great. Good. The top comment on my Neo Robot video is AI equals actually India. Yeah, pre-order is like an investment into the company you didn't mean to make and you have no equity. Exactly. Somebody says, love the new unfiltered Kevin. Kevin's always unfiltered. Nothing's changed. All right, so then... All right. We're going to have to make a bingo board. +5. Yeah, I agree with you on having to increase Bullish Catalyst even more. All right, let me do that. Let's go with, I'll go +3.
Bullish Catalyst.
Still seems low. You're right. I think it might have to be +5. All right, let's go to 5. And then we're going to do bingo. So, Bullish Catalyst, 5.
Bullish Catalyst.
That'll work. Pull up is too low?
Pull up.
Really?
Sync rate.
All right. Now, Fed bingo. Fed bingo, October 29, 2025. Insert image. Favorites. Collections. I think it's so hard to find stuff these days. People, pets, where's favorites? Albums. Oh, there it is. favorites. Bingo board. Yeah, boys. Oh, that's a good looking Fed bingo board. All right. Here we go. Fed bingo. So if you want, feel free to start throwing down some comments that we should put in here. So the first one we're going to do, as usual, is just the freebie that Powell on time. Powell on time. And then we'll throw a second freebie in, and we'll go with purple tie. Okay. Then we're going to, I mean, this, we know this, the balance of risks. Well, let's see here. Low, higher, low, fire. Low, higher, low, fire. Okay, this should be the easy column. Okay, we're going to call this the easy column. We'll put this at the bottom. Easy column. And then we're going to say the balance of risks has shifted. I actually want to get bingo today. Of risks shifted. And then let's do, you know, over here, it'd be nice to say something about, I mean, we got to throw in the data dependence, but the problem is there's a lack of data, right? And then so we'll say something like, we have other sources. Other sources, despite shutdown. All right. Good. Then data dependent. What else? Just close the effing door. Mentions Jackson Hole. Labor market easing. Jay Powell resigns. No. Yeah, if we have anything on the beverage curve, that'd be great. So let's see. Mentions beverage curve. Bonus, well, let's go break evens in labor market near zero. Strong GDP. So I should do like bullish and bearish over here. So let's do a bullish column. Bullish, bearish. Bullish is going to be steep beverage, whatever you want to call it. Bearish would be, increasing risks in private credit. Up risks in private credit. And the non-financial, what are they called again? The NFBIs or something like that? NBFIs. NBFIs. Okay. That's bearish. Layoffs accelerating is bearish. Okay. Quantitative easing's not going to come up. But pausing QT pause to stabilize funding and liquidity is bullish, right? Risk that QT pause doesn't solve liquidity issue is very bearish, right? If he's like, yeah, we don't know if pausing is actually going to help solve the issue, that would be quite bearish. Then layoffs accelerating. Let's see here. Inflation outside of tariffs nominal. Outside tariffs nominal. That's bullish. And then obviously anything about, let's see here, anything about, what was I going to say? It was something to the effect of like, inflation outside of tariffs being nominal is bullish. Oh, just basically, you know, longer one time transitory. He won't use the word transitory. He won't say word transitory, but it'll be the same thing. He'll mean the same thing, right? Any talk about a flexible inflation targeting, right? Flexible inflation targeting is bullish. Like steep beverage curve. He could also say this by basically saying, you know, stabilizing labor, right? That would basically be the same thing. The stabilization of the labor market. So, you know, we don't have to, he doesn't necessarily have to exactly say the thing about the steep beverage curve. That'd be bonus, you know, the steep beverage curve part. If he says that, he watches Meet Kevin, okay? J-Pow, if you're watching Meet Kevin make the bingo board, if you tell us that you're observing that the beverage curve is steepening and maybe that is a sign of a new normal, then we love you because it means you watch Meet Kevin. That'll be our secret message to each other, okay? Nobody will know. Nobody's gonna know.
Chew on this.
All right, good. Let's see here. Powell mentions the coupon code. Yeah. There you go. Coupon linked below. ADP reports. Yeah, he'll mention the weekly ADP reports. I think he will mention that. Weekly ADP stable. You know, no cliff. That's somewhat bullish as well. Let's see here. Papa Powell. Oh, housing inflation. Yes, housing inflation. Housing inflation down. That's bullish, by the way. And that they expect that to continue. Yeah, that the fewer people entering the labor market because of immigration is basically the break-evens comment. Where did I put the break-evens? Break-evens in labor market near zero, right? That's because of immigration. Yeah. Okay. Cool. Okay. Let's see what else here. We're on unsustainable path. That's the fiscal deficit. Yeah. 50%. 50% or a 50 basis point. I'm a teacher. My class listens to me, Kevin, in the background. Oh, that's awesome. Today students will learn Power of Powell's Good Afternoon. Yes. That's like Tim Cook's Today. We should let's put that on the easy list. Good afternoon. Oops. My handwriting sucks. Oops. Can't even spell good afternoon. It's because I'm trying to write moon. All right. Let's see here. Regional banks. Interesting. 50 BP. I would go with 50 BP not necessary. 50 BP not necessary. We'll probably get some talk about neutral, at this time. He'll say at this time. Because they can always cut faster if they need to. That's the nature of the Fed. They can always cut faster. But if you go for regional banking crisis, I would say he'll say the banking system, like if it comes up, it would just be banking is sound and resilient. He's not going to mention stress here. This was very 2023. And then it makes you wonder if he brings it up, does it mean it's not? Did we talk about the balance has shifted? The balance of risk shifted. Yeah, we put that down. So that's for the dual mandate. Evolving outlook. That's a good one. I like that. Let's see here. Watch out for adult content students. What time does the Fed get? We got 29 minutes to go for the Fed, rate cut release. Close the effing door. That's right.
Just close the fucking door. Close the door.
I love that. He said we caught that alive. That was like top G right there. That was top T. Top G. Top T. Oh my god. Yeah, valuation's high. I think that's fair. Asset valuations high. Yeah. Yeah, we could talk about the productivity boom. Productivity boom from AI may take years to realize. Yeah, not on a preset course. That's a good one. I think as the last one, we'll just throw in like a not my job. Just as a bonus. Not my job. Some kind of quip like that. Yeah. All right. There's the bingo board for today. Can we get this to where it's screenshotable? Aw, I can't get it into that little happy middle ground there. Close enough. Oops. There we go. Oh, stop it. There. I'm just trying to make it screenshotable. Whatever. All right. Fed bingo.
All you need to be off and running.
And it seems like that's becoming a more and more attractive proposition for a lot of folks every day. I think it was encouraging a few weeks ago. You might remember we saw the White House, the First Lady there, Melania Trump, of course, convening a big task force work group talking about AI and how it's changing the labor market. And when she was speaking, along with the labor secretary there, they were speaking not just to people that are coming up the next generation, young folks that are in school now and what kind of education they're going to need. But they also spoke to people that are, going to have to transition this change in the workforce and getting re-educated. So I think this is going to be a challenge to some of us, all of us, on being nimble and staying on top of our own game and being willing to kind of take up some new skills. The Wall Street Journal has this piece about, how folks have been on the sideline now for some of them months, after layoffs that have been really hard. My heart really goes out to them. The flip side of that, though, is the long-term benefit and the trade-off. I will say AI is not perfect yet. I'm a former lawyer like yourself. I'm in a lot of discussion groups about how AI is changing the legal community. Those jobs are really taking a hit. But I'm also seeing just as many posts and warnings out there about how what AI is doing to the law right now with the brief writing and stuff. It is far from perfect. It's, the what do they call it? The AI hallucinations where they come up with, fake case law and fake paragraphs. It's showing up in real court briefs because people are just feeling the pressure to operate too
Real
fast.
quick, Brianna, on this aspect, you would think that it would be lower-end warehouse jobs. But we're talking about white-collar jobs. And when people start to talk about white-collar and more high-paying jobs, that becomes scary. Now, the Republicans and President Trump are big proponents of AI. Does this politically come back to bite them?
No, not if they use this as an opportunity to reorient, in particular, college students, right? I mean, we're talking about rare earth minerals. Look, we have no refineries, no processing capabilities here. This is a great opportunity to go to college students and say, here's an avenue which AI might not be able to dominate for a while. This is a place where you're not going to lose your job, right? So we have to push students towards paths where there is something that is tangible and not something that is really just, intellectual, because that's where AI is going to go first.
You mean stop subsidizing like gender studies?
You got it, Brian.
Maybe if you want to get a job,
All right,
don't
let's go to the
stop.
Doomers. And how are the sticks doing right now, by the way? Take a quick look at the sticks. So the Qs are, okay, Fiserv's down still 42%. Let's see here. We've got the Qs are not quite at the low of the day, but we're getting a little lower. This is all pre-Fed jitters. Super, super normal pre-Fed. Let me go. Here we go. Tesla down 16 bips. That's not a big deal. Red Robin, the restaurants are going down on the and the consumer plays are going down on the Fiserv data. That's not a surprise. Nvidia, Meta's down 36 basis points. Nvidia's still up to 7. Still pretty impressive, but some of that extreme momentum has chilled out a little bit. MP Material down. We've called this in the Alpha report. Dude, the fact that we called 100 and then said it would top at 100 before it even hit 100. We said that when it was like $70. Like, this sucker's probably going to run to 100, and then it rejects 100 and goes down from there. It's down like 35% since that call. I remember in the Alpha report that morning going, this might be it. This is it. So, let's see here. We've got, so this is a good call in the Alpha report. We've got Amazon's positive. Symbotic, really nice move on Symbotic. That's pretty solid. And then let's see here. Dave, Beyond. Yeah, and then you got Tesla here. All keeps getting destroyed. Also not a surprise. All right, let's listen to Doomers for a moment.
Surprise is the more dovish cast.
Perhaps that comes out at the press conference.
Yes, at the press
I don't know, because as John started off, equity markets are at a high. Credit spreads are very tight. The labor market, you look at the low 4s unemployment, 4.3%, doesn't look bad.
I got a question for you. Given everything we've got, John, what would the dissent be at the Bank of England today if they had the same cards? There'd be visible back and forth.
So I think this is potentially a question for next year. I remember a time when Governor King dissented on his own committee and was pushing for more QE, and his committee was voting against him. And maybe that's a question for 2026. If you get someone super dovish in the seat for 2026, can he get the rest of the committee to come with him? I think a question for today, Bob, is just how divided this committee is. And you point to the labour market, and I'm right there with you. There are credible arguments today to cut interest rates. Equally, there are credible arguments to do absolutely nothing. And when you look at the labour market, it's massively dependent on which data point you're anchoring your view around. If it's payrolls, you are spooked. You are cutting interest rates. If it's unemployment, you're sitting there saying, you know what, I don't think the slack has increased too much here, even with this massive step down in payrolls, and I don't see the urgent need to reduce interest rates. How would you anchor your view around this labor market?
I anchor my view around JP Morgan Chase data. We're the largest banker to the consumer. We're not flying data blind at all. We see the top 4 quintiles of earners with deposit balances above where they went into COVID. The bottom quintile is below where they went into COVID. So that's the K-shape we all talk about. Does that get addressed with the One Big Beautiful Bill Act when you start to see tax filings and refunds on tips, overtime, Social Security payments, and a host of other things? Maybe it does.
Are you in the re-acceleration camp for 26? Are you expecting things to pick up in the new year?
Yeah, I think the fourth quarter of this year and the first quarter of next year will be, call it 1 to 1.5% GDP. There will be some digestion of further tariffs and final tariff policy. But with central banks cutting rates and an additional $1 trillion in stimulus hitting, it's hard not to see a reacceleration in growth.
What does yield tell you right now, not only the conventional full faith and credit, but the very short-term paper, the trust market? What are the indicators you see into this meeting?
The planet is underallocated to fixed income. I just got back from the Middle East. I heard it everywhere I visited. I hear it domestically. I've got one meeting after another. How else do you explain the 10-year trading through the Fed funds rate today? It can only happen if there are constant buyers, and the buyers are out there in full force.
Then how does that cross over to the dollar as an indicator of that need to buy more paper in America?
Well, I think that's a different topic because there is a sense that perhaps if you're an overseas investor and you accumulated U.S. assets, you may look a little toppy in dollar exposure. So why not hedge some of that back to your base currency? It didn't make sense a couple years ago because the dollar kept going up, so you hung on to the dollar with U.S. assets. Now they're starting to hedge some back to their base currency.
Bob, logic would dictate as the Federal Reserve begins to reduce interest rates that money and money market funds would start to spill out, maybe into risk assets, into other things. How sticky is that money at the moment?
Well, other things would be fixed income.
Just sent a little trade notification to those of you in the Meet Kevin membership. Pre-Powell, baby, pre-Powell. And my plan for post-Powell.
They feel they may have missed interest rates. I tell them, congratulations.
Remember, that coupon's expiring tonight. It's coupon code Schumer Siesta. I was expecting to keep the Schumer Siesta going because I thought that it was going to end sooner, but now I kind of think that the Republicans are going to kind of run the Schumer Siesta all the way until the end of the year, and then they'll end up taking credit for healthcare. That's exactly what I see happening. The Republicans are arguing, oh, Democrats want to give healthcare to illegals, which is not what the federal government does anyway. And then at the end of the year, the Republicans go, we're going to give healthcare to everybody but the illegals, which is literally exactly what the Democrats would have wanted anyway, because it's the state governments that give money to illegals, not the federal government. And then Republicans will take credit for reopening the government while solving the healthcare crisis, arguing that, well, we made sure it's only going to legal. That's it. Mark this moment right here, okay? October 29th, 2025. The government shutdown will be blamed on Democrats who want funding for Obamacare, the healthcare subsidies under the ACA. But by the end of the year, the script will flip. And it'll be Republicans who go, we reopened the government and got you healthcare funding, but we won't give a dime to illegals. Because again, that's always been the federal law from day one. It's just people like Gavin Newsom who end up giving money without verifying immigration status. However, California, in fairness, is a donor state to the federal government. So then it sort of provides this license of, well, should he be allowed to do that? I don't like Newsom. I'm just saying. That's how I see the Schumer shutdown ending. But anyway, so because this whole Schumer shutdown is going to take a whole lot longer, we're going to end the Schumer Siesta coupon code because we haven't had a coupon expiration in quite a while. If you actually look, it's been a while since we've had a coupon expiration and a price increase. So now we're going to have to play catch up and raise the price more. So we're going to end that coupon at meetkevin.com. All right. Now, where were we? All right. So we're waiting for Powie Wowie. Okay, how realistic is OpenAI's time frame for automating AI research? It's not. Let's see. China to fast-track tech IPOs to counter U.S. rivalry. Well, hell yeah. That's exactly what they're going to do. Accelerating the pace at which startups go public in hopes of increasing investment in the sector. It's actually pretty smart. Securities regulators in China approved the public listings of two chip designers, Meta X and more Threads, in less than 3 months. Chinese regulators typically take a year to approve public listings. Wow. And they usually prefer candidates for IPO to show sustained profitability. Oh, now they're probably going to put money-losing companies up, huh? Reflecting emphasis on protecting small investors that dominate the mainland Chinese market. Both of the chip companies are losing money. Yep, there it is. New policy follows a directive from the Chinese Securities Regulatory Commission in June that they will support high-quality, unprofitable tech companies with core technologies and strong potential. Ah, yeah, there we go. The move comes at a time when Beijing is stepping up efforts to promote the use of domestic technologies so they could wean off U.S. technologies, of course. It's not like Chinese regulator doesn't know companies are loss-making, but he must pick a few companies from such strategic sectors. Wow. All right, well, 14 minutes to the Poway statement.
5-day winning streak on the S&P 500. Equities this afternoon higher by 0.2%. On the Nasdaq up by 0.3. TK in the bond market, 2s, 10s, 30s. Interesting, the last time the Fed met, 2s at 350, 10s at 4%. This bond market has been very well behaved over the last month.
I don't like the word, but I'm going to use it here, resilient. And the answer is there have been some movements, including a dash to lower rates. But we come back, and again, I look today at weaker sterling and stronger renminbi with what's going on in Korea. And there's just a churn here that shows a resilient economy. As Bob Michaels said, you know, you model out Q1, Q2, and you say, okay, we keep it going.
I think Bob's right. Bob Michael at JP Morgan still with us, by the way. Look at what we're hearing from corporate America. Let's take the banks, Bob. Banks are telling us that corporate clients are re-engaging big time. If you look at Visa, just to stay with the financials, they're saying the consumer is still engaging and is likely to engage into year-end and beyond. Is that the tone you're picking up from corporate earnings? Just how bifurcated are things?
Forget about corporate earnings. Our analysts, credit and equity analysts, are talking to companies every day, dozens, hundreds of them every week, and we're all hearing the same thing. Tariffs are yesterday's news. They've absorbed it. They're over the hump. They've stopped moaning. They're getting on with life. And they've underinvested in themselves this year, deliberately. It's flattered earnings. Now it's time to invest. Maybe there's more CapEx in AI. There's a bit more hiring to go. They'll see how it all plays out, but they're not seeing the consumer fall off a cliff here.
Subhadra Rajappa of SocGen joins us now for The View from SocGen and a whole lot more. Subhadra, welcome to the program. Let's just start with the basics. In about 13 minutes' time, a decision, a statement. How much dissent are you expecting this afternoon?
Probably one dissent from Governor Myron for a more deeper cut, because he's been calling for the Fed funds rate to be moved down to neutral. There could be some dissents coming from some of the regional Fed presidents, but I think it's unlikely. I think I'm just
gonna, I guess, put some of my thoughts up here. I'll put them up on screen before we get started here. So I'll just publish this. This is all going in the Meet Kevin app. So remember, if you want to see kind of my data notes or whatever, you can get this in the Meet Kevin app. And I think it's, you know, it's kind of a cool little tool. But let's go ahead and just throw some last minute thoughts up here on what we think for the Fed. My take on the Fed today, you know, my belief is we'll get a time frame for QT ending, vacuum cleaner off, within the next 60 days, you know, before year end, basically. We'll get 25. And I think we'll get a bullish Powell on GDP. on labor at break-evens, stabilizing, hopefully. Likely argues that ending QT is enough to stabilize funding stress, and likely downplays private credit risks. All four of these are bullish stocks, but bearish bonds, right? So if this is correct, I expect 10-year Treasury to go to 4.05%, and therefore bonds down, and stocks rebound. We'll see. I doubt he'll go bearish jobs. He'll be bearish jobs. More likely to push for normalization. Bonus if he mentions steep beverage curve, in which case we know he watches Meet Kevin. That'll be the bonus. So we'll see. But yeah, I mean, these are just sort of my like pre-Fed notes here, right? And again, if you download the Meet Kevin app, you could literally get it in an application right here. You download the Meet Kevin app, you get those notes in the app. You get the data tab at the top, the daily wealth. That's a pretty awesome free kind of like commentary that I do daily. You can also get that on email by going to meetkevin.com/data if you'd prefer email. Meetkevin.com/data. At the bottom we have it there. And then, of course, if you're a course member, you get like the trade alerts, the 10 stocks to buy over the next 10 years, not personalized advice, the fundamental analysis, the technical analysis, and the alpha report every morning, and then the fundamental analysis in the stock tab we do as well. The two tabs on the right are for course members. But you could get for free the data and the daily wealth tab. And it's kind of a great way to see, the data that I'm putting together. So, okay, what else?
Maybe you've got to wait until December in early next year. Is today too early, Subhadra, to make that call to NQT?
It's not too early, but I wouldn't be surprised if they decide that they want to wait. I mean, I don't see the rush either. I mean, yes, you are seeing some pressure on the repo markets. You are seeing the availability of collateral go up because there's been a lot of bill supply. The Fed could quite proactively engage in ending QT, but they can potentially employ other tools like temporary open market operations to allay some of the fears in the repo market and perhaps have a later start. Either way, the way I look at it is it's $5 billion or so in treasuries that they're running off their balance sheet every month, which is really a small amount. So if they end it, I don't really see that as a big market moving event. What it will do is help allay some of the fears in the repo market potentially.
Explain, Bob Michael. We need to do this, folks. It's a course here on the Fed Decides. Treasury Bill 101. We have more debt than God. The Secretary of Treasury has made clear he's comfortable with Treasury bills. Should our audience worldwide be comfortable that we're going to have massive issuance of Treasury bills in the coming quarters?
I don't think they should be concerned about it. When you look at money that's in cash, you can look at a narrow measure of money market funds, or you can look at a broader measure of M2, which includes deposit balances, checking accounts, and so on. There's a lot of money sloshing around in the system, and if Treasury bills cheapen up a little bit, that money will circle into it. There are also other things that could happen. One, stablecoin is growing wildly in the U.S.
Stablecoin singular? Yeah, good one, bro.
So you have a natural buyer base forming there, and nobody's talked about relaxing the SLR calculation for banks and removing treasuries from the denominator. The Treasury can do that. So you can even create larger buying pools for the front end of the Treasury market than what exists now.
I got to rip up the script here. It's too important. Richard Portis and his leadership at London Business School. I spoke to Professor Portis today. He has great concern about stablecoin. Your bank is known for a cautious approach here. You've amended that. But should we have worries when we study stablecoin, or can we say it's removed from the things John owns, Ethereum?
Oh, keep in mind that QT, ending QT could drive yields down, right? So keep this in mind. Like, I'm going to write this. Ending QT could drive yields down, less selling pressure on bonds. But if Powell goes if Powell goes bullish on economy and uncertain on future rate cuts, I still see, 10-year 4.05. Could be wrong, but we'll see. So it wouldn't surprise me to see QT, they announced the end of QT at 11. So that could be a potential trade moment, right? Trade moment. QT could tank yields until Powell talks, then back up, right? QTN. So little in between thing to consider there when it comes to trades, if you're actually trading it. So as far as this, I think this is very interesting around private credit. Alarm bells going off regarding private credit, says Andrew Bailey of the Bank of England. All right, Bank of England. Then you've got IMF warns that US and European banks have 4.5 trillion in exposure to non-financial banking institutions. I think that's what it stands for. Non-financial banks. And that stress tests do not cover the bankruptcy of banks in IMF tests, and stress tests don't provide enough reserves if non-financial banking products, asset values crater. So, where was it? There was, let me actually go to, let's see here. That was that. Where was that IMF piece? That was here. Yeah, that was freaky. So the statement comes out in a few minutes there from Powell, so we're going to be ready for that. But here's the IMF piece. Private credit alone. Banks are increasingly lending to private funds because they can deliver higher returns. Right. IMF report indicates banks are lending to NFBIs, which can then lend to, hedge funds, private credit, through the regulation, essentially, without properly accounting for, the risks to capital / falling collateral values. IMF calls, they literally say here, the results suggest that the impact on the bank's solvency ratios could be substantial. And it was the footnote. Where was the footnote? Is the footnote over here? I gotta get that Financial Times piece. The Financial Times piece was perfect on this. Financial Times. Bummer. I think I closed it. Oh well. Oh, wait. Yeah, no, this was where we talked about the Andrew Bailey. Right, okay. 4.5 trillion. Lending capacity, losses first, deposits safe. Yeah. Where there was another piece on this. We'll find it, but we'll go through the Fed and everything in a bit first. But we just went through all of that. All right. We'll wait for the Fed statement now.
He's going to get his slew of questions from everyone, including Mike McKee. So the press conference will probably at least run 30 minutes or longer. He might get into the details on QT if they do announce QT. So
I found it. Okay. Yeah. So we'll go through more of that summary in a bit. But for right now, we're going to have the actual Fed piece come out. So this is actually a big moment because, first of all,
you are not prepared.
Yeah. But now we're going to get actual Fed decision. So this is going to go really fast, okay? I'm not going to be able to type it all out. but I'm going to read this all out as quickly as I can. I'm just going to put up the cues here. And I'm going to read this all out as quickly as I can. So, buckle up, boys and girls. 15 seconds for the Fed decision. Let's see if they end up cutting, ending QT. Quantitative tightening is the vacuuming up of money. Sucking money out of the economy, right? All right, ready? Okay, Fed cuts overnight rate. 25 BP says downside risk to employment rose in recent months. Available indicators indicate that economic activity expanded at a moderate pace. Job gains have slowed. Federal, consistent with these developments, economic uncertainty remains elevated. Inflation has moved up, remains somewhat elevated. Okay, attentive to risks of both sides of the dual mandate. The vote was 10-2, so 2 people wanted probably more. Myron wanted a half point. Oh no, Schmidt wanted no cut. 1 person wanted no cut. Fed to conclude balance sheet drawdown December 1st. Nailed it. QT ends December 1st. I told you it wouldn't be right away. I said within the next 60 days. Nailed it. Reinvest all mortgage-backed securities principal into treasury bills. Wait, so that means they're going to be buying. Oh, wait a sec. That's like a QE. Oh, that's bullish. Wait a sec. They're going to roll over the MBS principal payments into buying treasuries. That's more, that's like a form of QE. Dude, I gotta tweet that. Holy smokes. Fed just said they'll roll over MBS payments into buying treasury bonds. That's not only ending QT December 1 and cutting 25 BP, but basically buying bonds like QE days. Holy bullish. Wow. Now that part was unexpected. So that's very interesting to me. So, okay, let's listen in here.
Available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed this year, the statement says, and the unemployment rate has edged up but remained low through August. More recent indicators are consistent with these developments. They changed the tense on the balance of risks, noting...
Yeah, so again, QT to end DEES-1, I guessed within 60 days. Nailed it. Okay, good. Then we have, obviously we got the 25 BP cut. Minus 25 BP cut, that's not a surprise. And then we have the biggest surprise. I mean, this is like a huge surprise. Surprise. Fed will reinvest all mortgage-backed securities principal payments into treasury bills, aka so also known as aka they will buy treasury bonds just like they did during the QE days. So this is way more, which then makes you wonder, like, what are they concerned about, right? So, like, how concerned are they about labor, right? Because think about what they're doing here. We're getting minus 25 BEP, we're getting QT and DEES-1, and we're getting and QE on MBS rollover into treasuries. Okay? Like, I don't know about you, but it's somewhat kind of like, it almost sort of implies that they're like nervous or something, you know? So we also saw the decision was 10-2, but Schmid didn't want to cut at all. So that's interesting. 10-2 decision. Schmid wanted no cut. Myron 50 BP again, right? This is the second time he's pushing for 50. They say that Job gains have slowed. Job gains have slowed. They say that downside risks to employment rose in recent months. Downside risks to employment have risen in recent months. We have inflation has moved up earlier and somewhat elevated. Economic outlook, uncertainty remains elevated. I mean, this is all normal. Balance sheet drawdown. Okay. Yeah. Interesting. Okay, let's actually get the Fed statement. And we'll see if there's anything unique in the actual statement. But I'm somewhat surprised by this. Again, like, I'm confused. Like, I should feel bullish about it because it's bullish, because it's supportive of the economy, which means the Fed's hopefully not falling behind. But then it's like, going into from QT to QE without a pause, then it makes me wonder, like, what's going on? Like, what are y'all seeing? The sus eyebrows are going up. But at least there's still a coupon link below for today.
Coupon linked below.
All available indicators suggest that economic activity has been expanding at a moderate pace. Job gains have slowed. The unemployment rate edged up but remains low. More recent indicators are consistent. Inflation has moved up, remains somewhat elevated on inflation. Committee seeks maximum employment and stable prices. Uncertainty remains elevated. In support, we're going to reduce 25 BP. Not a surprise. That's what we expected. And then here it is. The committee decided to conclude the reduction in aggregate securities holdings on DIS-1. Well, where's that mortgage comment about them reinvesting it into mortgages? I guess they don't say it here. And these were where the votes were. Oh, here we go. Decisions regarding monetary policy. Okay, here we go. Unanimously to lower... Okay, let's see. Part of the policy decisions... Well, it wasn't unanimous. It was 10-2. I'm a little confused by that. Effective... Okay, that's fine. Overnight rate, fine. Roll over from the treasuries maturing in October, November that exceeds $5 billion. Redeem treasury coupon securities up to this monthly cap and treasury bills. To the extent that coupon principal payments from less than the monthly payments. Roll over all principal payments from Federal Reserve holdings or treasuries. Reinvest the principal holdings from MBS into treasury security to match the maturity. I mean, that's QE, man. That's disguised QE as reinvesting. Have I mentioned that my startup house hack has changed its name to Reinvest? It's mostly because, like, we want to reinvest our artificial intelligence product, which you can learn about here, into more real estate. So we're always asset backed, right? We launched this new website. It's the same company. It's HouseHack. You go to househack.com or reinvest.com. Make sure to read the offering circular. This video is not a solicitation, but we put our whole AI plan up here with AI notifications, the valuation wedge, the renovation wedge, selecting your markets. Like, it's a really cool product. If you want to invest, you can always check it out at reinvest.com. But I think it's funny because, like, at the same time, now the Fed is talking about reinvesting. I can't help but think about, my company, Reinvest. I'm wearing the shirt, Reinvest. Board of Governors voted to unanimously approve the decrease in rates. We saw that. Yeah, this is very interesting to me. This sort of disguised QE.
Committee into next year, even if you select a super dovish Fed chair, how hard would it be to get things your way?
It's a good point, John, because in practice, and I do it myself, the Volcker Fed, the Powell Fed, but it is a committee. It requires votes of the Federal Open Market Committee. Oftentimes inside the building, the power of the chair is the power of persuasion. persuasion. We've had some pretty persuasive Fed chairs, but there have been dissents. I think the key thing that we might start to see more of is dissents by governors. In the last 30 or 40 years, dissents really since Greenspan have been typically concentrated among the Reserve Bank presidents, and so that could also become a factor as well for the new Fed chair.
Rich, let's spend some time on this news conference. I imagine there'll be questions about what is guiding this interest rate decision, and for that matter, to Tom's point, what will guide the next one? Let's assume the government shut down. Rich, what is the data they can point to right now they're going to be leaning on, and how do they really flesh out their reaction function to non-traditional indicators? I think we're all familiar with how they respond to, say, non-farm payrolls, the unemployment rate, and CPI. But if you don't have that anymore, Rich, how do you communicate?
Well, it's tougher. There are alternative sources, ADP for employment and, the Billion Prices Project for prices. But I would agree, John, the further this goes on, the trickier it gets really to make an affirmative case, especially right now. Let's be honest, the justification here in September and now is really a risk management consideration. And, but let's be honest, that goes both ways. There's downside risk to the labor market, but there's potentially upside risk to employment. So risk management becomes trickier as well with little data.
Where are you seeing upside risk to employment? You're smoking crack, homie. Where is the upside risk to employment? Show me where all of a sudden employment's going to skyrocket. There's no upside risk to employment. Smoke another one, man. That is the dumbest thing I've heard. Upside risk to employment. That's upside risk to inflation, you knucklehead. Anyway, going back to this IMF report, which is bad. We have lenders with non-bank exposures worth more than their capital reserves now equal 40% of bank assets. That's from the FT, from the Financial Times piece here. And then banks are increasingly lending to private credit funds. We saw this. Private funds. Where were the other numbers? Because they had the 1 in 5. IMF estimates stock market is 10% overvalued. But that's below the 20% overvalued seen from .com bubble. Okay. Yeah. For that $4.5 trillion represents 9% of total loan books. And then they argued, I'm pretty sure it was that, from memory, somewhere around one in 20 banks wouldn't have the capital to cover these, these private loans going bad. I want to look at it because it's in here somewhere. Before, Powell will be out shortly, but I want to say it was right here. So let's see here. Here we go. Here we go. A few could face liquidity pressures. Some banks could face liquidity pressures. 4% of U.S. banks would lack liquid assets to cover the outflows. I mean, we could write that data down. So if NFBI stress, 4% of banks couldn't cover outflows, that's sort of like back to banking kind of crisis. Obviously, presumably the bigger banks would be fine. Presumably bigger banks fine, but per IMF report itself, the bigger banks have the greatest exposure dollar-wise to these private loans, these private credit issues. And so then it just becomes sort of a liquidity crisis. Bank stress shows that about 1%, let's see here, Silicon Valley stress test shows that global banks could incur valuation losses of 1%, CAT ratio 300 basis points fine. However, losses are much more meaningful for North American banks. Let's see here. Declines would be worse than stress tests. Yeah, we saw that. Okay. Here we go. 90% of lending to these intermediaries comes from large banks. Okay. 90% of the intermediary lending and NBFIs comes from large banks. And so basically it's a way to kind of get around regulation. IMO, the private credit bubble, is a way for big banks to get around regulation and capital requirements. Yeah, the results suggest the impact on bank solvency ratios could be substantial, especially because of falling collateral values. This is an interesting warning here from the IMF. U.S. banks with high NBFI exposure are more fragile than their low exposure peers, especially exposed to falling collateral values. Yeah, this is a great piece by the IMF. And it's really just sort of like writing the book. It's writing the textbook page of this private credit kind of bubble that we're in. The IMF is writing the textbook for the private credit bubble we're in. Powell's going to be out in 15 minutes, by the way. And then, of course, we've got our Fed bingo board already cooking. So Fed bingo board is ready. All this stuff I'm writing down, by the way, about the IMF and everything, if you want to see that very neatly put together, you could always kind of look at my data. Just download the Meet Kevin app. You could do it on an iPad, iPhone, Android, doesn't matter. Download the Meet Kevin app. The data tab, it's totally free. There's no cost for it. The daily wealth tab, totally free. There's no price, nothing on it. And you could see like the screenshots I put in here, the highlighting I do, the comments that I make on Powell. We've already got the Atlanta Fed GDP, that rise in the blue chip consensus in here, the actual Fed decision. I've already written those notes in here. So you can see that all in the Meet Kevin app, which I think is very convenient. And then, of course, course members can get the trade alerts, the 10-year stocks to buy on the Alpha report, the technical analysis, the fundamental analysis. The stocks have, like, we did a big fundamental analysis on Enphase this morning, a big landmine in Enphase's earnings call, by the way. We did a fundamental analysis on NEO, and we do them on, other companies, whether it's NVIDIA or Tesla as well. So very, very useful app. We put it all in that app too, because sometimes I see y'all complain in the chat. You're like, hey, I didn't get notifications that you were live for the Fed day or whatever. YouTube will only send you 3 notifications max in 24 hours. So in 24 hours, if I post 6 videos and number 5 is Kevin's live on the Fed, you won't get that notification. Even if you have the button all notifications turned on, you won't get it. But you can if the Meet Kevin app. You can customize which notifications you want in there too.
As well, and the ecosystems and entire communities in which they live. And now 1 in 4 children, you're talking about losing food stamps or the SNAP funding.
Right. Let's see if CNBC's got some stuff for us here.
Thanks a lot, Mike. Appreciate it. Of course, folks, we're just moments away from Fed Chair Jay Powell.
Yep, moments away from Powie Wowie. Powell
I'd
speaks
rather
in
place my
12
bets
minutes.
on cutting rates, and the 2-year is lower than the Fed funds rate. Does not happen often, especially in a rate cutting cycle. That 2-year should be above where the Fed funds rate is, and it's still lower. So I think
well, that's a sign of like concern and anxiety in markets that the bond market is trying to flush out, right? Let me see some other facts that are going on out here on the Fed. So I've got Richard Clarida, former vice chair, now at PIMCO, said you've got a pretty divided committee. Schmid, this is his first dissent, and he said in recent months that he sees strength in the economy, and we should lean against growth. Okay, so that is interesting. Schmid in recent months said we should, at Fed, lean against growth, aka higher rates, right? So that's an interesting division here. Sounds like a quite divided FOMC here. So hawkish dissent, was a surprise. Yeah. I agree with that. Bloomberg says the hawkish dissent was a surprise. I agree. In fact, when I first read it out, you probably saw or heard me say, oh, 2 people wanted 50. I thought 2 wanted 50 when I saw 10-2. We got 150, Myron, and 1-0. So that's interesting. Okay. The range now, for whoever cares, the range now is 3.75 to 4. And then statements maintain. What do we have here? Fed Myron voted against the decision in favor of lowering by a half point. We saw that. Yep. Government data releases almost completely stopped during the shutdown. Yep, we know that. But we know we're using ADP now for what it's worth. No real reply to that. Schmidt dissent makes me more confident that Jay Powell is going to push back on the December cut. Right. So, a doomer guy says Powell will push back against December rate cut. That's basically would be a version of being hawkish, right? That would be hawking a strong economy, basically. Yeah, sometimes I have typos in here because I don't use AI when I do this. And I want people to know that. Like when I put my data tabs together, I don't use AI because I want it to be from me. Like you don't have to go to the Meet Kevin app to get AI. You can get AI like a chatbot anywhere. The Q's still tenuous, kind of flat here. Tesla holding on to 460. Alt 5 scam is going down. I mean, we've been bagging on Alt 5 since it was $8, saying it was a scam. We even drew the support line at $1. We called the top on Beyond Meat between $6 and $8. It topped out at $7.60. That was in the Alpha report. Remember, you can get that at meetkevin.com. You pay once, get a tax write-off, probably, hopefully, talk to your CPA, and then you never pay again for the Alpha report, which is awesome. Fiserv keeps selling off, down 43%, now even lower than COVID lows, which is not great for that financial plumbing. And I think that's why you're seeing some continuous pain in some of those restaurant stocks as well, where there's a lot of exposure for Fiserv transactions. NVIDIA keeps booming, still up 3%. We've got MP Materials still down 36% from our top call in the Alpha report. Dude, that freaking nailed it, man. That call nailed it. Symbotic, another one we've been bullish on since $20. It's now at $72. Insane. Dude, how's it up 6% today? It's kind of remarkable. Q's nervous, though. Everybody's nervous for Powell.
This is how the markets want things to go. Right. So you're the market's representative and not the central bank representative like Richard Fisher is. What exactly is your response?
I'm happy to change places with you.
No, I'm sure you are, Richard. I know you are, Richard. So, Steve, let's respond to Richard right now. Given what you said, then how he responded, what exactly is the market reconciliation with the economy and some of the pros and cons that we've seen in the absence of government data?
Right. So first, let me start off with, I always love hearing Richard's comments. I always value those. That's why he's on the network, and that's why he's been around for so long. So if you look at...
This is a reference to Richard Clarita, who now works at PIMCO, used to work at the Fed, right? Powell's going to be out in 7 minutes.
They would rather have lower, because they rely on that variable rate fluctuation, so they need lower rates in order to hire more. So I think we have to make sure...
Dude, it's going to take so long for rates to show up. Shout out to those of you who just joined the Alpha Report. Christopher, Roderick, what's up? They literally just joined within the last few minutes. Welcome aboard. And then, of course, everybody else here. Chris, Jeremiah, Santiago, Travis, Mark, Robert, Boris. Welcome aboard.
So that's been locked up for so many years now. And that golden rate that many feel it's a golden rate is 5.5% on a 30-year fixed mortgage. We saw this during COVID. People didn't buy up as much real estate as they probably wanted to, but they did refinance a lot, and they refinanced around 3%. So we have a huge percentage that are locked in their homes. Yep. If we can lower those rates. Now, this is where it comes in to tie it all in. If you stop QT and you stop the $35 billion of MBS per month rolling off the balance sheet, that has the single most upward bias on 10-year yields. So if you stop that, which they are, that gives the ability for that mortgage rate to drop, hopefully precipitously. I don't know if it will be as quick as homeowners would like it to drop.
It ain't going to be precipitous. Not unless the labor market falls off a cliff, which could happen.
A very tight labor market that we had in previous years, which motivated businesses to undertake CapEx and capital deepening and find efficiency gains. Many of the productivity gains I think that we are going to see are actually further in the future. But this stronger productivity story for the Fed, I think, is one which suggests that rates most likely should stay higher over a longer period of time, and that our star is eventually going to be higher as well.
Michael Ferroli will write on this on Friday. You have to think about it in real time as seen in yield. A given company, we're showing 30,000 a door. Another company, we're showing 14,000 a door, and on and on and on. How do you, with all your experience, treat 5-figure job reductions at America's finest companies?
Yeah, you accept that it's the economic reality. You accept that we're in the very early stages. You hope that new industries and businesses will be created off of the back of AI that will employ more workers.
That's going to take forever to happen, Mr. Bob Michel.
Sheet replace manual spreadsheets. We saw
2 first names. What is this? So you can identify as a woman half the time?
The Dallas Fed president was just wonderful on this the other day.
What did he say?
He said hope. He said just what Bob Michael said. It's one big academic hope by the haves that there's a good...
It's spelled Michelle. How is it Michael?
I think it's been absolutely brilliant on this. This is regressive up front. Can hold back employment. In the near term, I hope that changes. It can boost energy prices. Electricity in this country is becoming the political topic.
Agreed.
For the next 18 months. Now, the argument you've got to make is that's all going to change. Productivity picks up. Great. Fantastic. But in the here and now, isn't that a bit of a stagflationary story? If you strip out what is happening, say, with energy prices, electricity taking off, if you look at what's happening with labour market, holding back employment, isn't that a bit of a problem for this committee?
I don't think so. I think
somebody just donated $10 to say hit like all. Aw, thank you.
There's a problem.
Oh, no doubt. They've done that for 5 years.
But if there's...
Somebody else is talking about Michael Obama.
In and of itself will hold back some inflation.
We have 25,000 employees. You are the most qualified one I know to talk about electric bills.
Somebody's asking, why is the market melting? I mean, I don't think the market's melting. The Qs are fine. You know, this is just, you're basically flat. I mean, you're at 27 basis points. It's not a melt. But, you know, people are now expecting that Powell's going to come out a little hawkish because of that descent. You know, right now you're sitting at a 92% chance of a December cut. That's down about 6 points. So you're kind of seeing like, you know, you might end up getting a Powell here that's kind of like, all right, boys, we gave you a rate cut and we gave you some disguised QE, some easing, some stimulus. Now we're going to wait and see. You know, we might get some wait and see here. We're about 3 minutes away here from Powie Wowie. Woo!
Matt Lazzetti, Deutsche Bank. Matt, thank you, sir. Always good to hear from you. Matt Lazzetti there.
Johnny Blade says, like meet Jose. Cheers, buddy. Actually, you know what? I have Jose's favorite drink. Check this out. Hashtag not sponsored. Wish it was. Look at that. Oh, yeah, look at that. Oh, yeah. Topo Chico, straight from Mexico. Dude, Mexican food is great. And the water is very good, too.
What are the metrics? If we don't have the data, let's say the government's still shut down. What's
I
the
want
next
a
decision
burrito.
hinge on?
I think it's going to be anecdotal evidence from businesses if they're still in a pause higher and fire doing neither, then this Fed will respond by cutting rates 25 basis points.
What is your shop's 12-month call on 10-year yield? We're now, I'm going to say a 399, 398. John's in charge of that. I just look at the Dow Jones Industrial Average. John looks at all the rest of the data. But on the 10-year yield at a 399, what's your call 12 months out?
Well, let's start with Fed funds. We see that around 3 3/8%. I think you're going to see the 10-year somewhere around 3 3/4%.
Okay.
But Michael, JP Morgan, this was...
Dude, I got to get this soundboard.
Decisions actually hit the economy. The markets react almost instantaneously, right or wrong. But I thought that was a very good point. And we're just going to have to see how he handles himself here and what he says. And I expect him...
Is he going to be on time? Of course he's going to be on time, because it's going to be the first part of our bingo board. He usually comes out about 30 seconds in. So we got about 30 seconds before he comes out. And I got my pen ready to mark him. To mark this off, because it's my freebie on the bingo board. I am ready. Are you ready?
Bullish catalyst.
You are not prepared.
Taking the podium as we speak.
Good afternoon. Say it.
Good afternoon.
Yes!
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Although some important federal government data have been delayed due to the shutdown, the public and private sector data that have remained available suggests that the outlook for employment and inflation has not changed much since our meeting in September. Conditions in the labor market appear to be gradually cooling, and inflation remains somewhat elevated. In support of our goals and in light of the balance of risks to employment and inflation, today, the Federal Open Market Committee decided to lower our policy interest rate by a 1/4 percentage point.
You did more than that.
We also decided to conclude the reduction of our aggregate securities holdings as of December 1. I will have more to say about monetary policy after briefly reviewing economic developments. Available indicators suggest that economic activity has been expanding at a moderate pace. GDP rose at a 1.6% pace in the first half of the year, down from 2.4% last year. Data available prior to the shutdown show that growth in economic activity may be on a somewhat firmer trajectory than expected, primarily reflecting stronger consumer spending. Business investment in equipment and intangibles has continued to expand, while activity in the housing sector remains weak. The shutdown of the federal government will weigh on economic activity while it persists, but these effects should reverse after the shutdown ends. In the labor market, the unemployment rate remained relatively low through August. Job gains have slowed significantly since earlier in the year. A good part of the slowing likely reflects a decline in the growth of the labor force due to lower immigration and labor force participation, though labor demand has clearly softened as well. Although official employment data for September are delayed, available evidence suggests that both layoffs and hiring remain low, and that both households' perceptions of job availability and firms' perceptions of hiring difficulty continue to decline. In this less dynamic and somewhat softer labor market, the downside risks to employment appear to have risen in recent months. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer-run goal. Estimates based on the Consumer Price Index suggest that total PCE prices rose 2.8% over the 12 months ending in September, and that, excluding the volatile food and energy categories, core PCE prices rose 2.8% as well. These readings are higher than earlier in the year as inflation for goods has picked up. In contrast, disinflation appears to be continuing for services. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market and survey-based measures. Beyond the next year or two or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to lower the target range for the federal funds rate by a 1/4 percentage point to 3 3/4 to 4%. Higher tariffs are pushing up prices in some categories of goods, resulting in higher overall inflation. A reasonable base case is that the effects on inflation will be relatively short-lived, a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to ensure that a one-time increase in the price level does not become an ongoing inflation problem. In the near term, risks to inflation are tilted to the upside and risks to employment to the downside. A challenging situation. There is no risk-free path for policy as we navigate this tension between our employment and inflation goals. Our framework calls for us to take a balanced approach in promoting both sides of our dual mandate. With downside risks to employment having increased in recent months, the balance of risks has shifted. Accordingly, we judged it appropriate at this meeting to take another step toward a more neutral policy stance. With today's decision, we remain well positioned to respond in a timely way to potential economic developments. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. Policy is not on a preset course. At today's meeting, the committee also decided to conclude the reduction of our aggregate securities holdings as of December 1. Our long
That's
stated
because he said the next rate cut isn't a foregone conclusion.
Reserves are somewhat above the level we judge consistent with ample reserve conditions. Signs have clearly emerged that we have reached that standard. In money markets, repo rates have moved up relative to our administered rates, and we have seen more notable pressures on selected dates, along with more use of our standing repo facility. In addition, the effective federal funds rate has begun to move up relative to the rate of interest on reserve balances. These developments are what we expected to see as the size of our balance sheet declined and warrant today's decision to cease runoff. Over the 3.5 years that we've been shrinking our balance sheet, our securities holdings have declined by $2.2 trillion. As a share of nominal GDP, our balance sheet has fallen from 35% to about 21%. In December, we'll enter the next phase of our normalization plans by holding the size of our balance sheet steady for a time, while reserve balances continue to move gradually lower as other non-reserve liabilities, such as currency, keep growing. We will continue to allow agency securities to run off our balance sheet and will reinvest the proceeds from those securities in Treasury bills, furthering progress toward a portfolio consisting primarily of Treasury securities. This reinvestment strategy will also help move the weighted average maturity of our portfolio closer to that of the outstanding stock of Treasury securities, thus furthering the normalization of the composition.
Stock's falling because he said go get the coupon code at meetkevin.com, expiring tonight.
Has been assigned two goals for monetary policy: maximum employment and stable prices. We remain committed to supporting our maximum employment, bringing our inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Nick.
Nick Timmeros of the Wall Street Journal.
Nick
Chair Powell, are you uncomfortable with how market pricing has assumed a rate cut is a foregone conclusion at your next meeting?
Well, as I just mentioned, a further reduction in the policy rate at the December meeting is not a foregone conclusion, as I've just said. So I would say that that needs to be taken on board. We had, just say this, 19 participants on the committee. Everyone works very hard at this and takes their obligations to serve the American people very seriously. And at a time when we have tension between our two goals, we have strong views across the committee. And as I mentioned, there were strongly differing views today. And the takeaway from that is that we haven't made a decision about December. And, we're going to be looking at the data that we have, how that affects the
This is him hawking because he's kind of bullish the economy. It's just a weird balance.
You and some of your colleagues have framed last month and maybe today, I won't put words in your mouth, there's a risk management exercise. At what point do you conclude that you've taken out enough insurance? Are you looking for some kind of improvement in the outlook, or could this unfold along the lines of last year, where you made a sequence of adjustments and then waited to gather more information?
So the way I've been thinking about it is the risks to the two goals. For a very long time, the risk was clearly of higher inflation. And then that has changed now. And as we saw particularly after the July meeting, we saw the downward revisions in job creation, we saw a very different picture of the labor market, and suggested that there were higher downside risks to the labor market than we had thought. And that suggested that policy, which we had been holding at a I would say modestly, other people would say moderately restrictive level, needed to move more in the direction over time of neutral. If the two goals are sort of equally at risk, then,
look at that.
Then you ought to be at neutral.
Dude, I predicted 4.05. Wow.
To cut. So if that got back into balance, then you'd want to be roughly at neutral. So in that sense, it was a risk management. And I would say the same about today, sort of the same logic. But as I mentioned, going forward is a different thing.
Claire. Claire Jones, Financial Times. Thank you for taking this question. We've just heard from you that the discussion in December and the conclusion of the discussion is not a foregone conclusion. I'd like to just dig into that a little bit more about what sort of arguments were brought up. Was there any?
I need to go vomit.
Instance of the investment we're seeing in AI and some of the generation of household wealth through rises in stock prices related to the AI boom? Thank you.
I wouldn't say that's a factor in everyone's assessment of the economy. I wouldn't say it's the driving factor. I don't think for anybody. I guess I would say it this way. Once again, I would just point out that we have the situation where the risks are to the upside for inflation and to the downside for employment. We have one tool. It can't do both of those. You can't address both of those at once. You've got a very different situation. So you have some people have different forecasts, right? So they'll forecast faster or slower progress on one or the other. And they also have different levels of risk aversion. And, some will be more averse to inflation overruns, and some will be more averse to underruns of employment. And so you put that together, and as you can see from the SEP and from the public discussion that goes on between the meetings when more participants go out and talk, they're very disparate views, and they were reflected in strongly differing views in today's meeting, as I pointed out in my remarks. And that's what leads me to say that, that we haven't made a decision about December. I always say that. It's a fact that we don't make decisions in advance. But I'm saying something in addition here, is that it's not to be seen as a foregone conclusion. In fact, far from it.
Can I just ask a quick follow-up on QT? How much of the fund impressions we've seen in money markets are related to the U.S. Treasury issuing more short-term debt?
That could be one of the factors, but the reality is we've seen, the things that we've seen, higher repo rates and federal funds rate moving up. These are the very things that we look for. We actually have a framework for looking at, what the place we're trying to reach. What we said for a long time now is that when we feel like we're a bit above what we consider a level that's ample, that we would freeze the size of the balance sheet. Of course, reserves will continue to decline from that point forward as non-reserve liabilities grow. So this happened, some things have been happening for some time now, showing a gradual tightening in money market conditions. Really in the last, call it 3 weeks or so, you've seen more significant tightening, and I think a clear assessment that we're at that place. The other thing is, the balance sheet is shrinking at a very, very slow pace now. We've reduced it by half twice, and so there's not a lot of benefit to be holding on to get the last few dollars because, again, the balance sheets, the reserves are going to continue to shrink as non-reserves grow. So, there was support on the committee as we thought about it to go ahead with this and announce effective December 1 that we will be, freezing the size of the balance sheet. And the December 1 date gives the markets a little bit of time to adapt.
Colby. Thank you. Colby Smith with the New York Times. So much of the rationale for cutting interest rates, even as inflation moves away from the 2% target, seems to be, that there are these mounting downside risks to the labor market. But if those don't materialize and the labor market either stabilizes around current employment levels or even starts to strengthen somewhat, how would that change your perception of how much interest rates need to fall from here? Would you then be a bit more concerned about underlying inflation and the possibility of second round effects from tariffs?
Yeah, I mean, in principle, if you were to see data that suggested that the labor market's strengthening or even that it's stabilizing, that would certainly play into our decisions going forward. So, we do have, we get some data. The labor market is a place where we get, for example, we get the state level data on initial claims, which are sending a sort of a signal of more of the same. We also get job openings. And we'll get lots of survey data. We'll get the Beige Book and things like that. So we'll have a picture of what's going on in the labor market, and the fact that we're not seeing an uptick in claims or a downtick really in openings suggests that you're seeing maybe continued very gradual cooling, but nothing more than that. So that does give you some comfort.
But if this shutdown lasts a while longer and you don't have that data in hand, I'm just wondering how that hinders the committee's ability to assess the state of the labor market and make the right policy decisions, and also how much is that factoring into the debate about December?
Yeah. So we get like I mentioned what we get in the labor area. We get some data in inflation, some data in economic activity. And we'll have a picture of what's going on. We also will have the Beige Book again. I would say we're not going to be able to have the detailed feel of things. But I think if there were a significant or a material change in the economy one way or another, I think we'd pick that up through this. So in terms of how it might affect December, it's really hard to say. December's the meeting's like 6 weeks away. We just don't know what we're going to get. If there is a very high level of uncertainty, then that could be an argument in favor of caution about moving, but we'll have to see how it unfolds.
Steve.
Steve Leisman, CNBC. Mr. Chairman, can you characterize the meeting in terms of, you said strongly differing views. Was this a close call, this cut, or was it a close call maybe the other way because you had dissents on both sides? Thanks.
So I was referring to the discussion about, to the extent it related to December. You saw we had 2 dissents, one for 50 and one for no cut. So, that was a strong, solid vote in favor of this cut. The strongly differing views were really about the future. What does that look like? And I think people are saying, they're noticing stronger economic activity. Forecasters generally, broadly, have raised their economic growth forecasts for this year and next year, in some cases quite materially. In the meantime, we see, a labor market that's kind of, I don't want to say stable, but it's not clearly in motion. It's not clearly declining quickly in any case. It may be just continuing to gradually cool. And again, people have different forecasts and expectations about the economy and different risk tolerances, and so there's you read the SEP, you read the speeches, there are differing views on the committee, and to the point where I said what I said.
And just to follow up on the balance sheet, if you stop it, the runoff now, does that mean you have to go back to actually adding assets sometime next year so that the balance sheet doesn't shrink as a percent of GDP and become a tightening factor?
So you're right. The place we'll be on December 1 is that the size of the balance sheet is frozen. And as mortgage-backed securities mature, we'll reinvest those in Treasury bills, which will foster both a more Treasury balance sheet and also a shorter duration. So that's what In the meantime, if you freeze the size of the balance sheet, the non-reserve liabilities, currency, for example, they're going to continue to grow organically. And because the size of the balance sheet is frozen, you have further shrinkage in reserves. And reserves is the thing that we're managing.
So as I promised before the Fed meeting, I executed our strategy. I sent a trade alert for those of you in the Alpha report. Remember, you get lifetime access if you're part of that at meetkevin.com.
You want to start reserves to start gradually growing to keep up with the size of the banking system and the size of the economy. So we'll be adding reserves at a certain point, and that's the last point. Even then, we didn't make decisions about this today, but we did talk today about the composition of the balance sheet, and there's a desire that the balance sheet be right now it's got a lot more duration than the outstanding universe of Treasury securities. And we want to move to a place where we're closer to that duration. That'll take some time. We haven't made a decision about the ultimate endpoint, but we all agree that we want to move more in the direction of a balance sheet that more closely reflects the outstanding treasuries, and that means a shorter duration balance sheet. Now, this is something that's going to take a long time and move very, very gradually. I don't think you'll notice it in market conditions, but that's the direction of things.
Janelle.
Janelle Marte with Bloomberg. How are officials interpreting the latest CPI report? So some components came in lower than expected, but core inflation was still at 3%. So at this moment, what are you learning about the drivers? And also, do you view that the risks are greater that the Fed makes a mistake on employment or inflation?
So the September CPI report, we didn't get PPI after that, which is important for translation into what we look at, which is PCE inflation. But we can still make a pretty good assessment of what that will be. When we get PPI, there might be some adjustments. But so directionally, it was a little softer than expected, and we always break it down into the three components. So basically, you've seen goods prices increasing, and that's really due to tariffs. And that's compared to a longer run trend of very, very mild deflation in goods. So that's moving inflation up. On the other side of that, good news that housing services inflation has been coming down and is expected to continue to come down. So if you remember a couple of years ago, that's the one that we kept expecting it to do that. Now it's been doing that for some time, and we expect to continue that. That leaves the biggest category is services other than housing services. And that's kind of been moving sideways over the last few months, but a significant part of that is non-market services, and we don't take a lot of signal about the tightness of the economy from that. So if you add all that up, a couple things to say. One is that inflation away from tariffs is actually not so far from our 2% goal. We estimate, people have different estimates of what that is, but it might be, 5 or 6 tenths, and so that if it's 2.8, then core PCE, not including tariffs, might be 2.3 or 2.4 in that range, something like that. So that's not so far from your goal. So that we look at that, and the thing about tariff inflation is the base case is that it will come, and it probably will increase further. But it is that it will be a one-time increase. And, we've been very focused for all of this year at making sure that that's the case and thinking carefully about what are the pathways through which it could become something else, troublesome inflation. One of those would be, a really tight labor market. We don't see that. Another could be inflation expectations moving. We don't see that. So I think, we're watching this very carefully. I think it's not the case that we're just assuming that it's going to be a one-time inflation. We understand fully that this is a risk we have to monitor and ultimately manage.
With the stubborn in services inflation, what are some of the things that the Fed could do to address that, and especially when we're seeing potentially labor supply challenges?
Sorry, say the first.
The stubborn services inflation that you mentioned.
Services inflation, yeah. Well, again, the part of services inflation that isn't coming down as we would like it to is the non-market part of non-housing services. And overall, that's just something that we expect will come down. The non-market part of it should come down. It largely reflects higher stock prices and financial services that are imputed rather than actually paid is a big part of that. But also just, we think policy is still...
Market goes green again.
That's the kind of thing that should lead to a gradually cooling economy. That's one of the reasons you see a gradually cooling labor market, is because the Fed policy is modestly restrictive. So that should also help get that. I want to say, though, we're absolutely committed to returning inflation to 2%. If you look at longer-term surveys or market pricing, you will see that's a credible commitment, and there should be no question that's where we're going.
Chris.
Great, thank you. Chris Rugaber at Associated Press. So there's a big investment boom in AI infrastructure right now, as you know, and wondering if the existence of such a boom would indicate that rates are not that restrictive after all, and could further rate cuts at this point perhaps fuel an excess level of investment there or market bubbles. How is the Fed thinking about that?
So I don't think that the...
Let's go, Steve.
You're right. There are a lot of data centers being built and other investments being made around the country and around the world. Big U.S. companies are just investing a lot of resources in thinking about how AI, which will be based on those data centers, run through those data centers, is going to affect their businesses. So it's a big deal. I don't think that the spending that happens to build data centers all over the country is especially interest sensitive. It's based on longer run assessments that this is an area where there's going to be a lot of investment and that's going to drive higher productivity and that sorts of things. I don't know how those investments will work out, but I don't think they're particularly interest sensitive compared to some of the other sectors.
Yeah, totally
And then
agree.
just a quick follow-up. You mentioned that you do have data that you're looking at for inflation and growth in the absence of government data. Could you give us a sense? I think we know a lot about the jobs data that's out there. Can you give us a sense of what you're looking at to track inflation in the absence of government data? Thank you.
So it's a lot of things, and it doesn't replace government data, but all of these. I'll just mention some of the many names: Price Stats, Adobe, and others.
It's Adobe retail sales, not Adobe stock. Also, the odds of a December rate cut fell to just 74% now.
You're going to ask about spending at some point. There are lots of other things that we look at, but it's many different sources, and again, including what we get out of the Beige Book, which will be sort of come out mid-cycle as always. And it doesn't replace the government data, but it gives us a picture. Again, I think if something material were happening, if there were material developments, I think we would pick that up. I don't think we'll be able to have the very granular understanding of the economy while this data is not available.
Howard.
Howard Schneider with Reuters. Thank you. I just wanted you to elaborate a little bit on what you said a moment ago about the continued shutdown, making it more difficult to make a move in December, and that may make you more cautious. To the degree you are relying on private data that isn't the gold standard, or that you're relying on your own surveys or the Beige Book, do you worry at some point you're going to have to start making policy by anecdote?
This is a temporary state of affairs, and we're going to do our jobs. We're going to collect every scrap of data we can find, evaluate it, and think carefully about it. And that's our jobs. That's what we're going to do. If you ask me, could it affect the December meeting? I'm not saying it's going to, but yeah, you could imagine that what do you do if you're driving in the fog? You slow down. So that could or could not. I don't know how that's going to play into things. We may get the data may come back, but there's a possibility that it would make sense to be more cautious about moving. I'm not committing to that. I'm just saying it's certainly a possibility that you would say we really can't see, so let's slow down.
As a follow-up in the debate on this meeting, we saw recently some pretty big layoff announcements coming from Amazon and others. Wondering if that figured into the discussion at all, that you're starting to see this tension between growth and employment starting to be resolved, to the detriment of employment. And secondly, some of the stress is starting to appear in the bottom spur of the K, as they call it, household health premiums that are going to possibly be going up quite substantially, things like that. Has that started to become a factor in your policy discussion?
So those are both things that we're watching very, very, very carefully. To start with the layoffs, you're right. You see a significant number of companies either announcing that they are not going to be doing much hiring or actually doing layoffs, and much of the time they're talking about AI and what it can do. So we're watching that very carefully. Yes, it could absolutely have implications for job creation. We don't really see it in the initial claims data yet. Now, it's not a surprise that we don't. It takes some time for it to get in there, but we're watching that really carefully. But again, don't see it yet in the initial claims data. On the K-shaped economy thing, I would say the same thing or similar thing. We are. If you listen to the earnings calls or the reports of, big public consumer-facing companies, many of them are saying that there's a bifurcated economy there, and that consumers at the lower end are struggling and buying less and shifting to lower-cost products, but that at the top, people are spending at the higher income and wealth, and so much. Anecdotal data on that, and so we think there's something there.
Edward. Thank you, Edward Lawrence with Fox Business. So, Mr. Chairman, I want to take another crack at the further reduction of rates is not a foregone conclusion. So in December, he said, far from it. So if a cut might not be on the table for December because of lack of data, what does the other concerns then stem from? So if it's not lack of data as the reason December is not a foregone conclusion, what other things could be the concern then? Well,
the perspectives of people on the committee that, we've now moved 150 basis points, and that we're down into, you're into that range between 3 and 4 where many estimates of the neutral rate live in that 3 to 4% area. You're there now. You're above the median number for the committee, but I think there are people on the committee who have higher estimates of the neutral rate, and that's you can argue these positions since it can't be directly observed, the neutral rate. So, I think for some part of the committee, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether in fact the growth. That the stronger growth that we're seeing is real. Ordinarily, the labor market is a better indicator of the momentum of the economy than the spending data. That's the lore. In this case, that gives a more downbeat read. So people just have, again, we've cut 50 more basis points in the last 2 meetings, and there was a sense like, let's pause here, kind of thing. And a sense from others wanting to go ahead, but that's why I say differing views, strongly differing views.
So on that division, then you're talking about going forward. So what's more important in this division? Is it inflation risks? Is it employment risk? Or is there a deeper philosophy division among the board?
Look, everybody on the committee is deeply committed to doing the right thing to achieve our goals, maximum employment and stable prices. You have differences on how to do that. And as I mentioned, some of that is different forecasts, but a lot of it is also different risk aversions to the different variables, which is common through all Federal Reserves. People just have different risk tolerances, let's say. So that leads you to people with disparate views. You will know that from the speeches you've been listening to from my colleagues. And so we're at a place now where we have, in fact, cut 2 more times. And we're 150 basis points closer to neutral, wherever that may be, than we were a year ago. And so there's a growing chorus now of feeling like maybe this is where we should at least wait a cycle, something like that. That's what it is. It's just what you think it would be. It's and again, you've seen it in the September Summer of Economic Projections. You've seen this in the public remarks of FOMC participants, and now I'm telling you that's what you can expect that in the minutes, and I'm just telling you that's what happened in the meeting.
Elizabeth. Thank you so much. Elizabeth Schulze with ABC News. What is your explanation for why the job market is weakening right now, and what will this rate cut do to improve the job market?
So I think there are two things affecting the job market, and one of them is just a dramatic reduction in the supply of new workers. And that's two things. That's declining labor force participation, which is a cyclical thing, and then there's declining immigration, which is just a big policy change that actually began in the last administration and it has been accelerated now. So a big part of the whole story is that supply side story. Okay. In addition, labor demand has declined, and the unemployment rate has gone down, meaning that demand for workers has gone down a little more than supply. So that's what's going on, but it is mostly a supply function. It's mostly a function of the change in supply, I think, and many people think. So the question then is, what does the our tool do, which supports demand, and and I would just say when you're in a situation where job creation, if you adjust for likely overcounting in the way that BLS does its work, is pretty close to zero. So maximum employment doesn't, on a sustainable basis, if you're creating zero jobs, if it's in equilibrium, if it's in balance, it's a pretty, as I said before, a pretty curious balance. So, I thought, and many of my colleagues thought, in fact, you've seen the last two meetings, that it was appropriate for us to react by supporting demand with our rates. And we've done that. We've reduced so that rates are looser. I wouldn't say that they're accommodative right now, but they're meaningfully less tight than they were. And that should help so that at least the labor market doesn't get worse. Though it's a complicated situation, and some people argue that this is supply and we really can't affect it much with our tools, but others argue, as I do, that there is an effect from demand and that we should use our tools to support the labor market when we see this happening.
You also talked about tariffs causing a one-time price increase. Should American household consumers expect that inflation will continue to go up this year because of those tariffs?
So the basic expectation is that there will be some additional increase in inflation because it takes a while for tariffs to work their way through the production chain and finally get to consumers. And we see this now from the tariffs that were put in place now many months ago. We see those effects, but if you put tariffs in effect, and they've been coming into effect consistently in February, March, April, May, and that's all happening. So that'll continue to happen for some time, probably into the spring. These are not big increases, though. These are a tenth or so on inflation. They may be big increases on a particular product that's been tariffed, but overall, these are fairly modest. I think some projections go, we're at 2.8% inflation. You might get 2 or 3 more tenths or 4 more tenths maybe. But then, as all of the tariffs are in, they stop generating inflation. You've had a one-time price increase. As long as you're not, at least this is the theory. This is how we believe and hope that it will work out. Once the last tariff is put on something, at that point, it becomes a higher price level, but it stops going up, if you will. Prices stop going up. They'll just be at that level, and then measured inflation will come back down to non-tariff inflation. As I mentioned, non-tariff inflation is not so far from 2% now. Now, consumers are not interested in that story. Their prices are higher. More than that, the reason they're so unhappy about inflation is the inflation that we had in 2021, 2, and 3. Because you can say that prices aren't going up as much, but that doesn't mean people aren't feeling those higher prices from the inflation we had 2 or 3 years ago. They are, and that's, I think, a large part of why the public, if you sample people, inflation is still very much making people quite unhappy. Even, and it's nice that that prices are not going up as fast as they were, but they're still much higher than they were, and it'll take some time for that effect to wear off as real incomes rise it will feel better over time, but that's going to take time.
Mike.
Michael McKee from Bloomberg Television and Radio. Do you have any concerns that equity markets are or are close to being overvalued at this point?
You know, we don't look at any one asset price and say, hey, that's wrong. You know, it's not our job to do that. We look at the overall financial system, and we ask whether it's stable, whether it could withstand shocks, right? So, you know, banks are well capitalized, while some households are clearly under stress. In the aggregate, you know, households are in good shape financially, relatively manageable levels of debt. At the lower income spectrum, you are seeing rising defaults, particularly around subprime auto, but nonetheless, in the aggregate, pretty good. You don't see too much leverage in the banking system or the financial system. It's a mixed picture, but it's not an overly troubling picture. And again, I'm not. It's not appropriate. You know, we don't set asset prices. Markets do that.
Well, you must be well aware that by lowering interest rates, you're contributing to additional asset price increases. And I wonder how you balance the idea that lowering rates would help the labor market with the reality that it seems more likely to be stimulating increased investment in AI, which is the rationale for thousands of job cuts that have been announced in the last few weeks.
Yeah, I don't think interest rates are an important part of the AI of the data center story. I think, you know, people think they're great economics in building these data centers, and they're making a lot of money building them, and they think they have very high present value and all that sort of thing. It's not really about. It's not you know, about 25 basis points here or there. You know, we use our tools to support the labor market and to create price stability. That's what we do. That's our two jobs, right? So we're here by lowering rates at the margin, that will support demand, and that will support more hiring, and that's why we do it. Now, no 25 basis point or even 50 basis point hike is going to be a dispositive thing, but ultimately, you know, lower rates will support more demand, and that'll support hiring over time. And of course, we also have to be careful about this, which is what we've been doing, because we know where inflation is, and we know that, you know, I've told you the story. It's a complicated story, but this is the best assessment that we can make. But you know, because there's uncertainty around inflation and the path ahead for inflation, that's why we're going. That's why the pace we're going has been a careful one.
Victoria.
Coupon linked below.
Hi, Victoria Guida from Politico. On AI,
soon.
I'm just wondering, you know, it seems like a lot of the economic growth that we've been seeing is fed by investments in AI. So how worried are you about what a sudden contraction in tech investment would mean for the overall economy? Is there enough strength in other sectors? And specifically, are there any lessons that you take from the 1990s in how you might approach what's happening right now?
Yeah, this is different. In the sense that the companies that are so highly valued actually have earnings and stuff like that. So if you go back to the 90s and the dot-com, these are ideas rather than companies, and you know so there's a clear bubble there. Whereas I won't go into particular names, but they actually have earnings, and you know it looks like they have business models and profits and that kind of thing. So it's really a different thing. You know, it's the investment we're getting in equipment and all those things that go into creating data centers and feeding the AI. It's clearly one of the big sources of growth in the economy. Consumer spending also, though, has been, you know, is much bigger than that and has been growing and has defied a lot of you know, negative forecasts, continuing to do so this year. Consumers are still spending. Now it may be mostly higher end consumers or maybe skewed that way. But the consumer is spending, and that's a big chunk of what's going on in the economy, substantially bigger than AI. You could point to growth. I mean, actually, you may be growth as opposed to level, but consumer spending is a much bigger part of the economy.
And why do you think that the labor market is slowing so much, even though consumer spending is strong?
Why has it slowed so much? Well, what's happened is that the supply of workers has dropped very, very sharply due to mainly immigration, but also lower labor force participation. So, and that means there's less need for new jobs because there isn't this flow into the pool of labor that, where people need jobs because there aren't those people now. So there's not a supply of workers showing up for jobs. In addition, demand has also gone down, and so has labor force participation has declined, which is more of a sign, in this case, of demand as well as trend. So I think you're seeing some softening. The economy's growing at a slower rate than it was, 2.4% last year. We think around 1.6% this year. It could have been a couple of tenths higher if not for the shutdown. And of course, that will reverse. But, you still got the economy growing at a moderate pace.
Andrew.
Hey there, Andrew Ackerman with the Washington Post. I wanted to ask if you could elaborate on how you think about policy in the context of the data drought. Does it make you inclined to stick with your plans as set out in September in the absence of the data that might change your mind, or does it make you inclined to proceed with added caution because of uncertainty?
Yeah, well, we'll know when we face that question, if we face that question. It'll probably be argued both ways, right? But I've said a couple times here that, if you really aren't getting information and you really don't know, and the economy looks like it's solid and stable and hasn't really changed, there will be an argument. I don't know how persuasive it will be, but there will be an argument that, you slow down when you can't see as far ahead. Others may argue, I'm not sure where this argument will come, but you're perfectly right that you could also argue, well, things haven't really changed, but you might not know that, So I don't know whether we'll face this or not. I hope we don't. I hope by the time of the December meeting we're getting, a better flow of data. But if we're going to have to do our jobs one way or the other.
Okay. I also just wanted to ask a FinReg question. I think several years ago you said the overall amount of capital in the system was about right. As the Fed moves forward with a revised Basel proposal, potentially changes to the GSIB surcharge, has that changed at all? Or are you planning to significantly reduce the amount of capital in the system? Thanks.
So there are discussions going on, I think, among the agencies, and I don't want to get ahead of those discussions. I continue to think that the level of capital, when I said that in 2020, was about right. And of course, there's been much capital added since then through various mechanisms. But I look forward to. I know those discussions are really just getting going. They haven't come to the point where they're got a whole plan and that kind of thing. So I really don't have much to say on that.
Brian.
Hi, Chairman Powell. Brian Chung with NBC News. Is the weakness in the jobs market accelerating, and who's at risk if the interest rate cuts are not the effective medicine for a further slowdown in the labor market?
So we do not see the weakness, as you put it, the weakness in the job market accelerating. I would say, then again, we didn't get the September employment report, payroll report, but we look at, the unemployment insurance claims, initial claims are reported at the state level, and we still get those, and we can accumulate them and get the national number. And there's really, there's no story. You can look at the numbers. Same thing with the job openings we get from Indeed. There's just no story over the last 4 weeks. It's kind of stable. So you don't see anything that says that the job market is, or really
stable?
Any part of the economy is making a significant deterioration. Don't see that. You see more things like I mentioned, though, which is you see big companies making announcements of either of layoffs or of the idea that they won't need to hire. Their number of employees is not expected to go up over a number of years. There may be different people working there. They say that too, but they don't need a bigger head count. So you see those kinds of things. You don't see it in the aggregate numbers. The layoff numbers have not gone up, but job creation is very low. And the job finding rate for people who are unemployed is very low. But the unemployment rate is very low as well. 4.3% is a low unemployment rate.
So as you make these cuts, is it the lower income workers that you're thinking about, or those who might have their jobs automated? Is there a particular
that we're
section
thinking of
the labor market that you're particularly?
So we can't, our tools don't allow us to target any demographic or any income level and that kind of thing. I do think that people, we saw this during the global financial crisis and the long recovery. If you have a long period of very strong labor market conditions, it benefits people at the lower end the most. The last 2 or 3 years of that long expansion, people at the lower part of the income spectrum were getting the biggest benefits, and lots of things were happening in that space demographically, which were very constructive. And we're not at that place right now. But so, a stronger labor market is the best thing we can do for the public. It's also part of our job. It is half of our job, but it is absolutely the best thing we can do for people. Along with keeping prices stable. Those two things. Inflation also hurts people on fixed incomes more than other people.
Courtney. Hi, Chair Powell. Courtney Brown from Axios. As you know, the 12 Reserve Bank presidents' terms are up for renewal at the end of February. I'm wondering if you can give us a timeline for when the board will consider those reappointments and whether we can expect everyone to be re-upped or if we can expect some changes.
So it's a process that we go through under the law. The way the law works is we have a reappointment process every 5 years for all of the reserve, each of them and all of them. We're in the middle of that process, and we're going to complete it in a timely way. And that's really all I can say.
Okay, thank you.
Daniel.
Daniel Davis, Agence France Presse. You've now had dissents in 3 consecutive FOMC meetings, but in this meeting you had dissents going in both directions, and you've just mentioned there's strong disagreement over the future path of rate cuts. Have these disagreements complicated your role presiding over the FOMC meetings, and if so, how?
I wouldn't say that, no. I think you have to take what comes, and what comes right now is a pretty challenging situation where we have, first of all, we have 4.3% unemployment. We have an economy that's growing close to 2%. So, overall, it's a good picture. It's a good picture. But in terms of our policy, we have upside risks to inflation, downside risks to employment. And this is a very difficult thing for a central bank because, one of those calls for rates to be lower, one calls for rates to be higher. We can't do both. So we have to balance the two. And so it's a challenging thing. And, as we have worked our way through this process, you would expect that there would be a range of views across the committee on what to do and the speed with which we should do it. And that's what we have. That makes a lot of sense to me. All of these people are people who take their jobs very seriously, work very hard at this, and just want to do what's right for the American people, but they have different views on what that is. And, it's an honor to work among people who care that much. It is, but I don't feel that it's unfair or anything like that.
Stick around, by the way, and we'll be covering earnings. Microsoft, Meta, Chipotle, I'll cover them all today.
I believe we'll get through this, and I think we've done sort of the right thing so far this year. I think it was appropriate for us to be careful about this. I think it would not be appropriate to just ignore or assume away the inflation issue. At the same time, I think the risk of higher, more persistent inflation has declined significantly since April. And if we do wind up resuming rate cuts at some point, we will at some point. I think we're trying to get to the end of this cycle with the labor market in a good place and with inflation, on its way to 2% or at 2%. So that's all we're trying to do, and we're doing it under, quite challenging circumstances and doing the best we can.
We'll go to Jennifer for the last question.
Last question.
Thank you so much, Chair Powell. Jennifer Schonberger with Yahoo Finance. Both regional and large banks have taken losses on loans given delinquencies on subprime auto loans. JP Morgan CEO Jamie Dimon warned, when you see one cockroach, there may be more likely.
Oh, here we go.
I'm curious how the
credit.
Fed is looking at these loan losses and
Go
if it
Yahoo.
poses risks to the financial system or the outlook for the economy. Is it a warning sign?
So, we're obviously we watch these things very carefully, credit conditions very carefully. You're right. You've seen rising defaults in subprime credit for some time now, and now you've seen a number of subprime credit, automobile credit institutions having significant losses, and some of those losses are now showing up on the books of banks. We're looking at it carefully. We're paying close attention. I don't see at this point a broader credit issue. It doesn't seem to be something that has very broad application across financial institutions. But we're going to be monitoring this quite carefully and making sure that is the case.
And then separately, many, you yourself have said that we're in a bifurcated economy right now with high net worth individuals continuing to spend with the lower income pulling back. How much of consumer spending continuing hinges on the stock market remaining strong? In some odd way, does the market help keep the economy buoyant?
So there's some relationship there, but remember, the more wealth someone has, the lower an additional dollar of wealth matters. So your marginal propensity to consume declines quite dramatically as you reach levels of stock market wealth. So, the stock market, it would affect spending if the stock market went down, but it wouldn't drop sharply unless there were quite a sharp drop in the in the stock market. People at the lower end of income and wealth have a much higher marginal propensity to consume of an incremental dollar of income or wealth, but they don't have the stock market wealth. So I think it's certainly a factor supporting consumption right now. But you would see it if you saw a material correction in spending, but it wouldn't be. You shouldn't think that it'll dollar for dollar stop consumption, because that wouldn't be the case. Thanks very much.
All right, time to do a full summary. We're also going to be covering earnings, so stick around for earnings. But let's get our full Powell summary in. Well, another Federal Reserve meeting in the books, and what Powie Wowie.
But he's a very talented guy.
Yep, we know. Thanks, Trump. Trump just came out of nowhere there. I was just putting down my cup of coffee. But anyway, what Powie Wowie just told us is frankly just bullish the economy. Now, we went into this meeting thinking that Powell was going to give us 25 basis points of cuts, that he would signal QT within 60 days, the end of QT, and that we'd probably end up seeing 10-year Treasury go up to 4.05%. I even sent trade alerts in the courses around this. And folks, what we got was incredible. We got 4.05 on the 10-year Treasury. We got 25 basis points of cuts. But we even got something a little bit more bullish. We got the vacuum cleaner of money will end on December 1st, and they're going to take extra money that is left over from mortgage maturities on their mortgage bond securities, MBS portfolio, and they're going to buy Treasury bills with that, which is not as bullish or stimulative as them going and printing money and buying every duration of Treasury bond, but it is a way of them reinvesting money into the economy. So it's what I call in disguise stimulus. So Powell's trying to put on this hard face of going, everything's fine. We haven't seen any real bad news yet, but they're really worried that the labor market could fall off a cliff. They're just not seeing it yet, which is exactly what we expected that the Federal Reserve would talk about. That the Federal Reserve would end up coming out, Powell would end up telling us, hey, we'll end up we're going to look what we wrote. We literally wrote that he would downplay private credit risks. Guess what he did? We ended up getting a downplay of credit risks. Labor at break-evens, he told us the break-even rate is basically zero. And what's the labor rate right now at with ADP reads? About 14,000. So that's essentially why we got the 10-year Treasury to 4.05. Not a surprise at all. Now, what did we get from Powell that's broadly bullish for this market? And why did I send out a buy the dip alert in the middle of the presser and in alignment with our plans in the Meet Kevin report? Because, well, frankly, Powell was broadly bullish, and this is exactly the MO of basically what happens every single Fed meeting. People get nervous before Powell comes out, they get nervous while he's talking, and they get bullish afterwards. That's why I sent the alerts I did, and remember, in case you want those alerts all of the time, get that Meet Kevin membership. All 8 courses, potentially a tax write-off, every trade alert, the top 10 stocks to buy, every alpha report every morning. Use that coupon code SchumerSiesta. It expires tonight. We'll be raising the price.
Coupon linked below.
So, with that said, what did we get specifically out of Powell today? Well, we actually got bingo. Barely. Right at the end, we got bingo. We got inflation outside of tariffs nominal. Yes, we already know that. In fact, he gave us a number. He thinks that inflation is sitting at about 2.3 to 2.4% outside of that one-timed longer-term effect of inflation from tariffs. Once those tariffs feed through, no more tariff inflation. Talks about housing inflation continuing to come down, which is really a bullish anchor for inflation continuing to come down. It's really hard to argue that inflation is going to somehow second wave, and that's why I think over the next 10 years, well, probably 8 years from now, we'll see interest rates come down substantially over time. But no fall off a cliff on the labor market. And this is exactly what we saw in the ADP data that came out on Tuesday. This is why we talked about this. I even sent a special note to course members yesterday. I go, folks, that ADP report is going to have Powell go bullish on the economy today. Because the ADP report told us we're actually probably above break evens. Now, does that mean we might end up seeing the economy fall off a cliff with, a labor market that ends up driving substantially more layoffs, like we've seen with the announcements from Hewlett-Packard, Target, Walmart doesn't want to hire, Goldman doesn't want to hire, Amazon's laying off? Of course that could happen. But what did Powell tell us? He told us exactly what we thought he was going to say, that the labor market right now is in balance, and we're just not seeing that weakness show up in the labor market right now via unemployment claims or any kind of weekly data. That's one of the reasons why on our bingo sheet, I literally wrote stabilizing labor. And I wrote it twice over here. Break evens near 0. That was my prediction. That's what he said. We also wrote down stable, no cliff unemployment. We got all of those. We nailed all of those and got bingo across the bottom row there, which was great. Now, we didn't get a direct mention of the beverage curve, but he basically told us as much as what we needed to know regarding the components of it. So broadly, you got a bullish Powell here, an economically bullish Powell, and that's why one of the reasons during the meeting, we briefly saw the market sell off because Powell told us, hey, we don't know if we're going to have to cut in December. This is a way of Powell just being bullish about the market. In fact, right now, we only see a 67.9% chance of a cut in December. That plummeted from 92% chance before the meeting. We had a 92% chance of a rate cut in December before the meeting. That has now collapsed to just 67.9%. Now, he does say this could change, that layoffs are not in the initial claims yet, and they take time to show up, and that we're watching and monitoring these layoffs carefully. But right now, we're somewhere between 3 to 4%. Neutral is somewhere around here. We've already cut 150 basis points. There's no big reason to cut more now. This is why I said short-term bearish on mortgage plays and yields likely to go up after Powell. It's exactly what happened. It was in our playbook with course members in the Meet Kevin Alpha report. Now, Jerome Powell goes on to say that interest rates really don't affect data centers. And I hate this phrase, but he says this is different when he gets asked about AI spending today compared to the dot-com bubble. He says that in the dot-com bubble, we were spending money on ideas, and that today we are spending money on corporations with real earnings. And in fairness, if you compare back to Cisco, the earnings of Cisco were absolute trash in the dot-com bubble. And if you look at the earnings of NVIDIA with the margins that NVIDIA has, it's absolutely mind-blowing how different margins are today at companies like NVIDIA compared to Cisco back then. Now, does that mean we're not going to end up seeing a bubble? Not necessarily. At some point, the party will be over. But look at those margins at NVIDIA. A true financial analyst will look at these margins and go, holy smokes, that is the largest PP I have seen in my life.
Big PP.
56.4% on a chip designing company and a software company. NVIDIA doesn't even make the damn chips. They're just the freaking middleman. They come up with the designs, they send it to Taiwan Semi, and then they sell the chips directly to the end user. It's remarkable, and it's why they have so much freaking profit, and why I've raised my price target for NVIDIA for the near term. Now, do I think it's going to keep going for 10 years? No. That's why NVIDIA is not on my top 10 stocks to buy for the next 10 years. Do I have 7 figures of NVIDIA stock in my personal portfolio? And am I personally jumping up and down about the fact that NVIDIA has now crossed $207 per share? It's up another 3% today on a $5 trillion company. Hell yeah, my friends. Hell yeah. And I'll send you trade alerts when and if I finish trimming this puppy or keep trimming it or whatever I want to do with it. You'll get it in the Meet Kevin. Now, that said, what else did we get out of Powell? Well, we get, hey, that next cut in December is not a foregone conclusion. It's far from a foregone conclusion. That's what tanked the odds of actually getting another rate cut in December. Now, part of that is because we ended up getting Schmidt suggest that we should not be cutting rates at all. Myron, of course, Myron comes out, Donald Trump's shill bending the knee, although I've started to respect him a little bit. He comes out and says, hey, we need a 50 basis point cut. And so it's no surprise that you end up getting somebody else to counter that. So you get this, hey, we should have 50. You get somebody else going, we should have 0. We get 25. In my opinion, are we going to get 25 in December? Probably. We'll probably get 25 in December. Does Powell want to promise that now? No, of course not. But it's all going to come down to what we see in that weekly unemployment claims data, which right now we're not getting unemployment claims data because the government is shut down. So we'll wait and see when that actually comes up. That's why I say it's a bearish catalyst when the government actually reopens, because you're going to get that flood of data. Instead, you need to start coming to this channel every Tuesday freaking morning now. Why? Because what are you going to get Tuesday morning? Weekly ADP data. If you haven't been paying attention yet to the weekly ADP data, make sure you start paying attention. It comes out Tuesday. I also broke down the weekly ADP data in the data tab of the Meet Kevin app. So if you download the Meet Kevin app, you can see this data. I'll post it there pretty regularly. But here, as an example, on Tuesday, I posted the ADP announcement that the Fed was secretly getting this. Then they got rugged, probably because of Trump. Now they're just releasing it to everyone publicly. But anyway, 14,250 jobs. That's technically above the break even that Powell just forecast. So we would need to see a weakness to probably closer to 0 to really encourage more cuts. And so that's your forward-looking indicator now. Tuesday jobs data. We got to pay attention to every Tuesday now. And this is why, if you don't have it yet, download the Meet Kevin app. You get the data tab and daily wealth for free. Alpha Report and Stocks, that's obviously, for course members. That's, by the way, the same app. We're going to be building in the Reinvest AI in that same app, which will be really cool. And we'll probably rebrand it all over time, Reinvest. You can invest in my startup, our Reinvest AI product, if you want. You could learn more by going to reinvest.co or househack.com. It's the same company. HouseHack owns all of the AI technology. So if you're an investor in HouseHack, you're already in on this. You can always invest more if you wanted to. Go check out the offering circular. Go read about what we're doing with AI. You could read about our renovations. You could look at our real estate, the actual asset-backed real estate that we have. And then you could look at our artificial intelligence plans and our timeframes for this app as well, if you want to diversify into AI. I personally think you're buying in at a real estate valuation, because that's when we got the valuation done for the company, and that's what we're raising on. I'm buying more stock myself in it because I'm so bullish on it. But then again, I'm a biased CEO. There's risk with every investment. So continuing on, other notes that we have in the Meet Kevin app. Our tools support demand. It takes a while for tariffs to hit consumers. We have, once tariffs are in, they're baked in. We go back to 2% inflation. Consumers don't care. This still frustrates people. This is basically a way of saying that most people don't understand how inflation actually works. Prices feel very high, but inflation's actually doing really well, which is why the Federal Reserve can cut rates in favor of the labor market. Somebody just donated here in the chat to say there's a rumor Wells Fargo is going to lay off 20 to 40,000 workers. You have to remember, the biggest risk to this economy is that we do get a real sharp increase in layoffs that end up leading to a surge in unemployment claims and a true normalization of the Beveridge curve. Because if you get that, that's when you end up in an unemployment recession. That is the big risk. This is why I'm bullish on the market right now through government reopening. And I really hope we don't get a lot of layoffs between now and then, because once we start getting that unemployment claims data, things could really rapidly shift. I think a really big red flag for you should frankly be Fiserv. Fiserv is, in my opinion, a really big indicator of not just potentially false promises from the prior executive leadership, but also a sign of the consumer, right? The fact is that Fiserv processes upwards of 25,000 transactions per second. They are part of the financial plumbing of the United States banking sector. And for them to be plummeting, especially when they have high exposure to e-commerce, restaurants, and retail sales, is a sign that there is some weakening happening amongst the consumer. So it's no surprise you're seeing consumer-led companies sell off today, whether it's the Cheesecake Factory, other restaurants. Cheesecake's down 8% today. Macy's negative, Best Buy negative, Six Flags is down 9%. You could see the two-tiered nature of our economy literally in stock prices. Look at Six Flags down 9%, Dave & Buster's down 5%, Restoration Hardware down 4%, yet Nvidia up 3.4%. You see the two-tiered nature of the economy here. And if we continue to get these layoffs, we will have an unemployment crisis, and it will take a decade to get back. Is that going to happen tomorrow? Probably not. And that's what the Fed is reacting to right now. They're saying, look, we're going to insurance cut right now, but are we really worried about the employment market falling off a cliff right now? No, we're not. Okay, maybe that'll end up being a mistake. Are they worried about private credit? Well, maybe they should be, because the International Monetary Fund basically says we're in a freaking bubble. The International Monetary Fund says that stocks are at least 10% overvalued right now. Not as bad as it was during the dot-com bubble, where we had 20% level of overvaluedness. But the IMF is literally worrying about the amount of exposure that our big banks have right now to non-financial banks or non-bank financial institutions. And that if collateral values fall in private credit, hedge fund exposure, private credit exposure, and some of these subprime lending things like what we saw with First Brands and Tricolor, we could end up seeing bank solvency ratios get substantially hit and massive adverse scenarios to the US banking system, especially since 90% of all lending to these non-bank financial institutions is conducted by, not small banks, folks, large banks. That's a really big red flag. So there are serious risks. This is very important to understand. There are real risks. Massive risks in labor, massive risks in private credit. The only way we can really get accelerating off the ground here and sort of have that bulked landing, if you will, where like you're coming in to land the plane and then you're like, nope, just kidding, we're gonna go full throttle and we're gonna go up again. The only way you could get that is the labor market going up again. Even Powell says that. He says, look, the best thing we could do right now is support the labor market so we can actually stick that soft landing and come up off that ground. To me, I love the plane analogy. I literally have a video of me pulling off a plane analogy, just like what I've just described, in a $13 million jet. In a $13 million jet, I break out of the clouds, come in for a landing in Santa Barbara, and you see me throw the throttle full force in. This is the perfect analogy. Powell says we are flying in the fog right now. He uses those words, and he says you slow down when you're in the fog. So this is me flying a jet in the fog. And what we're hoping is that we can come out of that damn fog and we could see beautiful blue skies ahead. That's the hope. Are there problems? Private credit, weak labor. Absolutely there are problems. But watch my hand. You're going to see my hand go full throttle. That's juicing rates. You gas the economy. You juice rates. You go full throttle right before you land and hit the ground, and you take off again, baby. That's called a bulked landing. You don't want to land this plane. You want to keep flying the jet. That's what you want. You got a jet engine of the American economy. You don't want to bet against America. You want to go full throttle on this puppy, and you don't want to crash. So let's Let's see it here, baby. Runway 7 coming into Santa Barbara. Give me that full throttle, baby. Juice me. Oh, yeah, look at that hand go forward. And then what happens? Before your wheels touch the ground, you start flying again. This is literally the perfect analogy for our economy. We do not want to smack that runway. We want to go flying. Look how beautiful this is. That's what's on the other end of this. If we can get through this disaster, this, this like potential private credit risk or labor risk, we could go flying again. Look, I'm even overspeeding my flaps in this example here because we're just gonna fly hot, baby. And that's part of what we're seeing with real GDP estimates. I mean, look at the Atlanta Fed. This is the first time over the last month that we are actually starting to see the blue chip consensus for GDP forecasts climbing. The blue chip consensus has always been way below the Atlanta Fed GDP Now estimate, and it's now starting to climb. And so as long as we can climb out without smacking into the ground by hitting some kind of unemployment recession, we could be Gucci here. And for the near term, it's bullish. So I'm optimistic. I'm hopeful. I'm not like, oh, let's go all in on margin and, lever up. I'm cautious, but I'm cautiously optimistic. And I just hope we don't fall off a cliff with these layoffs. The risk is when some companies start laying off, you get the game theory, right? We talked about this the other day. You get game theoryism that happens with layoffs, where if one company lays off to pump their margins, other companies would be dumb not to lay off. And the problem is when everybody starts laying off, that's when you end up with the pooper dupers, because then the broad economy ends up suffering because consumers don't have money to spend anymore. That's the big problem and big risk factor and big danger. So with all of that said, make sure to go check out Reinvest. Check out our AI if you want. You can learn more about it all over at reinvest.co or househack.com. It's the same company. We've had the best fundraise month so far this year, I believe. We're well over 7 figures now for fundraising, which is a fantastic month for Househack and Reinvest here. And then, of course, check out the Meet Kevin Alpha Report. I think we actually might be having our best month on the Meet Kevin Alpha Report as well, because people are loving what we're doing in the Alpha Report. They're loving the buy-sell alerts. They're loving the setups in the morning for trading and, what to look for, even with fundamental analysis. Not just traders in there, but people who are like, Kevin, I want deep dive fundamentals. I don't want to sit here and do the fundamentals myself. I want somebody to just tell it to me like it is. That's what you get at meetkevin.com. So go check it out. Use that coupon code Schumer Siesta. Boom, that's the Fed.
Markets, both private equity and private credit, we're already seeing signs of some major asset pools that have got themselves into illiquid positioning because of significant investment in private markets, and
Correct.
They don't have any money. That was famously Harvard University back when they were getting, their donors were pulling back because it was going on campus. I think Yale's been talking about liquidating some of their private equity interests and the like. And that's usually the sign of overinvestment, and the liquidity will dry up and it will turn into sort of a liquidation cycle. That's my map. I don't think it has.
That's scary. The liquidity will drive up and turn into a liquidation cycle. That is bearish.
I think that's going to be at the foundations of the next kind of financial problem that we have in the United States. And
Say it.
Perhaps beyond the United States borders. But certainly, there's a lot of investment in that category. So I caution investors. I think if you have liquidity options, some funds, they allow a liquidity option. They'll give you a mark periodically on their private credit book, and if they allow a partial redemption and you don't see any degradation in the marks on the private pools, I would take advantage of that liquidity function, because I think you're going to be getting out at a better level than you'd be able to get out at in future quarters. So
wow.
I'm very focused on private credit.
Dude, he's saying get out now.
We'll follow that. There's certainly a lot of focus on it. You've given our viewers a lot to think about today, and
wow, dude. Gondlock says get out now, basically saying you're going to get the best price now if you get out of some of those risky leveraged positions. Wow. This is why I say, man, like, I get debt is really desirable when the market is booming because you're just making money with OPM, you know, other people's money. But dude, I just want, I try my best to be transparent in the best way I possibly can. House Hack has no bank debt. We have a fraction of bonds relative to the amount of capital and assets that we have. And I have no personal debt, which I'm really, really excited about. So that's rare for me. You know, I'm usually Mr. like, yeah, hey, yeah, mortgage up, baby. Give me some more debt. Leverage, baby. Nope, not right now. So I don't know. A lot of people say I'm early, including my wife. Everybody says I'm way too early all the time. Maybe, but that's not going to stop me from being cautious. We do have earnings coming up, too. This is going to be really fun. We're going to cover all the earnings, mind you. All right.
The key number to watch is CapEx. Meta last quarter raised the midpoint of its full year capital expenditures.
Go. Okay. What does it code automatic? Oh, we're fixing the parts of.
Earnings coming up in just a moment.
And they turned it into an agent that works right where you work. Normally you would read a book like that, you'd stick it on your shelf, you'd forget about it. Now it's sitting next to you, helping you the way Grammarly used to help you.
Shashir, your company is famously private. Any plans to go public? Is there an IPO in your future?
Nothing to announce now. We've long had the metrics to be able to do it, so it'll be the right time when we feel like we're at that moment, but not right now.
Stay tuned. That's what I hear you saying. Shashir, thank you so much for your time today. Really appreciate it.
Thank you.
Well, AI will be a huge topic after the bell today. We're about to get reads from Microsoft, Alphabet, and Meta. Our countdown closers tell us if they're getting in before 3 of the Mag 7s release their quarterly reports. And you don't want to miss tomorrow's show. Liz Clayman, she's going to be back with...
Dude, these earnings are going to be Hugo earnings coming out here. Huge. Nobody knows. Huge. Quite like these earnings that are about to come out. So we have Microsoft, Chipotle, Meta, then we have Google. Bro, oh my gosh, there's so many earnings. Can't even handle all the truth we're about to get. Somebody say Hugo Boss. Dude, I love Hugo Boss. Nobody knows Hugo Boss better than I do. I wish they'd sponsor me. That's okay. I'll just wear short shorts. Maybe the short shorts lead them not to want to sponsor me. You know, they're like, they see the short shorts and they're like, nah. Too sexy for our suits.
Getting their biggest bump higher in just about 4 months. 10 minutes until the closing bells here in New York, with an eye on tech earnings up ahead and a look back at the Fed meeting, Katie, that just was here. A 10-2 vote by the FOMC to cut its benchmark rate a quarter point. No surprise there, but a bit of cold water from Jay Powell on the prospects for a third consecutive cut starting in December. I'm Romaine Bostick.
And I'm Katie Greifeld.
And here is Jay Powell and what he had to say.
Ooh.
We continue to face two-sided risks. In the committee's discussions at this meeting, there were strongly differing views about how to proceed in December. A further reduction in the policy rate at the December meeting is not a foregone conclusion. Far from it. For some part of the committee, you know, it's time to maybe take a step back and see whether there really are downside risks to the labor market, or see whether, in fact, the growth that the stronger growth that we're seeing is real.
Not a foregone conclusion for that December cut, and you can see the market reaction really playing out mostly in the bond market. We saw the S&P 500 dip by as much as 0.6%. It has come back, though, to unchanged territory. Big tech powering ahead with NVIDIA, of course, in charge. But then you take a look at that 2-year yield, higher by 11 basis points right now. Remember, it was pretty much a lock that we were going to see another 25 basis point cut in December. That is not the case right now. That is the biggest move higher for your 2-year Treasury since since the summer. And you can see also that the small caps taking a hit as a result, Romain. The Russell 2000 down now by 1%.
Ken Shinoda, DoubleLine Capital Portfolio Manager, joins us right now as we kick you off to the close. And Ken, a lot of talk right now about the moves in equity markets, but a big move today, a surprising move, if you will, in the Treasury space, 11 basis points higher on a 2-year yield. What caught you by surprise?
Well, I think Powell put it really well. When you're driving in the fog, you might need to slow things down. And without...
Yeah, use Powell's line, baby. Use Powell's line.
Takes a potential cut, not necessarily off the table, but they're going to want to see some more data before they make their decisions.
Have you gotten any sense here, Ken, either from the statement today or the press conference, that the rate cutting cycle that everyone had pretty much priced in over the last couple of months here, that is still relatively intact?
I definitely think the rate cutting cycle is intact. It's just the speed at which they cut rates is going to be dependent upon the push and pull of inflation staying sticky and the labor market weakening. I mean, there's less people coming to the workforce, but as of now, unemployment rate's still low, and I think that's kind of holding the economy together. So they want to cut rates, but there are no race to.
No race to, especially you said that we need to see more data. The government still isn't open, so it's not like we're getting that official government data that might inform the path forward and might clear up some of that fog, Ken. I do want to talk about how you bring that into the portfolio. As Romain mentioned, you saw that big pop up in short end yields. And when you think about the curve overall, does this change your thinking?
No, we've been negative on the long end of the curve. We've viewed that fiscal risks, too much deficit spending could potentially hurt the long end of the curve. We're definitely more constructive on the front end, and even more so now with this rate move. I think it's given investors an opportunity to buy, some credit assets at the short end of the curve that have attractive carry and don't have to carry too much interest rate risk. So, I think maybe a buying opportunity on that front end of the curve.
And so we're talking about duration. Let's talk a little bit about credit risk here and go to the credit market, because you write in your notes, actually, that when you take a look at both investment grade and high yield, both of those asset classes, they're behaving more like the equity market right now. Ken, what exactly does that mean?
Well, they're definitely more correlated with the stock market. When stocks are doing well, credit spreads are usually come in, and credit spreads have come in a lot. Investment grade corporate bonds and high yield have had some great performance. Investment grade spreads are near, decade-long tights, even high yields in that same space. But I think the risks are a little bit lower in those two particular parts of the corporate credit markets. Where you're starting to see some signs of trouble in the last couple of weeks has been in bank loans, and we think pockets of the private credit markets where more of the risky borrowers have gone to over the last couple of years.
I am curious on that. I mean, Powell was asked about that, at least publicly. He does not seem to be concerned. And of course, we've asked pretty much every guest about this over the last few weeks, Ken. Is there a sense here that if there is indeed some material risk bubbling up, is that going to be confined? Or do we need to start talking about this idea of systemic risk contagion?
No, I think when people talk about systemic risk, I think about the banking system. And I think the banking system has done a good job cleaning itself up for the last 10, 15 years post-GFC. And then it's in a good spot. You could actually argue that they should be more aggressive in expanding balance sheets to help the economy go along. So I think a lot of this stuff's kind of moved off balance sheet. A lot of the risks are off balance sheet and in private pools of capital. So I don't think it's a systemic risk, but there's going to be a default cycle. I mean, there's borrowers that are going to default. Doesn't mean that there's, a million cockroaches out there. Everyone seems to be talking their own book these days with these cockroach analogies. But, I think just investors should tread cautiously, know that there is risk in, below investment grade credit and allocate it appropriately.
Well, it does seem like the war of words when it comes to the big banks versus what private credit firms are saying certainly continues, Ken. But to your point that we're going to see a default cycle, it sounds like you're preaching quality here, that you're not reaching down the risk spectrum necessarily.
With spreads as tight as they are and the credit curve so flat, meaning you don't get paid as much to take additional risk, we definitely like going to higher quality parts of the market. Agency mortgage-backed securities, they've done well recently, but, they're government guaranteed, quasi-government guaranteed, and they can give you some interesting downside protection. So we think you should look to kind of diversify away from corporate credit into other parts of the bond market.
I am curious, Ken, before we let you go, I just want to get your thoughts here on the, I guess, what is effectively the end of quantitative tightening. I mean, assuming they don't restart it up again here. Does that actually matter to you?
No, I think that they're doing that because it's, if they're lowering rates, ending QT is just another way to ease policy. You're also starting to see a little bit of stress in the repo market, so I think they want to battle that. It's not really going to change much for investors in mortgage-backed securities. On the margin, they're going to take the dollars that are coming back from their MBS book, they're going to recycle that into short-term treasuries. So I think it's kind of a minor event for the bond markets that I traffic in, and I think it's a good thing for those short-term repo markets.
Ken Shinoda, portfolio manager over at Double Line Capital, helping us count you down to the closing bells on the heels of that Fed meeting. But Katie Greifeld, all eyes right now looking ahead to a slew of earnings coming out in a matter of moments.
It's just wild. You think about how much we're packing into this afternoon. Of course, we'll see what the after hours trade is right now because, again, equities fighting back to go green.
Absolutely. Microsoft, Starbucks, Alphabet, Meta,
Starbucks
MGM,
too.
just a few of the names set to report after the bells here as the S&P straddles the line.
After the bells, there's only one bell. NASDAQ doesn't get a bell, they get a button. But we're about 1 minute away from El Bello. And yeah, I guess we'll get Starbucks too then. That'll be really entertaining. So, cool. I'm excited. Let me see the times for the question or for the earnings, and then we'll get the bell ready to cook here as well. So earnings times, earnings. Okay. All right. Well, I got them up. So we'll see them all here. Yeah, Chipotle, Microsoft, Meta, okay, and Starbucks. There's no better loan than a margin loan for 99% of you. Dude, what? $499 donation to say there's no better loan than a margin loan for 99% of you? Oh my gosh. What? Well, thank you. But holy smokes. All right, here comes the bell.
Again, it's a source of instability at the top of the index if it keeps racing and everything else is left behind. But for now, making it work through rotation.
All right, Meta and Microsoft at 405, Google 405, Chipotle 410, Carvana comes out as well today. ServiceNow comes out as well today, so we'll get to see ServiceNow. Wow, we have a lot of earnings to cover, including Starbucks. So this will be really fun.
Major averages hit record highs early in the session, then pulled back.
All right. Okay, so here we go. Oh no, did I screw this up? Oh, I did. Damn it. What the hell? For some reason, my Fed video is the old one. What the hell? Is it the same title, or did I screw up the title again? I don't know why. This is the second time that's happened this week. Fed. Oh, what the hell? Yeah, I screwed it up. Man, that's all right. We're going to get earnings here. That's all right. It's only been like 5 minutes. All right, no problem. All right, so we got about 3 minutes to go here. Yeah, there we go. There's my correct Fed video. Ah, I see what's happening. It's no longer sorting these by time. Oh, that's quite bizarre. I think there's like a Final Cut update or something where like it's no longer putting my most recent video at the top. Jerks. Oh, I have to do all that crap again. That sucks. All right, no problem. We have I'm just keeping an eye here on earnings. We have about 3 minutes for the earnings to come out, and then we're going to be going through those and covering those. Bummer. And okay, that's solved. All right, no problem. Fixed. RIP. Okay. So Microsoft, Chipotle, Meta. Okay, Alphabet just out. Google service revenue beats 87.05 versus 84.67. Google Cloud ended with 155 billion backlog, revenue 102 versus 99 expectations. We have operating income operating income missed. Operating income at Google misses 31.2 versus 32.11. CapEx increased CapEx at Google. We are looking at, that is an increase of, let's see. That's an increase of CapEx of 98. That's 92 midpoint versus about 84.5. And Google is increasing CapEx by about 9%. Holy smokes. That's actually pretty impressive on the CapEx side. So I'm just going to type earnings, Google. So we've got CapEx forecast up 9. And that is for fiscal year. Operating income missed by 3123 divided by 3211 by about 2.7%. And then YouTube ad revenue beat. Cloud beat, search beat, and other beat. So it's really across the beat on the top line, but they kind of missed on the operating side. So Google, how's Google moving? Google's up 5% on it. So Google's happy. Okay, Microsoft comes out with revenue of 77.67 beats, but the stock's going down. The estimate for Q1 revenue was 75, so they beat. Intelligent Cloud beat. And then Azure and other cloud revenue beat. I mean, this is an across-the-board beat at Microsoft, and it's falling. Google's increasing CapEx spend. Google is now up 7% as CNBC starts talking about it. And Microsoft's down about 4%. Okay. So, and there's no clear indication as to what the problem is at Microsoft. Meta comes out. Reality Labs, 470 in revenue versus 317. That's a beat. EPS, $1.05. EPS, Meta beats. Ad revenue, 50 billion versus 48.5. Operating income up 18% year over year, 20.5. And this is good. Family of apps revenue, 50.77 billion versus 49 billion expected. It's just a beat. One quarterly include one-time non-cash income tax charge of $15 billion. Q4 revenue comes in at slightly higher than expectations. So Meta's a beat as well. Starbucks, comp sales come in plus 1% versus the estimate of a decline of 0.48%. So Starbucks beats on forecast, but adjusted EPS misses. Comp sales up, though, is bullish. Even China comp sales are up. Carvana lifts their forecasts and revenue beats, 5.65 billion versus 5.11 bill. EPS 103 versus 64 cents a year ago, and their margin misses. EBITDA margin comes in at 11.3% versus 11.7 expected, but their EBITDA in total comes in at 637 million versus 598. So they're making good money. They're making dollar hollers. So let's see how some of those stocks are moving. So Microsoft now down 4%. Google is up 5%. Carvana is down 12 on that beat, but maybe the margin miss must be the only thing that's bugging them. Wow, that's a big move on Carvana. S-Bucks is up about 2%, which is pretty nominal. And then ServiceNow is pretty much flat because they haven't actually reported yet. And then how about Meta? Wow, Meta drops 8%. Let's listen in here.
52 cents adjusted versus estimates of 56 cents. Revenues, though, would beat $9.6 billion for the quarter versus the $9.35 billion estimated. And that's even with the labor investments that the company is making right now. Comps turning positive globally. Q4 comp sales up 1%, better than the 0.3% decline estimated. Q4.
Yeah, and China did really well too. Let me go to the Doomers for a second. China was like plus 2% on comp sales, which with the competition in China, that's really impressive. Let's listen to Meta here.
Deeper into it and try to get you some more details.
Yeah, we'll continue to follow that, but as Romain said, could explain some of the negative reaction that we're seeing right now. Meta shares now down by more than 7%. I do want to go to this line in the release. We have a lot of focus, of course, when it comes to CapEx. Meta, they expect full year 2025 total expenses to now be in the range of 116 to 118 billion. The prior outlook had been for 114 to 118 billion there. And they also say that our current expectation is that capital expenditures dollar growth will be notably larger in 2026 than in 2025. This has really been the story for a lot of these big seven names, but also for Meta particularly.
Sorry, I do want to go back to that tax issue here with Meta, and this is something that Zuckerberg and his team are going to have to address on the call. They talk about the One Big Beautiful Bill, basically the big budget stimulus that was passed earlier this year. They did say that they expect a significant reduction in their federal cash tax payments for the rest of the year because of that bill. However, they're saying that for the quarter that just passed, they had to recognize a valuation allowance change that basically amounted to a $16 billion charge. Again, they are saying that this is a one-time charge, and then effectively they will revert back to something actually a little bit less with regards to the effective tax rate for the current quarter, the current fourth quarter that we're in.
Yeah, the company continues on their...
Yeah, that $15 billion charge, I think, is what's hitting Meta right now.
$15.64 billion compared to the reported net income of $2.71 billion. The company also saying, Mark Zuckerberg specifically saying that leading the industry when it comes to AI glasses, which we know that, and he sees a big opportunity there. A lot of analysts see a big opportunity there. He says if we deliver even a fraction of the opportunity ahead, then the next few years will be the most exciting period in our history.
It's true, but there'll be a lot of competition for those glasses. I did also just get some new Meta glasses that I'm really excited about. I'll talk about those, but not the one with the screen in them. I'm not doing that.
Between $2.83 billion to $2.89 billion. The estimate had been for $2.8 billion. So a bump up of that range. Take a look at shares down almost 9% at this point, though. So certainly some disappointment coming through when it comes to eBay.
Some disappointment as well when it comes to Carvana. Those shares down 10% in the after-hours trade with third quarter EPS coming in at $1.03 a share. Revenue coming in at $5.65 billion. But here's your guidance. The company says that full-year EBITDA will be at least $2.2 billion. It had previously pretty much guided towards that. It had a range of $2 to $2.2 billion, so maybe potentially trying to nudge slightly above that with regards to expectations. We should point out, though, the company is also saying...
Let's put together some of this. So the Meta numbers, and then we can analyze some of these in detail. But here we go. The Meta numbers, okay, so let's see here. Meta family of apps beats 50.77 billion versus 49.04 billion. We have Reality Labs operating loss less than expected. Loss at 4.43 billion versus 5.16 billion. I hate the Reality Labs thing, but whatever. Then you've got, let's see here. We have ad revenue beat again. Ad revenue beats again at 50.08 billion versus 48.59 billion. I've got, let's see here. Operating income up at 20.54 billion, up 18% year over year. However, the big hit here is the tax charge. Tax charge one time, $16 billion charge. Ouch. You know, so that's, I think, what hits the EPS number here. So let me see here what they're saying in these numbers. So Significant. Okay. Huge drop in net income from last year. Right, because the income was just 2.71 billion income net. Bigly drop from last year due to tax charge. Darn taxes. Because it basically beat across the board, right? And then if I go look at the CapEx guide, CapEx guide 71 bill for fiscal year, saw 69.3 bill, so a little bit more on CapEx here as well. And then for total expenses, 117 bill at midpoint versus 116 bill forecast. So a little bit higher on expenses. There we go. That's the CapEx versus total expenses. That's fixed. Okay. All right, so that's that. If we look at Alphabet, Gemini app has 650 million users. Gemini's better than Llama, for sure, in my opinion. So 650 mil users on Gemini app. Wow. It almost makes them like a, that sort of stat. That stat makes them seem like an open AI alternative to invest in publicly. Right? Okay, then you have, we saw the CapEx boost. And this is going to be at 92 billion midpoint forecast, which is huge, mind you. YouTube ads beat, let's do some of this math here. Okay, YouTube ads come in at 10.26 divided by 10.03. That's a 2.3% beat. Cloud, Google Cloud Rev beats at 15.16 divided by 14.75. That's a 2.7% beat. Search beats at, what do we have here? 5657 divided by 4.99, 2.8% beat. I mean, this is pretty good across the board. Let's see here. Google advertising in total. Google ads at 74.18 divided by 72.46. It's a 2.37% beat on Google ads. 2.37% beat on Google ads. Google ads total. Okay, so that's pretty good. ServiceNow does a, ServiceNow is going to do a stock split. 5-to-1 stock split. Now is going to do a 5-1 stock split. They come in with a beat on forecast and a beat on revenue. Slight beat on forecast and revenue. So there's not too much fun there. And then Carvana beat, but we know it's down, but they beat Q3 vehicle sales at 155,941 versus 150,632. That's pretty impressive too. 11.3% margin versus 11.7 expected. This might be tanking the stock. Might be hurting the stock. And then that's probably hurting Meta as that tax charge. Then we have, and then obviously the guidance at Meta isn't like, oh my gosh. Okay, that's that. Let's see here. Okay, cool. Then we did Alphabet. Okay, Starbucks. Let's just slap this in here. S-Bucks. S-Bucks. Starbucks. What do we get here? We got Q4 comp sales up 1%. Expectation was negative 0.48. So negative 48 basis points, and they came in positive. Adjusted operating margin at 9.4% versus 10.2%. So margin's still compressing. Pretty much flat on comp sales. Compare comp trends. Well, I mean, across the world, they did beat a little bit. Okay, and then Chipotle. Oh, Chipotle comes out with a miss. CMG. Comp sales decline in low single digits for fiscal year. We have comp sales plus 0.3% in Q3 versus estimate for 0.99%. Oh, that's not a good that's not good. Revenue comes in at 3 bill rev versus 3.03 bill expected. Adjusted EPS matches at 29 cents. And it's just a comp sales miss. So I wonder how the stock is moving on that. CMG. We have Chipotle's flat, basically. Almost no movement on that. It's almost like the market just had pretty low expectations here. So broadly now, Qs in post-market are down about 20 bips. If you look at, let's see here. NVIDIA is holding on to its 3%. Dude, Symbotic skyrocketed. Big fan of this company. Wow. And then, yeah, Meta, a nice little bleed here. ServiceNow slowing down on its run. Okay. What do you have over here? Let's jump around.
The engines we need to deliver those planes before the end of the year. So it's indeed a lot of work in the last quarter of the year, but we think we have the ingredients. We're prepared to come close to the 820 deliveries we have guided for.
And would you say that the engines are still your biggest bottleneck at this moment? You mentioned the gliders, for example. I know you had to park some ready-made planes because of that engine issue. So is that the biggest issue, would you say, when it comes to the state of your supply chain?
The majority of what we're delivering are the A320 family aircraft. And indeed, for those aircraft, the main bottleneck is the engine availability from both.
That's boring. Yeah, because they have to wait for like the Canadians, Pratt & Whitney, or, you know, Rolls-Royce. Okay, they're on commercial too. Okay, so broadly, I mean, there's nothing scary. Meta app is still growing at 8% for Meta users. That's wild. Meta still has 8% user growth. 8% user growth on apps. That's really impressive. And let's see here. ServiceNow, Starbucks, Alphabet. Chipotle, we saw that, and then Microsoft. So what happened with Microsoft? Microsoft, I mean, they beat 2. So I guess that's one I still have to write down. Microsoft came in with 39% Azure other cloud rev, which is amazing, right? That's very good. But Intelligence Cloud beat as well at 30.9 versus 30.1, 8 billion expected, and then we had Q1 rev beats at 77.67 bill versus 75.55, which is kind of nominal. That's a beat of 77.67 divided by 75.55. It's still 2.8%. It's kind of like Google, 2.8% beat. That's a lot like Google, actually. And then they're going to provide guidance on the call. Oh, okay. All right. Well, that could be something too. Guidance on MSFT call. Okay. So, good. Interesting. Also, they said Q4 revenue will be partially offset by lower year-over-year Reality Lab sales. So I wonder if that's because they're lapping, higher sales for the Meta glasses, maybe last holiday season, right? Expecting lower year-over-year sales on Reality Labs. I'm gonna put maybe lapping last Christmas. Okay. All right. There we go. So a lot on earnings here. And then obviously we had a lot on the Fed here. Remember to get that coupon code Schumer Siesta. Coupon code ends tonight. So that'll be 11:59 p.m. I encourage you to be there. Be square. You get lifetime access. Could even be a tax write-off for you. So check it out. By going to mekevin.com. Make sure to read the offering solicitation before investing in HouseHack or reinvest AI at househack.com. We'll see you over there as well. Thanks so much for being here.